and market-based instruments to respond effectively as may be required. In this regard, we shall remain vigilant, and we are fully prepared, as I mentioned earlier, to do whatever it takes to preserve an orderly market conditions. To conclude, global economic conditions and sentiments continue to be frayed without any meaningful resolution of the West Asia conflict. While these have adversely impacted the domestic growth inflation outlook, the economy at this point is relatively strong. We shall put in place policies to meet the challenges while taking measures to further strengthen the macroeconomic fundamentals of the country. Thank you, Namaskar, and Jai Hind.
Well, the rupee has responded. We have seen a decent amount of strength. I think it's about 1/3% higher. Almost everything that we were expecting or everything that was being speculated in terms of helping the currency, helping capital flows have been announced by the Reserve Bank, and these include ECB concessional hedging by the Reserve Bank for all PSUs who raise money. So you should expect SBI, BOB, PFC, REC to be able to raise money. Likewise, the number of government securities which are available and the fully accessible route. That's what the governor meant by the far route. Those are the easily accessible instruments for the foreigners. That now includes all instruments, 5-year, 10-year, 10-year, 30-year and 40-year bonds. That hopefully will mean more bond inflows. So I think they've gone the distance as far as allowing people to come in, allowing debt funds to come in. NRI limits on NRIs has also been extended to all other entities as well. And this other one, full bearing hedging cost to authorized dealers for FCNRB that they raise. Now, I'm a little unsure of that, because if you allow that, people who have kept in NRE and other accounts will now come through FCNRB. So it's a possibility that that will not bring more money but only circulate existing NRI funds or FCNR funds. It's a possibility, but ECB quite clearly will be fresh funds. So let's go to the top banker. Mr. Ashwini is already waiting with us. Sir, what is your reaction? Do you think SBI will now go out and raise funds because the hedging cost is going to be concessionally borne?
Thank you, Lata. So, as you mentioned, most of the steps in the policy are ones which we have been discussing with both the Reserve Bank and the Government of India. So, in that sense, it is good that all these steps have been announced together, because then it is going to make a substantial impact in our view. As far as we are concerned, these two announcements on ECBs, which are to be raised by the public sector units, we are already in touch with all the public sector units with whom we have their accounts, and all their plans we have been discussing with them. So this will come as a major boost to those, and maybe we will go in for those ECBs. Secondly, in terms of FCNRB deposits, while some money can transition in this manner, as you mentioned, but and we have to still see the details. But I do think that there will be a lot more new money. So it's a clear 3% advantage which is being given. 1 year forward is 3% today. And overall hedging cost is around 3.2. So that advantage of interest, if we pass it on substantially, I think that should result in a lot of new money also coming in. That's what our hope is. And we will go all out to market those schemes and reach out to all the NRI customers, which we have both in the Middle East, the US, and other European countries. And hopefully we should see significant inflow of these FCNRB deposits to us, new money especially.
What is significant, sir? What is significant? Can we talk about, on ECBs, can we talk about what, 30 billion? And FCNR, how much approximately? Are we talking 50 billion, 60 billion, including both FCNR and ECB?
It's too early to give out numbers, Lata, because we have to still assess in terms of FCNRB, what will the appetite, how much people will bring in. I do think anything upwards of 10 billion is something for the system as a whole. Should be expected for the FCNRB flows. On ECBs, again, we have to discuss exactly with all the PCP, public sector units, to see what is the plan and are they willing to take something more. So it should be substantial, but overall, what will be the number? I'm not in a position to at least give it out as we speak now.
Fair point, sir. But do you expect some more elbow room even on the deposit front? I mean, if that much of money, after all, every FPI pull out of money has mean, reduction, contraction of deposits also for the banking system. If this 50 billion were to come, or whatever, some number were to come, are you all having much more elbow room on deposits? Do you expect deposit costs, therefore, to fall, or cost of funding to fall for the banking system?
So we are not expecting a substantial reduction in the deposit cost. We have to still see how this plays out. Now, to your point, on a principal basis, if a lot of foreign exchange comes in, and then we have to deploy it domestically because the hedging is taken care of, to that extent, there'll be improved liquidity and there could be some impact. But I think we have to still see this because the credit demand continues to be very, very strong. Even after March, while we can't give out the numbers, but the credit demand is much more strong and the deposit growth is lagging. So I do not see that realistically there will be a reduction on deposit rates, at least so far. We'll see how that goes depending on the flows.
Okay. Sir, please stay on, Mr. Ashwini Kumar. We have a treasury expert as well from DBS. So let me get the overall currency view. At the moment, it is not so much interest rates and growth and inflation that the market is worried about, although I can see that bond yields have fallen. They've come down to 6.96 overnight. They were above 7. So clearly there's a bit of a relief that a possibility of interest rate hike is not there now. And therefore, for the moment, there is a purchase, or at least cutting of shorts in the bond market. You are seeing the yields inching lower. But Ashish Vaidya, over to you. What are you expecting in terms of dollar inflows? And more importantly, dollar-rupee range now. Do you think that 95.7, 96, etc. becomes a ceiling for the dollar-rupee?
Yeah, thanks, Lala, for having me. I think very good measures and very strong measures, a very decisive kind of thought process given by the governor. And I think it is going to lead to significant dollar inflows into the country. And the fact that whatever we were going through, that's certainly going to get alleviated. We'll have to get to the details of how much of the discounts that the RBI is willing to offer. I really don't have the details as yet. But my guess would be that anywhere between about 30 to 40 billion can flow in, put together all these measures, which is including ECBs, the FCNRs, and any other kind of borrowing that can be done. And the better part is that it's going to be quite spaced. So the ECBs could be 3 years and the FCNRs could be 3 to 5 years. So it's a very stable set of money that should really come in. That's certainly positive. Having said that, there is one more point to be mentioned, that the relaxation on the taxation side is certainly positive and good for fixed income. But it's a very technical sort of clearance of, it's a very, I would say, transactional clearance which has been done. And does it really change the math for the fixed income investor globally? The fact that the US Treasury yields are at about, say, 4.5%, and the hedging cost is, say, about 3.2, 3.3%, you still have a negative 100 basis point carry for a global investor. So will he be really incentivized to sort of move into a rush to invest in India's securities? Not necessarily, unless he has a very positive view on the FX. Because if you open out the FX and you allow, then the returns are reasonably significant. Now coming to your FX view, I think like these are very strong measures, and I would think now the rupee should not cross 97 on the outside. But having said that, it all depends upon, we're back to the global geopolitics and basically where the oil trades and where the other things happen. But on a very macro basis, I think basically we can head to 93 also is my very initial take. But we'll have to really take it as things develop.
Okay. Okay. Mr. Ashwini Kumar, there is also the exporters who have to bring back their money. You know, that extension from 9 months to 15 months was given in November. So much of that money, if it is now becoming 9 again, from November to now, it becomes like due anytime now. So I guess exporter flows also will be there. You must expect decent flows, you think?
Yes, so exporter flows will also come in, and this is in
Ashwini Kumar?
addition to. Sorry, can you hear me?
Yeah, go ahead, sir.
So I'm saying that the exporter flows definitely will come in, and in addition to those, this is a series of the same steps which RBI has been taking. For example, the limiting the NDF market positions which was announced in March, and similar other steps which have been taken. So I think overall, this is also going to add to the inflow of foreign currency. And if you look at the complete measures which have been announced together, including the GSEC taxation, which, while it may or may not result in too much of money coming in, was a clear irritant to a lot of investors, and this was flagged to us by many investors. So having removed this, I think most of these structural things are being removed. Of course, nobody can predict the rates of whether Fed rates or our GSEC rates and whether there's money to be made. That will be a call the individual FIIs will take. But at least whatever the government and the RBI could have done, they have done. And therefore, we should expect a decent amount of inflows into India now.
Absolutely. So there's less paperwork. I mean, to answer Ashish Vaidya's point, there may be many jurisdictions where, because of this double taxation treaty, like Singapore or Mauritius, where the tax is not an irritant, but it is always a paperwork irritant. And therefore, if the taxes have gone because of the ordinance, that is, fully done. I think the government was waiting to announce the ordinance to package it along with the announcements made by the Reserve Bank to a T. They have wrapped it together, and therefore, may I request the economists to wait, since we are all excited about the rupee and the rupee-related flows, capital flows that the government has announced, along with the Reserve Bank. Mr. Dinesh Kanabar of Dhruva Advisors is with us. Mr. Kanabar, what is, from an FPI bond investor point of view, the tax is gone, and more number of instruments are available to them under the fully accessible route. Are you expecting your investor clientele to be happy?
So, years, a number of representations were made to the finance ministry. Interest was becoming an irritant. Taxation of the interest was becoming an irritant for a number of reasons. I heard you mention earlier about tax treaties. But under none of the tax treaties does interest get fully exempt, nor is capital gains exempt. And here, of course, we are more concerned about interest and capital gains, because capital gains is only on the fluctuation of the value of the security. Interest is something which is an ongoing thing. And in none of the treaties does that become zero. And the fact of the matter is that there is a huge amount of interest that we have seen of people wanting investment in government securities. The 20% interest was significant. Even if it got reduced under the treaty, it was between 10 and 15. Now that that has gone, is not only do you get your full interest without any withholding, remember, many of these investors are foreign sovereigns, wealth funds, etc., who are not paying taxes in their own country. So this tax becomes a total cost to them. There is no way they can take a credit for it in their home country.
Set off.
So that becomes simple. And then, because there is no tax at all, you don't need to file returns, you don't need to go through a tedious process. So I think it's a very welcome step. Good irritant being removed. It's not just an irritant, but really a huge cash flow from the investor's perspective.
Yeah, actually, things get credited immediately. You sell and it gets credited. You don't have to wait for the longer process of deduction of taxes, provision of taxes, etc., which is what investors of that kind really want. They want to move the money quickly, and perhaps this is a very big relief from a vertical that was anyway not giving the government that much money. Let me get to the economists, and Mr. Tiwari, I would request you to wait, because the language of the governor and the forecast of 5.1 inflation number, 50 basis points higher in forecast than the previous, gives me the feeling that maybe we don't even have to wait for the second half for a rate hike. A 5.1% average inflation and a 5-quarter repo means the real return is very little. So why not an earlier rate hike? Upasana Bharadwaj of Kotak, what is your sense now from the inflation forecasting angle and the governor's language in terms of inflation expectation? Would you advance the rate hike expectation?
Lata, I think the governor has tried to be fairly balanced yet. I don't think he has, of course, he's highlighted all the risks that are pertaining to the inflation trajectory. But the very fact that the second half of the year is now averaging 5.7%, that clearly at the rate at which the repo rate is currently, it does warrant a rate hike. Now, the question is how much of this is going to be resulting in a generalized inflation. That wait and watch is still awaited, as in we still need to see how much of that is going to pass through. So while I do not entirely rule out August policy being live, but I think we will still stick to our base case of October for now.
Okay, okay. No, I would think that for people like Ashwini Tiwari, that will be a big relief. All your loan costs are EBLR, or a large part is EBLR tied, and it takes time for the interest rates to get passed on. So I don't know, when you're meeting on August 6th or 7th, you have a September, a third quarter inflation number of 5.1 staring at you and 5.9 in the third quarter. I mean, second quarter itself, the average is 5.1 according to the Reserve Bank. So it seems like a little unkind to the saver to keep it to keep the repo rate at 5/4. What's your sense, Kaushik? And then I'll come to Mr. Tiwari. Kaushik, do you think we should advance a rate hike expectation given the inflation forecast?
Lata, first of all, it's been a bazooka of announcement that we are all expecting. And as I told you in your pre-monetary policy expectation show that, they will broaden the FAR universe and, you'll have ECB subvention and, you have government also cutting the withholding tax and capital gains tax. So all that you could ask for the rupee, I think it has been done. And, the inflation forecast also, I told you it will be brought, up to 5.1, consistent with oil at about 95 or 100. So that has been done. So if you see the quarterly forecast, as you mentioned, July, September is 5.1, but then October, December is 5.9, and then 5.7 or 5.4 for January, March. They have given this concessional FX swap window till the end of September. So my guess is till September, RBI will not want to hike rates. They'll allow the flows to come in and, cool down the rupee, and we could expect rupee to come down to 93. Our year-end target for rupee has been at 93 when it reached 97 as well, because we're expecting these measures to come. And RBI will allow appreciation to happen when these, flows come in. So to that extent, I would expect October and December 225 basis points rate hikes when inflation actually starts showing up closer to 6%. And then it will not stop there, because as I told you, if your inflation is at 5.1, your repo rate needs to be at least at 6/4. So therefore, I think April and June of next year, you'll get another 50 basis points rate hike. So 100 basis points rate hike, I think, will happen over the cycle. It's just that RBI probably will prefer starting from October, once this concessional FX window, closes, and that is still 4 months. So that is till September end. And the next policy is, just first week of October. So it will be a good time to start hiking rates at that point of time. Also, it will give time to RBI to look at the inflation, whether it is getting entrenched, what happens with monsoon, what happens to growth. If you've seen the revision in growth, October, December, RBI is saying growth will fall to 6.3%, and before that to 6.5%. So the April, June GDP data comes out in end August, and after that the next policy is in October. So I don't think first week of August RBI needs to hurry and hike rates, because most of the worry about hiking rates were coming from the currency point of view at this point of time, and then market was exaggerating how much rate hikes can happen if rupee were depreciating towards 100. Now that fear is gone, and if rupee were to appreciate, I think market will reprice this expectation of rate hikes, and therefore October, December 50 basis points this year would seem logical, and then another 50 basis points next year. But I think this is a very, very good policy, and they have shown that they want to use interest rate only for inflation and growth considerations, which is what the MPC is supposed to do with this inflation targeting model. and use other measures which RBI has to take care of.
Kaushik. Got that, Kaushik. We've got other guests joining us, so let me get to Mr. Kanabar again. Mr. Kanabar, this withholding and capital gains apply to corporate bonds as well, isn't it? To all? Oh, we don't have Kanabar. Go ahead, Ritu, you had some questions.
We've discussed this pretty much in detail, Lata, for the last 20 minutes. You've been talking about, the kind of taxation relief that has come in. But Kaushik, just to quickly come back to what more, or rather if Ashish Vaidya is still there. Mr. Ashish Vaidya, what more, for foreign investors, the government has removed both the withholding tax and the capital gains tax. RBI has announced this whole bunch of measures. What more would foreign investors want to hear for a meaningful, flow into India?
No, I think, a combination of things. So basically, if you look at foreign investors' point of view, the equity market standpoint, this is absolutely delightful. Whatever is happening in terms of, withholding tax removal, etc. But if you look at from a fixed income point of view sense, then the gap between interest rates have to narrow. Now, whether the US interest rates actually comes off or the global interest rates actually come off, but given the kind of headwinds we are seeing in terms of inflation actually picking up, our rates will have to catch up to the rest of the world, and that is what I think the governor also alluded, and that is what our friend Kaushik is also mentioning. I would agree with his estimate that you should get a 250 basis point rate hikes. While my assessment would be it should be a little bit earlier, but we'll have to wait and watch exactly how things pan out. The clarity which probably I don't have at this point in time is certainly the tax exemption, etc., should apply to the corporate bond markets as well. But what I hear from initial understanding is it's only applies to the government bond markets. So if it's made a bit wider, it's far better for the market, and it's really going to help. One more point I just wanted to sort of add is that even if we expect a $30 to $50 billion kind of money which sort of comes in by say September, that's my broad estimate, but the actual impact could be much larger because there's an importer lead and exporter lag phenomena which we've been seeing the last 6-8 months. Now, if that reversal itself can give you an additional $30 to $40 billion.
Okay,
that should be
interesting there. The tax relaxation is only on the government securities, not on corporate bonds. That would have been, a bigger game changer as well. But Mr. Ashwini, since you have to go, Mr. Tiwari, very quickly, from this ECB relaxation or this benefit that comes in, what to your mind are some of the sectors that stand to benefit most? I mean, will we see power infrastructure companies, oil companies? Any quick first thoughts on that?
Yeah, so the normal public sector units which raise ECBs every year are the oil marketing companies, the power companies, and the infrastructure companies. These companies are already some which we have been in discussion with. So they already have their plans and they definitely will raise those loans. The only other thing is that there are other companies which may not have planned immediately, but after this announcement, maybe they will look to for fast forward the earlier plans which may have been next year or after that to the current fiscal. So we will talk to all of them and see how many of them want to raise money either earlier or in the current planning stage. And there should be a substantial amount coming through the ECB route with this exemption which is given.
Okay, Mr. Tiwari, there's someone from your ilk, actually, a state banker, pointing out that the hedge benefit for FCNR is only provided to ADs, that is, authorized dealers. It is not to customers. So does that mean that this transfer of, from one bucket to another to come to the new FCNRB route may not be really feasible? It's not going to advantage them. This is more a hedging advantage available to you. So someone is arguing that the FCNRB will be all new and it won't be churning out of the old deposits. Is that a fair argument?
So, I don't want to comment without seeing the full instruction, but my sense is that if we as authorized dealers get any benefit, then we are going to pass on that benefit to the customers as well, and maybe increase the rates, etc., to compensate for whatever benefits we are getting. But let me also look at what the exact instructions are, and then we will come out with our policy subsequently.
Okay. Okay, so more generally, Mr. Tiwari, is it fair to say that once the ECB money comes in, you are likely to see a fall in funding cost? I'm not asking you to cough up SBI's margins, but for the banking sector, can margins dip a bit? Margins improve a bit because funding cost falls?
By that general principle, any funding cost, if it falls, the banking sector stands to gain. So therefore, how much that is going to be, we cannot predict till we see the rates. But the last point I will make, Lata, is that once we have some stability on the rupee level, I think you're likely to see a lot of equity inflows as well. This is the feedback we got from a lot of investors we spoke to in our trips recently on the mutual fund IPO. Yeah.
Okay, that is a very big one, sir. That's a very big one. If we can turn the tap over there, since that's always a larger amount of money that comes in. Thank you very much, Mr. Tiwari. I know it's a busy hour for you and you have to run back to the bank. Thank you very much for sparing time for us. Ashish, what about that? Yeah, thank you, sir. Ashish, the point that Mr. Tiwari is making, that if the exporters bring back money, ECB money comes in, overall sentiment is that dollar flows are going to reverse and we are going to see more inflows than outflows. Then, even hedge funds and the NDF market behaves differently. Are you likely to see equity flows? That was the killer statement he made.
Absolutely. From a dollar adjusted point of view, and the expectation of depreciation that was already built into every investor's mind, that sort of fades for at least some time, right? So it will be seen positively. And I think, like I also mentioned, I think it's very, very positive from an equity angle. Let's really look at it from a fixed income angle at a later date when the spreads actually narrow.
Okay, we also have Mr. Jayesh Mehta, Vice Chairman and CEO of DSP Finance with us. Mr. Mehta, what a bazooka of measures, both from the government, of course, on that much-awaited FII relaxation on taxation for government bonds, and of course this whole bunch of RBI measures we've been talking about. Quickly, your first thoughts on these and where you see rupee levels from here with all of these measures getting announced.
I think to start with, everything what was asked for, most of them has been given, of course, but as you said, till Mage more, there is some more people would, at least I would expect it, but at least to start with, this is good. You do see some money coming in, particularly because of ECB as well as for the exporters, 15-month being shortened. I think that too would be a good measure. As far as GSEC is concerned, it is a pain level which was there. So that would kind of get you steady flow, at least to the extent of index. People will not be now a little bit underweight index. So at least to the extent of index, it will come to see. And of course, in the immediate, so much of support on the currency and all this money coming till whatever money comes in till September 26th. And if there is a bullish view on INR, you will see one of the best way for the FPI debt to take bullish view on INR is to buy government bonds. And they would do that for trading purposes also. So that money also would flow in significantly immedately, right, to capture on INR bullishness. So to that extent, all of that is there. The only thing is why you only asked that question, and I think you only answered it. Mm-hmm. Why only government security? Why not corporate bond? And as I said, Dilmage more, why ECB, discounted swap only for PSU, and why not large corporates also? That could really get large money here to the country.
Mr. Mehta, I know this is a long shot, but we've tried asking our guests as well. Any estimates on how much could realistically flow in as a result of these measures from the RBI and the government combined?
So I think on the PSU side, definitely, as Tiwari ji said, there has been some talk, and because of the support, they would be able to get in. So that side of it, maybe I would expect at least $10 to $15 billion from the PSU side. I don't know about the CNRB. Even the mechanic is not so clear, so I won't be able to comment on that. On the bond side, I would say it is just a nominal couple of $1 billion may come in, but at this juncture. Because of whatever the shortfall on the index underweight people were having currently. The good part, as Ashish said, with the currency being stabilized, at least the hedge fund, the investors who were equity investors who were not hedging, they had to put on their hedge because they're questioned by their bosses, like, you're continually investing in equity, which is depreciating asset currency, and therefore they had to forced hedge themselves. So at least that hedge will go off. So hopefully this all measures will do that. But at the same time, while we looked at this, our problem is the FPI equity outflow, right? Till that stops, we will always be on risk. If you look at last 1 week, it's almost 40,000 crores in 5 days, right? They have sold off in India. So that kind of selling, if it continues, I don't know what is the solution to that, but we need to work something on that.
Okay, Upasna, very quickly, since we're running out of time here, the 5.1% CPI forecast, 6.6% GDP forecast, CPI has gone up, GDP has gone lower, pretty much as expected. What's the next move you're anticipating?
As I said before, I am not expecting a rate hike right away in the August policy, although we'll have to wait and watch for data for sure. Our rate hiking cycle starts from October and 50 basis for FY27. That's what our base case is. I just want to highlight one thing, that at the moment, even though there has been upward revision of to 5.1% on the headline, the core inflation still remains at sub 5%, despite the adverse base effects. So I guess that also provides some room for RBI to wait and watch even through August policy and see the impact of imported inflation because rupee comes under pressure. And all of that would probably result in the pace of rate hikes that will begin from October onwards.
Okay, Kaushik?
Ritu, as I mentioned, that we're expecting 50 basis points rate hike this year, and probably the time is October, December. The concession window is till September. So once that ends, I think October is a good time. And then another 50 basis points next year in April, June. So it has to be 100 basis points rate hike, given where inflation is. Policy rate needs to be at 625 to give a 125 basis points of real rate. You asked a question, what more can happen on flows? Just one point I want to say about all these measures that have been announced of cutting in withholding tax and for the fixed income investors. The next step could be inclusion in foreign bond indices with the withholding tax being gone. So that could happen, and that could bring in 20-25 billion flows, not this year, but maybe next year. And also we can move into this Euroclear settlement, which probably was stuck because, we had this withholding tax, which was sitting and creating complications. So once these irritants are gone, as we move into Euroclear settlement and new bond index inclusion, there will be a steady flow of money which will come in. And if rupee stabilizes with all these measures, I think equity money will also look to come in. All they were looking for was stability on the rupee. And these measures, the bazooka measures today that have been announced, and governor said whatever it takes, they'll do to stabilize the rupee. I think this will all work in favor of the next, 6 to 12 months.
Yes, for now, we have the rupee at 95.40. It's appreciated by almost 40 paise, in the last hour or so. For the bond yields as well, there's been some softening, about 4 basis points. 6.95 is the yield we're looking at. So it's come down below that 7% kind of a level, closed yesterday at about 6.99. Jayesh, quickly, on the 10-year near term, where do you see it settling with all of these measures now factored in?
I think there will be some relief rally happening, but I think the larger issue is the short-term rate because of LCR, the way banks are borrowing their short-term, which is at still 7.5. That will kind of stop the local guys to really go all out for it. But definitely you'll have some foreign FPIs who are on the more trading side, especially when your rupee is bullish. They would bring in maybe 10-15 basis points lower from here. But we need to see how many of the trading FPIs really come into buy. But looks like they should come into buy.
Okay. Thank you very much for that, Jayesh. I think this is all that the market could expect from the Reserve Bank that has been delivered. It is a hawkish policy, and I would tend to believe that we now have to advance the rate hike expectation to the next August policy. It is April, May, June average that the inflation average is 4.2. For July, August, September, it is 5.1. So already from July, the inflation is inching closer to the repo rate. And that's not what is expected from a Reserve Bank. The Reserve Bank is expected to give a positive real return to the saver. And therefore, if you're sitting in August and there's already 1 month where, inflation is inching towards 5%, then to keep it as late as October would be unfair to someone who is putting in a deposit or a saving instrument in, say, July, August. My sense, therefore, is that the way in which the inflation forecasts are given quarterly, with second quarter, that is July, August, September, already going to an average of 5.1, the Reserve Bank, under a flexible inflation target, is morally responsible to giving the interest rate hike a little earlier. That would be, again, bank positive, even if that is NBFC negative. But at the moment, we are more concerned about the currency, and I think the government and the Reserve Bank have gotten together and almost to a T at the same moment announced a bunch of measures that the markets have been waiting for, asking for, and this is a lot of paperwork less for foreign investors, plus number of instruments available to them, and of course FCNRB and ECB concessions given to banks to bring in money. Chances are that we are going to see the currency rally somewhat, and if what Ashish Vaidya and Ashwini Tiwari are telling us, that will also mean that equity investors may also find this a very good bottom price for the currency to enter, at least to dip their toes. It looks like the best has been delivered. Let us see what the governor says in the press conference. From Ritu and me, thank you very much for watching the Special Monetary Policy Show. We will be back at 12. Until then, it will be time for HTR.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia, flanked by the ladies Ekta Batra and Sonal Bhutra. Ladies, good morning. Well, it's a proper Friday, right? Chaos, one news flow after another, and the RBI policy has almost taken a back seat because there is so much that has happened beyond that.
And, you know, as you said, it is not like we didn't have enough. Now today, we are getting news flow after news flow, and important at that as well. So we'll discuss that with our experts as well. For now, if we take a look at the markets, there has been a massive recovery from the lows of the day as well. And that is important to track. The Nifty, a sharp uptick since the time we saw these announcements come by as well. It is up 53 points above the 23,400 mark. Across the board, we are seeing that recovery. Bank Nifty is the one which is outperforming the benchmark indices, so that is the one which is pushing the Nifty higher as well. And there you go, at the day's high, a sharp one at that, 420 points higher, almost a 350-point recovery from the lows of the day. The Sensex is off 450 points from the lows, and a lot of these banking names continue to be on our radar. The tax cut or the tax exemption on interest that has come in on GSEX and the withholding tax, and a lot more actually. We'll discuss that on the show today. But looks like that's what the markets are enthused about. But whether it's a big term or a long-term impact or not, we'll see.
Hi, well, yes, absolutely, you know, and what stands out is not only the impact on the equity market is what has taken place in terms of the bonds as well as for the rupee. So I just want to pull up the bond market for you and the bond yield. If you look at it, the yield on yesterday's closing was 6.99. And today, ahead of the policy, it had already softened to around 6.97. That's the bond yield. And currently, post-policy, it's come down to around 6.95. So there is softening which has taken place in terms of the yield. So you can see that it's currently at around 6.95. For the rupee as well, ahead of the policy, before the RBI policy at 10 a.m., it was at around 95.7. Post-policy, the rupee has softened or appreciated to 95.4 and even further at this point in time. So that's the kind of impact that you're seeing in terms of the bonds as well as the rupee post all of the steps which have been announced both by the government as well as the RBI. But to take all of this forward, we have Dheeraj Agarwal, who's the Managing Director, Ambit Investment Managers, joining in. Dheeraj, hi, welcome to the show. Well, you know, some people have described this as a bazooka in terms of what the government has announced, in terms of flows that we could see eventually, say from a 12 to 18-month point of view. What is your stance, and what do you think the market should make of this?
I call this more of a relief at this point of time more than a bazooka. The government and the RBI wanted and needed to do something more decisive on currency management, and I think the current RBI policy announced today actually stands out on that account. Everything else is a little bit in line with expectations, rate pause and some warning on GDP growth outlook, some warning on inflation outlook, looking at the global environment. But the steps taken to stem the fall in rupee and actually push it towards a little bit of appreciation at this point is a massive relief. But you know, we need to remember that rupee is one of the few reasons FPIs are cautious or bearish in India. It's not the only reason. It's become the more noisy, more predominant reason which is highlighted. But there are other issues as well. But stemming the fall in rupee was a very urgent requirement, and I think the policy announcement stands out on that front.
Dheeraj, thank you for taking time out today. But you know, the announcements that were made with regards to the FPI, the NRI and the OCI investment limit enhancement as well, is that also, would you consider something as a relief measure? Because of course, as you mentioned, there are a lot of other factors that need to fall into place. But for a sentiment positive, for a market that is, well, for the lack of a better word, thirsty for a positive development, would that be enough to at least arrest the downside that you could see in the market? Let's not get to the upside yet.
You know, the problem in the Indian markets have been outflows and not really the scarcity of limit for the additional inflows, right? Now, inflows will happen when the earnings growth improves, when the earnings outlook starts improving, or when people get a little tired and bored of the AI trade, or a little worried about the AI trade which is happening globally. So it's a welcome measure, yes. All the measures are welcome, but I think the most significant measures are still more currency directed. and currency is already showing 30-40 bips of appreciation the last time I saw, and if it appreciates, let's say a few percentage points more from here, that's a major relief, according to me, in today's RBI policy.
Dheeraj, there are relief measures announced. As you said, it's a relief, not a bazooka. But the RBI governor did speak about uncertainty, spoke about a fear of El Nino that could lead to higher inflation. Growth forecasts, they have been trimmed down as well. Will markets take note of relief for the short-term period and look ahead in terms of the inflation, energy security issues, and the fact that the war is still on? Is that something which could keep things under check for a longer period of time?
I think so. That's what my belief is. I think by taking care of the currency at this point of time, what we have, or what RBI has ensured, is that there is no panic. And remember, that's the central banker's primary objective. In fact, the governor did mention in his speech today that they don't really target a level for the currency, but they don't want disorderly price movements. So by doing these movements, they are sort of arresting a panic both from the currency market point of view and equity market point of view. But longer term equity market will do well only if with the growth outlook and the earnings outlook improves. And on that count, even the governor's speech was a little cautious. I mean, there has been a cut in the GDP growth forecast, there's a hike in inflation forecast. And I mean, the most significant sentence in today's speech, according to me, was after he did these two forecast changes, the governor did mention that the risk is more on the downside, and risk is not more that these forecasts are conservative. Second key announcement that he made today was that RBI is revising up the crude basket estimate from the last policy itself. But last policy, I think he mentioned, was $87, if I remember correctly. So it's higher than that. And remember, a year ago, we were at about 65 or 67. So the medium-term picture is still not very rosy. So we need to be a little cautious.
Okay, well, Dheeraj, you're sounding very cautious at this point in time. What does that mean for FIIs coming back into the equity markets now? The RBI was extremely cautious. CPI estimate is 5.1%. GDP estimate has been lowered, for the year as well. In that context, do you think that this is going to be a sullen year for FIIs flows into the equity markets?
I don't see any. Sorry about continuously sounding cautious, but I don't see any compelling reason for the FPIs to start coming back. If the currency starts to appreciate, what can happen is that the pace of outflows or the outflows itself may slow down. Now, given the fact that there is like average 5,000 crores selling a day by the FPIs, that itself will be a welcome change. But for FPIs to come back, something more needs to happen. But I think the fast pace of pull out of money from India might slow down if rupee stabilizes or actually starts appreciating.
Slow down, I guess that is the optimist would take that as well, even if it slows down, because the extent has been something that has been a matter of concern. But Dheeraj, the entire gamut of announcements that have been made, the one sector that gets impacted the most is financials. And almost in every conversation that we have with every fund manager or with a market expert, the consensus more or less is the fact that financials is possibly the place to be, because there are plenty of other headwinds for a lot of other sectors. Do you also fall into that camp that financials is the place to be with all these developments that are taking place? And if so, where would you be in this, be it in the private banks, the NBFCs, or even in the public sector banks?
No, I'm actually, I continue to be cautious in financials, because financials are a reflection of the macroeconomy to a large extent. And if there is going to be GDP estimates cuts going forward, there is going to be inflation estimates getting increased going forward. And I was on your channel, I was listening to Lata just before I came on. None of this bode really well for financials from a 12-month point of view. After today's announcements, can they do a month, month and a half, 2 months of upward swing? That's always possible, but that's not what we're talking about here.
Okay, maybe not a long-term story. We'll see which way things go in August if the rate hike does happen. But Dheeraj, always a pleasure speaking with you. Thank you so much for joining us today with your take. So basically, yes, these are relief measures that have come by, but Dheeraj says for equity markets, there's still some caution because inflation outlook that continues to remain somber. Let's take a quick break. Post that, we'll be joined by Anil Bamboli, HDFC AMC, on India's big move to attract foreign capital in the bond market and a lot more. Welcome back. You're still tuned into Trading Hour. The markets continue to trend higher, but a lot has been announced by the RBI and the government. The tax cut or the tax exemption on interest on G-Secs by FIIs and the withholding tax is something that was expected and has finally been announced. What does this mean for the bond market and FPI flows in the fixed income space? Anil Bamboli, head fixed income of HDFC Asset Management Company, is joining in with his thoughts. Anil, good morning. Thank you so much for joining in. Well, this is something which was expected and has finally been announced by the government, the capital gains tax exemption on interest on G-Secs and the withholding tax as well. It is just for G-Secs. We are not seeing it for corporate bonds. Do you think that is enough to enthuse FPIs to get in more flows into the bond market? What do you make of this announcement?
So just to get some perspective, if you see the outflow that we have seen recently, most of it has been in equity. Debt, if you look at it in the month of March and April also, we hardly had an outflow of around 2 billion. In fact, in the month of May, there was a marginal inflow. So FPIs haven't really sold off so much on the debt side. But yes, at the same time, these measures will definitely help. It makes it it makes interest rates, the investment in G-Secs more attractive. Along with that, of course, as RBI has announced a lot of other measures to raise forex reserves and get some dollar inflows. I think overall it will reduce the pressure on rupee, and hence I think it will make the G-Sec also relatively more attractive.
Okay, Anil, hi, welcome to the show. Well, how much, according to you, are these steps being taken in order to facilitate maybe the addition of the Indian bonds in the Bloomberg Global Bond Index?
So this was also one of the asks of the FPIs for a long time, and I think Bloomberg Index, I think, had some issues around it also. So I think this will help as one more measure. Recently, I think ECB and RBI also arrived at some consensus on, recognizing CCIL as an exchange. So these two measures put together, I think, increase the chances of India getting included in the bond index.
Anil, trying to play the devil's advocate here, so moves, of course, a positive, yes, but for an FII or an FPI who is getting a 4.6% return in dollar terms in the 10-year bond on the US, is that step attractive enough for them to come into India at a 6.97% in rupee terms, even without the tax exemption? Does that gap, is that enough of a step to fuel further investments?
Dollar returns, yes, are high, but I think, again, you have to get some perspective on some of those numbers. You have to look at the differential, and that too on the real yield, basically adjusted for inflation. So if you look at 2009 to say 2019, the 10 period after 10 year or before COVID, the differential was much lower compared to what it is now. The real yield difference, that is the inflation differential and the difference in the 10-year yield, that difference was as low as 0.4 on an average in that period. Currently, it is much higher at around 2.5. Even if you take the last CPI numbers, the differential on the real yield basis would be closer to 3% or 2.5%. So actually speaking, though the absolute yield difference is lower, on a real yield basis, actually it is much higher compared to the pre-COVID period. So that, I think, remains an attraction. As I mentioned earlier also, they haven't sold off in this period, even though US yields have been higher. We haven't seen very large outflows from FPI. And all these measures will only enhance the attractiveness, and hence there can be some inflows, may not be very large. If the Bloomberg Index does come into play, yes, the inflows can also be large.
Okay, that was expected in June itself, right, Anil?
Sorry?
The index inclusion was expected in June itself, or was it sometime away?
The next review was in June or July. I don't remember the date.
All right. Okay, so what's your take on the rate cycle from here on? The conversation suggested maybe it could be preponed, but what is your take? When do we expect the next rate hike? What kind of action do you expect from the RBI from here on, considering the inflation forecast, the growth forecast that they have put out?
So yes, they have increased the inflation forecast. So the average inflation forecast is now 5.1 for the fiscal year FY27 compared to 4.6 earlier. So we expect that RBI will increase rates anywhere between, say, maybe 50 to 100 basis points in the next 12 months. Timing can be a little difficult, whether it will start from August or October, because in August, the full monsoon impact may not be visible. By October, that will be more visible. By October, you'll have some more data points on the first quarter GDP also that will be out. So it will be a toss between August and October, I think, is when they can start. Very difficult to pinpoint whether it will be August or October.
Anil, just wanted to circle back to the point that you mentioned about inflows into the debt market from FPIs, if in case there is that addition in the Bloomberg Global Bond Indices, which does take place. What is your sense in terms of how much could possibly come through if in case the addition takes place? And by when? Will we probably see it second half onwards?
Yeah, so once it gets included, they will give a timeline as to when actually they will start including in the index. That lag can be anywhere between 6 to 9 months. So the actual inclusion may happen from January or April of next year. But as we saw when it happened with the JP bond index, the inclusion date was much earlier, but the FPI flows happened much before that. So I think the moment they announce it, I think thereafter we should start seeing gradual inflows from there. The amount is a little difficult, but market estimates are that it could be in the region of 15 to 25 billion.
Okay. All right, Anil. Well, that's definitely music to the ears if in case that does come through. Thanks very much for joining in and speaking with us. So that is the view coming in on the fixed income market. We need to take a short break with the news that the Nifty is absolutely flat at this point in time. Mid-caps are holding up with a gain of around 0.3%. Bank Nifty up around 0.6%. Take a break. Up next, we'll be discussing market technicals. Himen Kapadia will be joining in.
Welcome back. Well, the markets continue to remain choppy, and if you take a look at the chart as well, if there was ever a chart pattern called the Grand Canyon pattern, you would see this today as a fall from the cliff, then you come back towards the highs, and then that recovery gets sold into again. So we are absolutely flat, as flat can be right now, and the banks are the ones that are contributing to this volatility. You take a look at the Nifty Bank as well. Now, there was a very, very sharp recovery that you saw from the lows, still holding on to gains of around 0.5%. That 54,500 level remains the crucial one to watch for the Nifty Bank, but again, at higher levels, towards that mark of 55,000, there is some supply that is emerging for the Nifty Bank as well. The good part is that the currency is doing well for itself. Despite all the choppiness that you are seeing in the market, the rupee currently is now 95.33 as we speak. So a 0.5% appreciation that you're seeing. The yields have cooled off further as well. So at 6.94 is where the yields stand. And the entire policy gamut announcement has had a very, very choppy impact on the market as well, the banking stocks as well in general. Look at Bank of Baroda, look at HDFC Bank. They had all moved into the green at one point of time, and they are now back in the red. Bank of Baroda is down 2% among the top PSU bank losers. Of course, the stock is ex-dividend today, mind you, so you need to keep that into account as well. HDFC Bank, Kotak Bank as well, 0.5% lower as well. The sector that is continuing to see selling pressure, though, is the metals. Nalco was down 4.5% yesterday, is down another 3.5% in today's session. Tata Steel, Vedanta, Hindalco. Vedanta seeing profit booking from higher levels. It was up around 30% in the month of May. Hindalco too, from 52-week highs, is seeing a bit of a cool off. You take a look at the newsmakers today. Wipro, record date for the buyback in today's session, so 4% on the stock. Hindustan Zinc, some news reports coming in as well, 4.5% lower. Trent turned ex-bonus yesterday, was down in yesterday's session, continues to extend those losses. And Physicswala seeing some profit booking today after that 15% up move that we saw in yesterday's trading session. And lastly, some profit booking seen in a lot of these high-flying names. Take a look at HFCL, down in the lower circuit. Sterlite Tech, down in lower circuit. And of course, there were other names as well that were seeing some profit booking. Wockhardt was one such name after the up move, down around 7% in today's session as well. Good time to get in a chart check as well from Himen Kapadia from DR Choksi Finserv, who's now joining in. Himen, good morning. Thank you for taking out time. It's been a while, but for the market that continues to remain the way it is, how important is for the Nifty to A, defend that 23,151 low, and B, cross 23,500 on the upside? So your call on the index and your stock recommendations for the morning as well.
Very good morning to you, Thomas. Thank you for having me on the show. It's all the pleasure. And yes, it's been some time. Frankly speaking, you answered your question yourself. I think 23,151 is crucial. I wouldn't say make or break level, but yes, it's crucial. I don't see that breaking. Hopefully it doesn't. And there was this gap from 8th of April, we've spoken about it earlier. So that has now been covered up. So 23,151 does not need to break. Bank Nifty showing relative strength. Downside does appear limited. The VIX has gradually drifted below 16. I believe if there is some settlement on the geopolitical issue, VIX should be back below 14. Things are looking okay, despite the volatility that you mentioned in the Grand Canyon pattern that you mentioned, Hormaz. I think the Bank Nifty is showing a little bit of relative strength. I don't see 52,700 breaking. I'd see 55,500 coming first. But yes, the choppiness isn't going to go away. And things are looking wobbly, but slightly stable. Stocks that you told me, which I like and I would recommend. First stock that I like is State Bank of India. 1, oversold. 2, crossover buys by the mechanical indicators. 3, positive divergence. So it's a sort of a trading buy. One can buy State Bank at 985, stop loss 970, target of 1015. The other one is Eternal. Eternal looks quite interesting. Is on the verge of breaking out. Hasn't yet, but looks good. So one can buy Eternal at around 255, stop loss of 244 and target of 277. It's on the cusp of a breakout, Thomas.
Okay, take that point. Thank you so much for joining us, Himen, as always. Have a great weekend ahead. That's all about the technicals of the market. What's happening with the F&O space? Let's get in Sudarshan with the latest trends. Sudarshan, quite volatile for the markets now.
Quite volatile. Market remains choppy. If you have financials coming as a support, one segment or one sector that remains a drag is the IT. At the morning, we thought that Nifty IT today might provide a support as well along with financials, but that has not turned out. Today, it's one of the major drags along with metal names, but there are certain positive part as well. If you take a look at the put-call ratio, it continues to hold the levels around 1, and also volatility index as of now still trading below 16. That also can be taken positively. There is a sharp recovery in the rupee after the announcements made by government as well as RBI related to certain tax exemption for FIIs in the investments that they do in G-Secs or say government securities. And that's the reason now you're seeing a rupee at trading around 95.37 versus previous day's close of 95.79. Now, coming to the options data. So in Nifty, you are seeing a major action in the range of 23,300 to 23,700. So it tells you the range. So on the downside, 23,300 seems to be protected as of now. But on the upside, there is a very low probability of Nifty moving beyond 23,700. So if you take a look on the put side, 23,300 and 23,400 are seeing maximum increase in the open interest, but at the same time, there is a drop in the premium for both these put options. Also on the call side, 23,500 and 23,700 too are seeing a drop in the premium. So you are seeing writing not only on the put side, but also on the call side. That's the reason I'm telling you the range is very narrow of 400 points for Nifty. So support 23,300. First resistance for Nifty would be 23,500. Buying will return only when we cross 23,500 comfortably, and next resistance comes around 23,700 or say 23,800. As far as Nifty Bank is concerned, after these announcements, there's some kind of buying like we are seeing in Nifty Bank. So support would be 54,000 and resistance would be 55,000 for Nifty Bank. Some of the stocks, you can see top Nifty gainer at this point is Bajaj Finance, up more than 3%. It's seeing fresh buying. Hindustan Zinc, there is a news on Bloomberg that government is looking to sell up to 2% stake via OFS. And after that, there is a sharp drop and fresh shorts are being added on that counter. And Hindalco from the metal names is also seeing fresh shorts.
Okay, all right, Sudarshan. Thanks very much for bringing us all of those F&O cues. Well, for the markets, we're holding up for the broader markets, so it's not doing too badly, up around 234 odd points for the mid-cap index. Bank Nifty up over 260 odd points. But it is the Nifty as well as the Sensex just about consolidating right now with a little bit of a positive bias. We'll do one thing, we'll take a short break, but on the other side, a panel of experts joining in to help us make sense of the latest tax relief measures for FIIs. Tejas Desai of EY India and Rajesh H. Gandhi of Deloitte will join in just a bit. Stay tuned. Welcome back. Well, the advanced decline ratio has been holding positively, so that's good. It stands at over 2,200 stocks advancing to around 1,600 stocks declining at this point in time on the Bombay Stock Exchange. But let's get talking about the tax changes for FPIs, NRIs, OCIs and PROIs. We do have, as promised, Tejas Desai, who's the partner at Tax Financial Services leader, EY, now joining in to discuss this. Tejas, hi, welcome to the show. Well, there have been, these equity investment limits for NRIs and OCIs and exchange-traded instruments without SEBI registration, which have been increased. Just take us through the changes which have taken place and what does this mean? Were there significant regulatory hurdles which have now been eased?
Sure. So look, this is something which, was announced in the budget in February. The government wanted to do two things. One is for investments by NRIs and OCIs through the portfolio investment scheme, where there are regulatory limits in terms of how much they can invest. Those limits have been increased. So the government had already made an announcement in the budget speech. What this is now doing is giving effect to that, right? So this is obviously, on the lines of the government wanting to attract more foreign flows and whatever sources it can tap on. And NRIs and OCIs are obviously, the first audience that comes to mind. So that's the measure that they have given effect to. The second thing they are looking to do is to attract foreigners. So, look at this as a man on the street in London wanting to invest into India and how to make investment regime for them simpler without going through a lot of paperwork and without going through a lot of registration. So that's the second thing that they've done. I think we need to wait for, the detail and the fine print to be there. But that's the two target audiences in the minds of the government, which they want to attract to invest into India. And I think it's a good move. Look, obviously people will invest basis, the expectation of return. But I think what is important that India is putting itself in a ready state that when the tide will turn, we can have some of these participants put in their dollars into the Indian market. And we are essentially, the government is lining up its ducks and putting itself in a ready position.
Okay. Tejas, how large would the addressable investor universe be now, other than OCIs, NRIs, this particular category where these relief has come, the persons resident outside India? How big of a flow can we look at once this does get operational and we do get more details?
So look, again, I'm not an expert on this, but I think it'll be small beginnings here. It will be humble beginnings. Getting foreigners, pure foreigners, to invest into India is never easy. If you look at India and how many people invest outside India, it's still a small portion, right? So it will be humble beginnings.
Okay, well, on that point, Tejas, the fact that there used to be certain kind of limitations that existed, what might be the risks to this easing?
No, I really don't see, risk to this, this move, right? Anyway, the FPIs are anyway subject to a 10% cap on their investment in a single portfolio company, right? The cap for the NRIs was lower. They've only increased that cap. So I don't see a risk, from that perspective.
Okay. Tejas, anything else that stood out for you from the government announcements that came by? We had that tax cut on GSECs, exemption, I would say, the withholding tax. There have been multiple announcements on the FEMA bit as well. Something that stood out for you and can be considered an immediate relief for the industry, for whatever is happening with macros, rupee, etc.?
So actually, that is a big one. The exemption that has been granted to foreign portfolio investors from any income that is earned from investing in government securities. So for your audience to understand the context, today when FPIs invest into India, they pay tax both on the coupon as well as when they sell the government securities. So if they hold it to maturity and they earn the coupon, they will pay tax on that. And when they sell it prior to maturity, they will also pay tax on the sale. What the government is now doing is completely exempting the income from interest as well as capital gains that is earned by FPIs on government securities. So there is zero tax through the value chain, nothing to be paid, by the FPIs. And the tax rates were 20% on the coupon and 12.5% and 30% on the capital gains, depending on whether it was short term or long term. So I think it's a significant relief. I think what it does is, I think it's a very market friendly reform, and it puts India, in line with all international jurisdictions, which do not tax, income from government debt. So I think it's a step towards internationalization of India's bond market.
Okay, all right. Well, just circling back, Tejas, to the NRI conversation, just wanted to understand that what kind of safeguards would possibly remain in place now in order to possibly monitor ownership, concentration, and any kind of prevent any kind of regulatory arbitrage going forward?
See, I think there's a whole machinery on tracking investment limits, whether it is for FPIs, whether it is for NRIs. So I think whether it's NSDL or CDSL, there is a strong mechanism in place to track some of these investment limits, and I don't think that will change. What has only changed is the percentage. From 5%, it's gone now higher. So that's the calibration that needs to be done. But I don't think that is something which should cause any problems for anybody.
Okay. All right. Thank you so much for joining us today with your thoughts and insights. Of course, initial days for some of these announcements and notifications as well. We'll need more details, but the FPI tax cut on G-Secs is the big one that has been announced by the government today. We'll slip into a short break. Up next, we'll focus on the bond market with Manisha Gupta on the other side.
Welcome back. Shifting focus to the bond markets then. Manisha Gupta is here with all the highlights. Manisha.
Well, it's raining RBI measures and amendments today, and as expected, MPC has voted unanimously to keep the rates unchanged at 5.25%. The RBI also said that the global economic outlook remains clouded by the continuing geopolitical tensions therein, and the monetary policy has turned more cautious globally. Also, the El Nino risk in India perhaps could lead to food outlook uncertainty. The elevated energy prices, global supply concerns is something that the MPC would continue to watch out for. Also, indications that the average oil prices this year are going to be higher than $85 a barrel, a level that RBI had earlier spoken about or had done calculations on. The core inflation in the meanwhile is seen at around 4.7% for the financial year. But for the bond markets, it really is about government releasing the income tax amendment Ordinance 2026. The street has been anticipating this for the last couple of days now, but it was the RBI governor announcing it. So with this, FIIs now have been exempted from tax on any interest on government securities. Also, the FIIs are exempted from capital gains arising from sale, exchange or transfer of these securities as well, something that the street clearly was factoring in. The RBI in the meanwhile also has expanded the universe of specified securities under fully accessible route. Also, RBI has now removed FPI limits on short-term investments. The other measures that RBI has taken is that along with the government tax relief, it also is going to support foreign demand for GSECs, is how the markets are looking at. Is it supportive for not just FI inflows but for the Indian rupee as well? The RBI in the meanwhile also has raised investment limits for NRIs and OCIs for listed equities without SEBI registration. So a lot of measures and a lot of amendments just to ensure that we are looking at stronger FI inflows continuing into the country.
All right, Manisha, thank you so much for joining us with that update from the bond market. Definitely the market to focus on in today's trading session. Markets have come off from the highs, continue to be very volatile, but we did have some market opinion coming in. Gautam Shah, founder Goldilocks Global Research, says he is bullish on the micro-cap and small-cap stocks, adds that he expects real estate to outperform as AI-related concerns appear priced in. Listen in.
Large part of the market, which is micro caps, mid caps, and small caps, they have done phenomenally well in the last couple of months. In fact, I want to use a word that it's been a raging bull market in the micro caps and in the small caps. So I think this bipolar attitude at the markets is going to continue. I am starting to get a little more constructive now. I've been a lot more cautious and bearish for a while now, but I just feel that most of the negatives are in the price. India versus the world, if you look at the ratio charts, they are all at long-term supports. So I want to believe that there is a case that the markets gradually go up from here. So I think the message is be in the broader markets. That's where the action is. And I think that action and outperformance is going to continue for the rest of the year. For a retail investor or for a typical HNI, it still makes sense to go out there and buy a basket of small caps or micro caps or mid caps instead of doing stock picking. Because I think it's a very theme specific market. We've seen the comeback of pharma and chemicals in the last 1 month. And I think both are mega themes for the rest of the year. So I would still be very positive on pharma, PSU, and chemicals, which I think is making a strong comeback. And real estate, for me, I think has made a major bottom. So again, the top 5 or 7 stocks are likely to do exceedingly well. So I do believe that the micro cap index and the small cap index will make lifetime highs much before the Nifty in the next few months. I personally believe that there is too much over pessimism about tech. I think most of the negatives are in the price. Our working target on the downside for the tech index was about 26 to 27,000. We are close to that. And now there is a discuss and debate whether AI is actually disrupting the India tech story, which I think is already disrupted and the markets have already discounted that. I don't think from these levels tech is going to see a big fall. In fact, I think they will get into a period of time correction. 26,000 should hold as a medium-term, long-term support, and we will gradually move higher from here. Now, this is good news because if tech starts to perform, then it can take away some of the responsibility that Reliance and banks have. And I'm actually not very positive on banks because I think they're just going to stay in a range.
Gautam Shah there with his views on the markets, which continue to remain extremely choppy, but the broader markets are no short of action. REITs is now at the highest point of the day, 5.5% higher on that stock. What's also trading 5.5% higher is Zee Entertainment, continues to move higher from the lows that it saw, and after, of course, the FIFA deal announcement as well. 110 now on Z Entertainment, doing well. It was for the first time after December of 2025 that it managed to close above the mark of 100, and now it's building on to those gains. The Adani Group stocks as well, Adani Green Energy, Adani Energy Solutions, all of them doing well today, gains of around 4%. Grow is back near the mark of 200. And inclusion in the Jefferies model portfolio this morning. So good going for Grow as well. So some stocks that are doing well. Wockhardt, of course, continues to remain near the day's low, 7% lower on that stock. And some profit booking also seen in Tejas Networks and in names like Hindalco and SAIL. So metal stocks continue to see some bit of profit booking even as the index continues to remain choppy. Take your leave on this edition of Trading Hour from Sonal Ekta and me. Thank you for watching. Halftime report takes the action forward, but before that, the Governor's address.
and welcome to the special coverage of the RBI monetary policy. For those of you just tuning in, the Reserve Bank of India has left the repo rate unchanged at 5.25% and kept the stance at neutral. But the big announcement came in the form of measures to support the rupee and draw in more dollars into the country. There's a whole bunch of them we've been talking about here. As far as the macro forecast is concerned, expectedly, the inflation forecast has been raised to about 5.1%. It was 4.6% earlier. And the growth forecast has been lowered on account of the stress that's starting to flow in because of the West Asia crisis. The GDP forecast for FY27 is now at 6.6%. Earlier, it was 6.9%. We have the top brass at the Reserve Bank of India that will be speaking shortly to address all questions surrounding the policy coverage. We'll be hearing from them very soon, so we'll be cutting across to it now.
I wanted to know if you can give us some more details on the ECB and FCNR scheme, especially FCNR. Last time it was excused from CRR and SLR. And banks were allowed to give loans and, get their customers to raise FCNR. So it was not just their money, even leveraged was allowed. Can you just elaborate, because that will give an idea of how much they can expect and
the details.
And anyway, what is an idea of the flows? Sorry, what kind of flows? Sorry, it's a sales call. What kind of flows are you all expecting with everything, ECB, FCNR, and the other steps that you'll have announced, NRI, etc.? Thank you, sir.
Shortly, we are still, working out. In terms of CRR and SLR, that dispensation will certainly be given. Other than that, I don't think there is any change, in the regulatory dispensation. So that whatever is, whatever is the existing dispensation, regulation with regard to that, there is no special dispensation for that. In terms of the quantum, we are hopeful of reasonable and good. We are not targeting any particular amount, but we do expect healthy flows, both from ECB and other various measures have been announced today. So as a result of all these measures, we expect healthy flows, not only in this period of 3 to 4 months that we have given short window for ECBs and FC and RB deposits, but there have been other measures for equity as well as government bonds. So all put together, we are quite, and there were other measures, which were taken even earlier, whether it is in terms of the ECB, liberalized ECB scheme that we brought in, and the measures that I mentioned in my monetary policy statement with regard to government initiatives in terms of the trade agreements, etc. All those put together, we are quite confident of very healthy, a much better BOP this year as compared to what it would have been otherwise.
Thank you, sir. We'll take some more questions from our left side before we come to the right side. I now request Manojit Saha from Business Standard to ask his question. Manojit, please.
Thank you, sir. Now, can we assume that for the time being, since you have not mentioned that when the RBI expects inflation to come back to 4%, can we expect that RBI now put that 4% target in abeyance for the time being and more focused on the range like we did in COVID times? Because from the speech, I think it's evident that you're more concerned with growth rather than inflation. So is the 4% target is kept in abeyance for the time being?
No, the target is not in abeyance at all. It's a target which is sacrosanct for us. It's a target which the government has given to us. It was reviewed. It remains 4%. And that is what our endeavor is. But keep in mind that this target, it is to be met, over a period. It's a medium-term kind of a target. And it is not advisable to take action for each and every small or large, especially small, deviations from the target, because that can have consequences which can be disproportionate for growth. So our target remains the same. It is 4%. It is to be met over a period of time. And as mentioned, we will be data dependent. We have to watch and see as to whether this shock supply, because it's a supply shock, whether its effect is going to persist or whether it is going to wane away. So we are watching for that. And I think the details are already there, in my monetary policy statement. We'll be very watchful if inflation is getting generalized, building into expectations, and accordingly, take action.
The concern is the real rate is now very, very small or even negative. So,
see, as I mentioned to you, we have to look at it over a little longer period. It's not possible, nor is it desirable. It's neither possible, nor is it advisable to have it pegged, in a very small range. And that's why we have this range. The range of 2 to 6% is primarily for this purpose, that while the endeavor, the focus, the target is 4%, but there can be fluctuations around that. And we don't, if they are really fluctuations, then, we don't, and it's the effect and the inflation is coming down on its own, then we don't apply, monetary policy tools, which will have other adverse consequences.
Thank you.
I will, in interest of everyone's time, let's restrict ourselves to one question at a time. And then if there is time and the question has not been asked by anyone else, then we come back. Okay?
Thank you, sir. I now request Anup Roy from Bloomberg to ask his question. Anup, please.
Thank you, sir. Sir, in a recent interview, you have said that rupee is undervalued. So what is, as per your estimate, the fair value?
Which interview are you talking about?
In Mint interview, you have said rupee is perhaps undervalued. So
I have never said that rupee is undervalued. I think what you are referring to is the fact that I mentioned that, it may be, I think if I recall correctly, I said something to the effect that it is reasonable to think that it may not be, overvalued. And some people, of course, do say that it is, when they look at REIT, etc., then they do say that it is undervalued. So this is what I said. I never said that it is undervalued, but by some accounts, yes, it is undervalued.
So what could be the fair value if you have done any?
See, we don't have, as mentioned, our policy has been consistent. This question keeps coming up again and again, and we keep giving out the same answer. I don't have anything more to add than what I said in my monetary policy statement.
Thank you, sir.
Thank you, sir. I now request Hamsini Karthik from Money Control to ask her question. Hamsini, please.
Thank you, Pritha. Thank you. Good afternoon to everyone. My question is on deposit and lending rates. Earlier in your policies, you've said that at RBI, you would endeavor to maintain rates at a certain level, which would be slightly low. You're not in a rush to increase rates. Would you continue to maintain that stand even today, given where geopolitical situations are and what other economies are doing with the monetary policy tools? And as an allied, I would also want to draw your attention to deposit rates. In your speech, you mentioned that there is a certain amount of hardening of lending and deposit rates as well. We recently had a very large private sector bank say that they had to resort to very competitive structuring of deposits to ensure that they're able to combat this excessive competition for deposit. Is that a practice at RBI that you would allow, that you're okay with? And given that deposit rates have continued to be very elevated, I mean, it has been a pressure to mobilize deposits. I think we're in the third year of that. Where do you see some sort of a relief coming for banks?
Well, see, as far as deposit rates are concerned, there is no regulation on that. So I'm not understanding as to the intent of your question.
I'd primarily like to understand, sir, is there a room based on the macro environment today where do you foresee low interest rates continuing to prevail in the country for a while? And what would be the allied impact of that on deposits?
Yeah, so see, that's futuristic. we will be data dependent, and we'll see, how the growth inflation dynamics plays out, as I've already mentioned. I think on rates, policy rates going forward, I'll not be able to, give you more guidance than what was given in the statement and what, I mentioned when I answered one of the previous questions.
Regarding competition for deposits, or any view that you have?
Is competition, as far as, competition is healthy. Competition is good, as long as, it is transparent, as long as, it is fair, competition is good. And that should continue.
Okay.
Thank you, sir. I now request Ekta Suri from Z Business to ask a question. Ekta, please.
गुड आफ्टरनून सर, बहुत संक्षेप में सवाल पूछूंगी ताकि छोटे आंसर्स में ही कम समय हो जाए ज़्यादा चीज़ें. सर, ये पूछना चाहूंगी कि एनआरआई डिपॉजिट्स को लेकर आरबीआई का कोई टारगेट है, और यहाँ पर हम क्योंकि बात कर रहे हैं कि हमारा फॉरेक्स रिजर्व रहे, तो मोदी जी ने भी अपील की थी कि सोना जो है लोग कम खरीदे. क्या आरबीआई गोल्ड मॉनेटाइजेशन स्कीम को और ल्यूक्रेटिव बनाने के बारे में सोच रहा है? एंड जस्ट इफ टाइम अलाउज, वन मोर क्रिस्प
आपने
क्वेश्चन.
दो क्वेश्चन पूछ लिए. तीसरा अगर समय रहा तो पूछिएगा. तो पहले मैंने कहा कि कोई हमारा इसके लिए लक्ष्य हमने कोई निर्धारित नहीं किया है, लेकिन हमें आशा है कि काफ़ी स्वस्थ और अधिक मात्रा में हमारे को फ्लोज इसमें जो विभिन्न हमने जो मेजर्स जो हमने आज अनाउंस किए हैं उसकी वजह से आने चाहिए. दूसरा, आपका जो गोल्ड मॉनेटाइजेशन के बारे में अभी कोई प्रस्ताव जो है उसके बारे में विचाराधीन नहीं है.
थैंक यू सर.
धन्यवाद सर. I now request Anurag Shah from ET Now Swadesh to ask his question. Anurag, please.
Thank you, sir. Thank you, sir. सर, आम लोगों से जुड़ा हुआ एक सवाल समझना चाहूंगा सर, क्योंकि सर लोगों का आरबीआई पे भरोसा है और आप सही आंकलन कर सकते हैं. तो मौजूदा आर्थिक स्थिति को आरबीआई किस तरह से देखता है, कितनी चुनौतीपूर्ण है, और आरबीआई के लिए सर अब चिंता आगे चल के क्या रहेगी, ग्रोथ की रहेगी या महंगाई की रहेगी? क्योंकि सर ग्रोथ के आंकलन में आपने आज कहा कि बर्डन शेयरिंग जो होगी आगे चल के वो भी काफी महत्वपूर्ण होगी, वो भी ग्रोथ को तय करेगी. तो सर उसे कैसे देखते हैं? और सर आजकल भारत के अंदर काफी चर्चा चल रही है डॉलर के मुकाबले रुपए के स्तर को लेके. बुद्धिजीवी लोग, अर्थशास्त्री लोग, हर कोई अपनी राय दे रहा है. तो सर आरबीआई उसको कैसे देख रहा है? क्या ये एक बस प्रक्रिया का हिस्सा है? अगर निकट भविष्य में वो 3 डिजिट का आंकड़ा भी होता है तो दैट्स जस्ट अ नंबर, नथिंग मोर.
नहीं, देखिए, जो हमारी आर्थिक स्थिति है, जैसा कि हमने अपने वक्तव्य में भी कहा है, तो वो काफ़ी सुदृढ़ है, बहुत सक्षम है, स्वस्थ है. ये जो एक ग्लोबल शॉक है वो उसमें भारत अकेला नहीं है. सभी देश जो है इससे इम्पैक्टेड हैं. जहाँ तक भारत की स्थिति है, हम तुलनात्मक दृष्टि से हम लोग न केवल अन्य देशों से तुलना की जाए, बल्कि पूर्व के इस प्रकार के जो शॉक्स हमारे सामने आए हैं, दोनों दृष्टि से हम लोग आज काफ़ी बेहतर स्थिति में हैं. चाहे वो आर्थिक हमारी वृद्धि हो 6.5% से ऊपर, वो बहुत कम देशों की है, किसी की भी नहीं है. जो मेजर जो देश हैं, बड़े देश हैं, किसी के भी नहीं है. और जहाँ तक मुद्रास्फीति की आपने बात करी, तो मुद्रास्फीति निश्चित रूप से जो है इससे बढ़ेगी, क्योंकि अगर ऑयल के प्राइसेस बढ़े हैं तो वो सब जगह पे बढ़ रहे हैं. लेकिन यही उम्मीद कर सकते हैं कि ये ज़्यादा लंबे समय तक नहीं रहे. काफ़ी अनिश्चितता है, तो उसके बाद में हमारे को मालूम चलेगा. लेकिन जो हमारी अर्थव्यवस्था की स्थिति है वो काफ़ी सुदृढ़ है, वृद्धि अच्छी है, हमारे बैंक्स वो सक्षम है, सुदृढ़ है, हमारा जो कॉरपोरेट जगत है उसके पास में भी उनकी जो बैलेंस शीट्स हैं वो भी बहुत स्वस्थ हैं. बाहरी जो स्थिति है, आपने रुपए के बारे में बात की, तो वो भी हमारे जो फॉरेक्स रिजर्व्स हैं वो हमारे पास में पर्याप्त मात्रा में है, और 11 माह का जो हमारा आयात, गुड्स का जो आयात है उसको कवर करने के लिए पर्याप्त है। कुल मिलाकर के हम काफ़ी बहुत अच्छी स्थिति में हैं, और हम काफ़ी विश्वस्त हैं कि इस स्थिति से हम लोग अच्छी तरह से हम न केवल निपटेंगे, बल्कि इस स्थिति को एक अपने लिए एक अपॉर्चुनिटी मानते हुए और अधिक हम अपने आप को सक्षम और सुदृढ़ बनाएंगे, ताकि इस प्रकार की जो क्राइसिस या शॉक्स आते हैं उनको हम बेहतर और अधिक बेहतर तरीके से निपट सकें।
धन्यवाद सर. Sir, we'll now take a few questions from the right.
Yes.
I'll request Sangeeta Mehta from Economic Times to ask a question. Sangeeta, please.
Thank you. Sir, given that influx of inflows that might happen because of the measures announced, what kind of system level liquidity you think would be appropriate in the current scenario? And do you expect banks to pass on the benefits of hedging costs to the customers respective?
Yes, I do expect them to pass on some of the benefits of hedging, and that will result in good flows. Liquidity, as I've mentioned, we will provide the appropriate amount of liquidity so that credit in the system, not only bank credit but other bonds, etc., also can be provided to meet the needs of the economy. There's no level that we generally target. You have seen we gave about 2.6 lakh crore of liquidity in the last 2 months since we have met, and we'll continue to provide appropriate liquidity as is needed.
Thank you, sir. I'll now request Jaspreet Kalra from Thomson Reuters to ask his question. Jaspreet, please.
Thank you, sir. So you've announced measures aimed at garnering capital inflows today, via FCNR, ECB, etc. Are you also considering measures to slow down outflows, perhaps through restrictions on liberalized remittance schemes, overseas debt investments? Is that something under consideration? And because some of my peers took the liberty, I hope you'll allow me. You speak a lot about inflation expectations. In the recent data that we've seen in RBI surveys, they've started to drift up. How do you sort of closely track that? Are there supplementary tools that you're looking to maybe measure inflation expectations in more real time to be able to stay ahead of that curve? Thank you.
See, as and when, first of all, there is no, such measure right now under consideration to restrict any kind of, capital flows, outflows. On your second question, which is related to inflation expectations, we do our household surveys, so that is the primary source, through which we get the data. And other than inflation expectations, the prices, when they are passed on, that can also have some element of expectations built into it, apart from, the service that we do. So we monitor those very closely, and we'll continue to do that and take
from
action.
the companies to the consumers. Thank you.
Thank you, sir. I'll now request Piyush Shukla from NDTV Profit to ask his question. Piyush, please.
Yeah, good afternoon, Governor, DGs. Thanks, Blitzer. Sir, we understand the updated list of NBFCs is yet to come out. You have issued categorization draft circular. There are views on, floating around on one CIC which has applied for deregistration as well. When can we expect the upper, the next upper layer list to come out? And if you could allow me to ask, because this is the largest private bank of country, we have seen a lot of developments happening with regard to how its governance is being played out. Is the regulator concerned in any manner on this particular aspect? Thank you.
See, we don't, you are aware, we don't, answer any entity or bank-specific questions. we are more, we are looking at, system level things. So that's, on your second part of the question. Your first part
updated layer of.
See, the list is there already, right? So it continues till the time, we have a new list.
When will we have it? It was supposed, it gets updated on a yearly basis. That's why I'm asking.
So we'll do it shortly.
Thank you, sir. I'll now request Ankur Mishra from ET Now to ask his question. Ankur, please.
Thank you, Brice, sir, for the opportunity. Good afternoon, Governor. You mentioned during the monetary policy statement that the crude oil prices has been more than the assumptions which were there in the last monetary policy. I want to understand what is the assumption now. Apart from that, you also mentioned about the exchange rate policy, where you are saying about speculative pressures and how Reserve Bank of India responds to that. In the past, you have taken few measures regarding the same. Are there more measures which are expected from Reserve Bank of India?
No, there are no specific measures, but as I have mentioned, in case they are required, especially to curb speculative kind of a behavior, then we will take them in case they are required. Assumption for crude is $95 to a barrel, so it's changed, from our previous ones and previous assumption, and that is one of the reasons, why inflation is higher. Projected inflation is higher.
Thank you, sir. I now request Shayan Ghosh from Mint to ask his question. Shayan, please.
Governor, on the issue of deposits, generally, I mean, what has happened with the bank, they also justified it as an industry practice. My question is, as an industry,
practice?
The practice of giving differential interest rates and masking it, probably.
No, our policy, I mean, we do allow differential interest rates.
Right.
So sorry, please complete your question.
On a systemic level, I was asking, because they justified it saying that it's an industry practice. Is RBI okay with an industry practice like that? Where you give differential interest rate but route it through something else?
I think you are referring to some individual specific instance, bank, which we don't comment on. However, as I have mentioned, I think perhaps now the earlier question, I think they are too connected, that they are connected. So, we have a very consistent and a very clear policy for deposits as to when they can have differential rates. I think for certain categories of people like, senior citizens, depending on tenor, and things like that, you can have differential rates. I'll ask one of my colleagues, to tell you on what basis you can have differential rates. But they have to be transparent at the same time. You have to display them to everyone clearly. And any differential rate beyond that is certainly, if someone is giving, is certainly not acceptable.
Thank you, sir.
Thank you.
I'll now request K. Ramkumar from Hindu Business Line to ask his question. Ramkumar, please.
Why is this concessional swap facility for raising ECBs restricted only to public sector undertakings? Why not extend it to even the private sector, actually? Yeah.
See, the public sector the public sector entities are a special category, and they are more, in areas where we feel the needs where the needs, of the economy are more. And the benefits are also, passed on to the general public because they are catering more, to public utilities, infrastructure. So the benefits go to a much larger section of society when we give it to the public sector undertaking. If you give it to private, then the benefits are not as widely dispersed as they are when we give such kind of a benefit to the PSUs.
Thank you, sir. I now request Mayur Shetty from Times of India to ask his question. Mayur, please.
Thank you, sir. Governor, you announced a whole lot of measures to attract
fixed income inflows. Do you see a role for interest rates here? In the past, whenever such measures were taken, there were higher rates offered to attract capital. Or do you expect banks to offer better returns under these schemes?
Yes, obviously. Because I think one of you asked, this will enable banks to increase the deposit rates for the non-resident and the OCI depositors.
This is despite the reduced interest rate differential between India and...
Yes.
Thank you, sir. We now take the remaining questions from the left side. I'll request Falakna Syed from Deccan Chronicle to ask a question. Falakna, please.
Good afternoon, Governor. Thank you for the opportunity. Sir, there's a 50 basis points upward revision in baseline CPI inflation forecast with upside risk. So this strengthens the case for a rate hike in the next meeting. And also, if you look at the bond market, they are factoring 3 rate hikes. The yields are now around 7%, 10-year benchmark yields.
So what's your question?
So the question is that it's strengthening the 50 basis revision in with upside risk in CPI. It's strengthening a case for a rate hike in the next meeting.
In the next meeting or later, whether it strengthens the case or not, I don't know. But obviously, I mean, it's adverse. It's more adverse, than it was previously. Certainly, yes. Whether it strengthens the case will depend on many other things, as already mentioned. We'll have to see whether it is actually getting generalized. It's not, as I mentioned, again and again, it's not, just one. If it is a one-time increase, then, you look through. But if it is getting generalized, it is getting persistent, it is getting into expectations, then is the time, to act. So for that, we have to wait and we have to watch.
Thank you, sir. I now request Krishna Kaushik from Financial Times to ask his question. Krishna, please.
Hi, good afternoon, sir. So I wanted to understand, you mentioned that, there's a good environment for private capital investments to grow. But have you seen private capital expenditure growing? Because there has been a bit of a frustration on the government side on that as well. The private entities are not investing enough. Along with that, why do FDI inflows remain negative? You mentioned that in the first 3 months or the first 2 months till now, basically, it's been about $14 billion that has outflown. So why are these two things? Can you just comment on that, sir?
See, investments are healthy. If you look at data, the data, for the second advanced estimates for last year, and even if you look at some of the high-frequency indicators in terms of capital goods, imports, production, H1 numbers of fixed asset growth, H1 was very good. It was in 2 digits. H2 has moderated, but still it's high single digits. So if you look at all these indicators, it's decent. Of course, there is always scope for more. Inflows also have been, FDI, I think we gave you the numbers. It's continuing, gross FDI has been. But would you like to add on the remittances and, on the inflows as to how, the situation looks like?
So I can add to the overall situation of capital flows, as well as capital investment in the country. As Sir said, private capital formation numbers actually have been very healthy. Investment to GDP ratio has been turning upwards. So those numbers remain healthy. More can certainly happen. If we look at the BOP side, gross FDI flows were $95 billion in 25-26. Can be much more this year, for all we know. Certainly top 100 billion, can go up to, 110, 120, if not more. And it's a secular increase, which means it's not a story that we can pin down to only 1 year. There are years coming which will see even healthier inflows of gross FDI. And with the measures that have been announced, we are looking at and projecting a very healthy BOP going forward.
The net still remains negative, right? FDI.
So we do not have projections for this year, and that remains to be seen on how things pan out. Net FDI is also a combination of, globally how things are. And those are, things that get settled over a period of time. But one can talk more confidently today about the gross FDI numbers, which are looking very healthy.
Net FDI was also positive. It was not negative, 6.7 or so last year. And April numbers, gross FDI is 15 billion and net is also about 7 or 8 billion, if I remember correctly. That's also positive. So 15 billion in 1 month is a very high number. We don't have the monthly figures. A lot of it was to do with the financial sector. So we are confident, as DG also mentioned.
Thank you, sir, and thank you, madam. I now request Lalatendu Mishra from the Hindu to ask his question. Lalatendu, please.
Good afternoon, Governor. Last month, the Prime Minister urged the people of India to do a lot of things, like not to go on foreign travel. He said, postpone buying gold, then do work from home, also do carpooling and reduce fuel consumption. And now you told, to Anurag's question, things are better. Has the thing changed since then, and what could be the reason for him to tell all these things? Thank you, sir.
You have to ask him, and you have to ask yourself as to what the reason therefore is. I think it's important for us, all of us, to be, to be prudent, to be judicious, to not be wasteful. That's the message, I think, that he gave, and it should be taken in that spirit.
Thank you, sir. I now request Nachiket Kelkar from Business Today to ask his question. Nachiket, please.
Thank you, Governor. Seemingly there is enough cash in circulation, but we also keep hearing that ATMs are running short of cash, they are running dry. Is RBI looking at it? What are the issues there? Are you worried about it, or something needs to be done there?
No, see, we have a plan. Every year we build a plan of what the requirement of currency is, and that is provided to the banks as and when it is required. The ATM part I have not looked into, but certainly, we will, if there is a shortage, we will certainly, ensure that the shortage is met with. We have sufficient currency to provide and fill and refill the ATMs and the bank branches.
Thank you, sir. I now request Manish Suvarna from PTI to ask his question. Manish,
thank
please.
you, sir. Good afternoon, sir. So you mentioned that you are expecting good amount of flows because of the measures you have announced today. So how much incremental flows can we expect? And secondly, so I just want to understand, you explicitly flagged implication for the rural demand from projected monsoon deficiency. So do you see a risk of weaker rural consumption spilling over to the private consumption growth?
Number I already mentioned, we don't have a specific number, but obviously it's all put together, it will be very healthy. Answer to your second question, rural demand, well, yes. Private consumption, well, yes. Some impact will be there.
Thank you, sir. I now request Akash Mandal from Indian Express to ask his question. Akash, please.
Good afternoon, Governor, Deputy Governors. The RBI has intervened heavily in the forwards market in the past year or so, with the RBI also bearing the full hedging cost of the new 3 to 5 year FCNRB deposits, in addition to the concessional forex swap window for the ECBs of PSUs. Does the RBI expect some forex pressure going ahead, and how does the central bank expect to mitigate or manage this risk in the going forward?
No, we don't expect, but we are always prepared. As mentioned, we have sufficient reserves, and we have the buffers And we will do, whatever is required in order to ensure that we have good flows and we are able to maintain an orderly movement of the rupee.
All right, so that's the top brass of the Reserve Bank of India addressing the media after announcing that policy rates unchanged at 5.25, but the focus very much has been on the measures supporting, more foreign inflows into India, not pressuring the rupee. I think some of the additional takeaways from the press conference, one, of course, is while the governor did not give out any specific quantum of foreign inflows that he expects to come into the country on account of these measures that have been announced, he did say the inflows are expected to be healthy, they're expected to be decent, and overall the balance of payment situation may be much better than was previously estimated. We also heard from Deputy Governor Poonam Gupta saying that the gross FDI inflows into India this year could be upwards of $100 billion, could go up all the way to $120 billion or so. Gross FDI numbers looking pretty healthy. On one of the specific companies, the Tata Sons listing issue, which has been the talk for a while. The governor did not comment on any specific entity, but he did reiterate that the upper layer NBFC list, which was last released more than a year back, will be updated shortly. So that will probably decide the fate of the Tata Sons listing. But yes, let's get back to more on the policy. We have Soumya Kanti Ghosh, Group Chief Economic Advisor at State Bank of India, joining us. We also have Neeraj Gambhir from Axis Bank and Lalit Tyagi, Executive Director at Bank of Baroda, with us. Gentlemen, thanks very much for your time here. Mr. Soumya Kanti Ghosh, let me just start with you on what you made of some of these rupee-related measures. If you've done any calculations so far since the announcement has come in, what kind of additional inflows are we going to see as a result of this? Any, back-of-the-envelope estimates?
Yeah, thank you, Ritu. I think how much of the inflows will come, that's $1 million question to speculate on. But I'll just give you some pointers in this context, some of the numbers. I think the first thing is on the debt utilization limit. If you look into the number in the general category, the total limits available for investment is around 4 trillion. That is the first point. And in the second point, if you look into the FAR limit, only 6.8% have been utilized and total outstanding is around 48 trillion. So this amount could actually be significantly upwards, but it's very difficult to make an estimate when the utilization and the outstanding amount are so much different. So, but anyway, this is going to have a positive impact on the yields. You already see that they have declined to 6.95%. Now, on the other question on FCNRB and ECB, I think on the FCNRB, what will be important is the costing structure. As I understand today, if we just make some ballpark estimates, for example, the US yield today is at 4.4%. So to make the funds attractive, any rates may have to be in upwards of 5%. Even if you assume say 5 to 5.5%, you add on that hedging cost, which the central bank will bear. So basically, the total cost has to be significantly attractive. And on the over and above that, the hedging cost currently, if you look at the forward premium, that is around 3%. So even if I assume that the RBI takes the hedging cost around 3%, it will be, and the total cost will be linked to the overall amount of mobilization. But the important point which I want to highlight is that even if say the inflow is around 10 billion, 20 billion, 30 billion, whatever, that will reflect in a corresponding increase in the deposits. Because this year, as per the inflation and the growth projections, the nominal GDP growth rate could be around 13%, 12 to 13%. That means that the credit growth will continue to be stronger, around 16 to 17%. For that to be funded, the banks are actually facing a shortage of deposits. So whatever amount comes into the system, maybe even say 1.5 trillion, 2 trillion, that will help the banks to mitigate this credit deposit gap. And I think that will be positive for the banking system as a whole. So overall, while the fund inflow is difficult to guess, it could be a healthy one, as Governor has emphasized. But at the end of the day, that will translate into corresponding increase in deposits, which will be easier for the banks to fund the credit. And this will also bring down the entire term structure of interest rate, because today there is a significant pressure on deposit mobilization as the banks have to borrow from the market in terms of the CDs, in terms of the capital raising. So I think all this will also have a soothing impact. So overall, the impact on the costing structure will be positive for the banking system.
Okay, we also have Pranjal Bhandari, Chief India Economist at HSBC, who has joined us now. Pranjal, welcome as well. Neeraj Gambhir, coming to you very quickly on what you thought, were some of the most important measures as far as attracting foreign inflows are concerned. The ECB route, including the fully accessible route to cover, longer tenor securities, etc. What, to your mind, will move the needle most? And if you have any estimate of what kind of inflows this could bring in?
So all of these are important measures and useful measures. I'm not sure in the short run whether the FPI tax concession will have an immediate impact, because the FPI flows are not just dependent upon the tax rate or tax impact, but also the market's view on where the bond yields are headed and attractiveness of India's bond market relative to the rest of the world, particularly developed markets like US. But the other measures such as benefit on ECB hedging, the concession given, complete concession on the hedging cost for FCNRB deposits, these are two very, very significant measures, and I think they will have a material impact in terms of flows. I'm not able to take a call on the amount at this point in time, because on both of these measures, we don't have the specifics. We don't have the details in terms of what is the concession being offered on ECBs and what is the total package on FCNRB in terms of regulatory impact. For example, the governor mentioned in his post-policy conference that the CRR SLR benefit will also be given. Last time around, this borrowing was also exempted from PSL, and the banks were also permitted to give leverage to their customers to place FCNRB deposits. So I need to see the full package and how does it compare with what happened last time to be able to make an assessment. But going by governor's comments, suffice it to say that there will be a material impact as far as flows is concerned. I think the Reserve Bank is expecting a material impact as far as flows is concerned. And that should have some kind of a calming effect on the currency market.
Okay, let me ask the banker then. Mr. Lalit Tyagi, thanks very much for being here. RBI said it is going to bear the full cost of this 3 to 5 year FCNRB deposit, the hedging cost of it, that is. How much additional money do you think banks could raise, realistically through this window, if you have any sense on any kind of estimates you could give us?
Yeah, thank you, Ritu, for having me on this panel. I echo the views expressed by Mr. Ghosh and Mr. Neeraj. Actually, it will be difficult for all of us to quantify the quantum of inflow. All I can say that FCNRB deposits comprises of roughly 20% of the total NRI deposits with the banking system in India. And with this kind of window available where the swap cost will be borne by a regulator, banks will have an incentive to offer attractive rate in the 3 to 5 year window, 3 to 5 year tenor. And we are mindful of the fact that current FCNRB deposits are largely concentrated into the window of 1 to 2 years. So this way, by offering attractive rates in the longer tenor window, we will be able to ideally mobilize fresh deposits from such NRIs who are unwilling to put the money in the long-term bucket. So that will be one take. The another thing is that last time when such a scheme was launched, $28 billion were mobilized. So if we take that as one data point, so this time looking to a gap of the NRI flows and the volume they have, the opportunity is significant.
$28 billion last time. Let's see if we can do more. But Mr. Tyagi, just to confirm that banks would be able to fully pass on this benefit to customers?
Definitely, they will be offering better rates to the NRIs to attract the flows. How much quantum banks will be, passing it on, time will tell in terms of the demand and ask. But definitely, there will be a pass on.
Also the fact that RBI has made it now cheaper or more attractive for large public sector enterprises to borrow overseas. For public sector banks like you, these are also big borrowers for you. Do you think that in some way negatively affects banks here like you?
No, in fact, we are participating in their ECB funding as well. Yeah. And we have a significant amount of ECB book. Bank of Baroda types of bank have overseas presence also. So we see opportunity in that in case, such PSUs are aggressive in raising the ECBs. So we will be participating in that, and we do not see it as an impact on our overall loan book growth.
Hey, Pranjul, thanks very much for waiting by patiently. The inflation forecast, as expected, I think the MPR gave us a clue that if crude from 85, the assumption goes to 95, we're looking at inflation of over 5%, and now it has come to 5.1. What do you read into? How do you read into that? Into how long you think the pause could last, and how quickly the hikes could come after this?
Yeah, thank you very much. I think today's policy was quite strategic. People were looking for two things: what they do on the FX package and what happens on interest rates. And I think the RBI did not want to muddle the two. One of the reasons they didn't move on rates, despite increasing their inflation forecast, is because they didn't want to give the impression that they are hiking rates for FX. They wanted FX measures to take care of the FX problem, not interest rates. So therefore, I think they've in a way downplayed inflation to some extent, and they are just waiting it out. But because they have increased their inflation forecast, and I think the increase is meaningful, my sense is rate hike is coming. We were earlier expecting a rate hike, in October and then another one in December, but it could now be August and October. Overall, we are expecting 2 rate hikes. But I think it is strategic this time, that they focused more on FX and not that much on inflation, because they didn't want markets to confuse the two. And that's why they're watching out on rates, although they went all out, with their FX measures.
But repeatedly, Pranjal, the governor highlighted the fact that there is risks from El Nino, from the deficient southwest monsoons, etc. Do you expect a further, sort of revision to these macro numbers from here on? Do you think they're conservative at this point?
Well, there's just so much uncertainty. Like, for example, when will the El Nino actually set in? We don't know. Will it be June, July, August, September? Nobody really knows. So I think from on the back of that, they've just given placeholder forecasts for now. And over the next couple of months, they will fine tune, these forecasts. Our own forecasts are a lot more graver. Our sense is inflation, they have it at 5.1% for this year. We have it at 5.6%. And from September onwards, more than 6% for 2 to 3 quarters in a row. And we have such high numbers because we are pricing in and penciling in the fact that an El Nino will set in about July or August. And my sense is that the revisions, if any, from here for the RBI will also be on the upside, and rate hikes can't be avoided in this cycle.
Okay, Mr. Soumyakanti Ghosh, I think the governor at some point said that the inflation could inch up, to the upper tolerance level by the 3rd quarter or so. Is that the period after which you expect the hike cycle to start at all, or are you expecting a pause through this calendar year at least?
Ritu, it's very difficult to say at this point of time. We will be completely data dependent, because while the inflation risk is properly appreciated, there is also the fact is that growth is going to be weak. And in fact, the central bank, I have never not seen the central bank revising the forecast so quickly for a calendar year in any of the earlier policies. 6.9% and 6.6% in just 2 months. So I think the risks are grave, and there could be some possibility downside to the growth estimates also. So from that perspective, I believe the central bank will have a wait and watch policy. My sense is that in the August policy or something, the RBI will see how is the El Nino playing out and then take a considerate call on the rate hike cycle. But my sense is that I think the last December rate hike, rate cut from 5.5 to 5.25% did not have any material impact. And if the RBI has to hike, I think any hike less than 25 basis points will not be appropriate, because to have a possible impact, the rate hike has to be of 25 basis points. But at the same point of time, the rate hike cycle, I believe, will be a shallow one if it happens. But as of now, we have kept our options open, and we'll look through the cycle and take a call as appropriate when the time comes.
Okay, a shallow rate hike cycle, perhaps at a later stage. Mr. Neeraj Gambhir, very quickly, your sense as well as to the next move. And, the bond yields, for instance, we've seen a 5 basis point softening or so now at about 6.95. Where do you see this settling in the near term? Because the larger concerns about, the supply in the market, that remains.
So bond market has to a large extent already moved and started to price in rate hikes, right? That's why, despite repo rate being at 5.25, the 10-year is at 6.95, went all the way up to 7.10. Similarly, you see in the money market, the CD rates are quite elevated. The OIS curve is pricing in a 100 basis point hike. My sense is that if we get onto a rate hiking cycle, which is probably what the next step is going to be, I don't see anything less than 100 basis points of hikes, to adjust for the fact that the core inflation has moved from roughly 3% to 4.7% as the governor has forecasted. And that is despite the fact that gold has stopped going up as much as it did last year. So it is a material change in the inflation numbers. It is a material change in the inflation forecast. So anything less than 100 basis points through the cycle is not going to be meaningful. I agree with the comment that there is a growth impact as well. So there will be a need to balance between both growth and inflation. But remember, MPC's mandate is now inflation, and they are an inflation targeting central bank. So I think inflation will have a bigger say in what they do.
Okay, Mr. Tyagi, with these relaxations for public sector enterprises, etc., to borrow overseas, with some support on the hedging cost, would you have a sense of what the pipeline could look like? Oil, power, all of these sector companies. Would you have a sense of what the borrowing requirement could be, how much this could boost credit and thereby, of course, inflows as well?
So I think the PSU's share in the overall ECBs hover around 35 to 40% of the outstanding stock.
Okay.
And I think with this kind of dispensation available to them, they will be more incentivized to go for ECBs a little bit more aggressively during this available window. And time is more opportune, I believe, because the oil prices are high and oil companies will tend to utilize this window to cover their borrowings quickly. So the second important thing is that their borrowing decisions are also influenced by the dollar rates. We have to see and wait what the rate action or the decision of the US Fed is about the interest rates. If that remains steady, then probably it will make more sense for them to mop up the ECBs during this window.
Okay. There is no, pipeline per se already that you'd have visibility on, Mr. Tyagi?
Normally, they borrow good amount. I cannot quantify right now, but all the leading oil companies, power companies, infra players, they raise a good amount of ECBs every year.
Okay. Mr. Soumyakant Ghosh, would you have any sense from SBI point of view as well, the sectors that benefit?
No, I think overall it's a positive one, and most of the sectors which are facing pressures, I think they will benefit from this move. But as I said to in the beginning, Ritu, the credit demand continues to be positive. And within 12 to 13% nominal GDP growth rate, the credit growth could be in upwards of around 15 to 16% at least. So from that perspective, I think these measures which have been taken will be positive for the market. But the sectors, if you ask me which of the sectors will benefit, I think there are sectors. The ECLGS scheme has already attracted quite a sufficient demand from the MSME units. I think we'll know the total number very soon at the end of June. But the other sectors which we had mentioned at the beginning are also likely to, cushioned a little bit because of the appreciation in the value of the rupee. Because please note that the entire narrative on this capital inflows into India depends on how the rupee stabilizes. So once the rupee stabilizes at a lower levels or at levels which the foreign investors believe is going to be a stable one, I think capital inflows will again revive into India, and that is going to drive the next set of measures.
Okay. Mr. Neeraj Kampir, the governor said pretty much in so many words that they're prepared to do whatever it takes. When asked about the rupee and an orderly market condition, beyond, of course, a whole lot of measures have now been announced, but do you expect continued intervention in the market? The rupee remains above 95.30 odd levels. Do you expect to see heavy intervention like we've seen in the last 2 weeks and the last couple of months?
So while the measures have been announced, it will take a bit of a time for people to work out exact strategies in terms of raising the funding. Going to the market and raising the funding can also take 1 or 2 months. That's why this has been a 4-month window that has been given. Once the flows start coming in, maybe the need for RBI to intervene will go down, but I don't expect Reserve Bank to completely withdraw from the market. I think there is every reason for them to make sure that the specific thing that the governor pointed out, that it doesn't become a speculative, self-fulfilling sort of currency depreciation. So yes, Reserve Bank is expected to be in the market, but the quantum and the amount that they need to intervene with can probably go down as the flows start coming in.
I see. Pranjal, at $95 a barrel, which is the now revised assumption for oil prices versus 85 earlier, How does the macro math change in the assumptions that you've made?
Yeah, look, my sense is that RBI is working on the right direction. It's raised its inflation forecast compared to the previous policy meeting. It's lowered its growth forecast, but there is more to come. And my big thing here is the El Nino. I think we are underestimating the risks of an El Nino. You know, earlier El Ninos used to be a little moderate. They used to only impact fruit and vegetable crop. And RBI used to always say, we'll look through it because the next crop will come in 2 months' time. But now El Ninos have breached previous temperature thresholds, and they are impacting hardy crops like rice, wheat, pulse, edible oil, egg, meat, fish, all of these things which take, sometimes 6 months to 1 year to come back. So the inflation impact of all of this can be, quite a lot. And I think all of that is not fully priced in the RBI's forecasts, at least the ones that were announced today. They are waiting to see, when the El Nino comes. And that's why they also said that there are upside risks to their inflation forecast at this point of time. So my general sense is eventually inflation will be much higher, growth will be much lower. RBI will start hiking rates possibly in the next policy meeting. But once it's done with 1 to 2 rate hikes, say 50 basis points, we will also start getting growth data, which will be much lower than forecasted. My sense is in the September quarter, growth could actually fall below 6% if an El Nino has set in by then. And that will again then tie RBI's hand. So there'll be a large growth shock and there'll be a large inflation shock. On the back of that, RBI will hike by about 50 basis points, but it will not be able to hike too aggressively.
Okay. Well, thanks a lot. Just finished the press conference and I have run down to the studio. And I want to ask the bankers this. Neeraj Gambhir, the governor, very clearly said that the money raised in FCNR will be excused from SLR and CRR as it was done in 2013. Banks will be allowed to offer leverage loans to the customers, and therefore the amount they can invest in FCNRB can be accordingly higher. Now that you have that clarity, even if the circular is not yet in, can you have an idea? I guess even private sector banks will be able to offer that kind of loans to their global NRI clients. What's the amount you're looking at?
I think, if I remember it correctly, the last time FCNRB scheme was approximately $30 billion put together across all the banks. The difference, given what you have mentioned, the difference from the previous scheme is that last time there was a hedging concession. This time it's complete hedging, which basically means that an FCNRB deposit actually becomes very attractive deposit from a bank's perspective, as the difference between an FCNR rate and rupee rate is effectively almost 200 basis points. So the banks can actually go up to that level in terms of attracting these deposits. And on a levered basis, this basically means that the return that the NRI investor gets can be fairly attractive. So I do expect more than $30 billion this time around, meaningfully more than $30 billion this time around. Again, we need to see the circular before I can say with any finality as to what number is a meaningful number here.
Okay. Similar question to you, Lalit. Have you all done the math? PSU banks can raise the ECBs. All banks can offer FCNRB. ECBs, you get concessional hedging, and FCNRB, you get full hedging. So is there some number you all are working with? I guess a bank like yours can do both, FCNRB and ECB.
So, the ECB, the benefit will be given to the corporates who are raising the ECB loans. So in that sense, the banks get what they were getting earlier. The only thing is that since ECB, since such PSUs are incentivized to raise fresh ECBs where they are not bearing the hedging cost, so they will hasten their ECB borrowings than the other kind of borrowings. As far as FCNRB deposits are concerned, banks are direct beneficiary because it adds to their deposits. And I do agree that in case what Governor has announced in this press conference, if the CRR, SLR benefits are also passed on, then it will further incentivize banks to offer the attractive rates. I believe PSU banks largely raise the FCNR deposits from the NRI customers directly as their direct deposit schemes. And probably leverage product, etc., are offered by some other kind of banks, I believe.
Yeah, foreign banks, I suppose.
Yeah.
Okay, so definitely, Neeraj, this means that for the banking sector, the cost of funds fall?
Yeah, I mean, I'm hoping that the net cost that we offer to the customers, adjusted for all the benefits, is lower than what we are paying for at the deposits at this point in time. So yes, on this marginal funding raised, the cost could be lower than what we have right now.
Okay. Soumya, any guesses on the rupee, therefore? Do you think at 96 we have seen the worst, given the expected flows?
Yeah, I think, Lata, I think 90, today, I think impact the rupee has appreciated around 40 basis points. And I think the impact on the rupee will be gradual, because in the coming weeks, as the markets see that the inflows are start coming in, the appreciation could be even more larger. So my sense is that the rupee actually, if everything plays out properly, the rupee actually could move to higher levels like 93, 94.
Okay. Pranjul, your number for the rupee?
Yeah, look, I think the currency will be, well supported right now on the back of these measures, on the back of the RBI intervention, that has been pretty strong for the last couple of days. And also one eye, on oil prices and what's happening on Hormuz. And if some good news comes from there, then I think the currency will be well supported. In fact, I think if we get some good news on the Hormuz, then we could see a 1 to 2% appreciation, from these levels. But we also have to understand that, once September is behind us, at some point, there is a large short book also, the forward book, which has to be paired up. FDI inflows, at least net FDI inflows, haven't yet started to rise in a major way. So there could be that usual decline, later on, post-September, which we see of about 3 to 3.5% every year.
Okay, I'm being forced to wind down this conversation. Can I have a monosyllabic answer from all the four of you? Are you expecting an August hike? Pranjul?
Yes. Two hikes starting August and October.
Yeah, I see.
Just please give me monosyllabic. Neeraj, are you expecting?
Highly likely. Highly likely we'll see.
Soumya? Okay. What about Soumya?
Yeah. Did you ask me? My line got disconnected.
Okay.
No hike in August.
So you are expecting a hike. August you're expecting?
No hike in August.
Okay. And Lalit?
We also feel that RBI would like to wait for the inflation and growth dynamics play out, and probably we feel that...
No in August. Okay, no in August. Sorry, Lalit, we're out of time. I'm taking liberties with time. You're and no. So it's an equally divided house in terms of yes and no. Ritu, that's the word that we are getting from our experts. Chances of a hike is 50% at least when it comes to August. Go ahead, Ritu.
Okay, thanks very much, Lata, for taking us through that. And on that note, we're going to thank all of our guests, Pranjul, Neeraj Gambhir, Soumya Kanti Ghosh, Mr. Lalit Tyagi, and of course, Lata, for joining in. All of you, thanks for your time and for helping us parse through this policy. That was the Reserve Bank of India, keeping rates steady at 5.25% and the stance unchanged at neutral, but announcing a whole bunch of measures to attract more foreign capital into India to stabilize the rupee. On that note, we'll take your leave, but stay with us. After this break, more news and updates continue right here.
All frontline indices fall into the red. Realty, healthcare and financial notch gains, while metals and energy drag.
RBI's Monetary Policy Committee keeps the benchmark interest rate unchanged and retains a neutral stance, but an upward revision in inflation and trimming of growth only paints a challenging picture with the high likelihood of rate hikes later in the year.
Rupee climbs after RBI steps in with measures like ECB issues by public sector entities, bearing hedging costs for FCNRB deposits, expanding the list of investable GSECs for FIIs, and cutting the time to realize export sales. The governor tells CNBC TV 18 that he is hopeful of reasonable and healthy dollar inflows, but is not targeting any particular number.
In a move to draw more foreign investor money into government securities, an ordinance has been passed to exempt withholding tax and capital gains tax on such investments. The move can also aid India's inclusion in global bond.
The government moves to operationalize its budget announcement of easing access to equity markets for persons resident outside India by doing away with SEBI registration process and raising the related investment limits. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan and with me is Harmaz Patakia. Good afternoon, Harmaz. You know, this story has been quite similar through the week, right? We saw the markets gain after the RBI policy and now it's back at the lows of the day.
It's been very topsy-turvy all through the day, right? You're not been able to sustain at the highs. And, well, there is some buying interest that keeps emerging at the lows. So, long story short, we haven't gone anywhere all through the day. And that's been the story. We opened gap up, yes, but then that gap could not sustain. And once the policy was announced and a lot of other measures were, we fell to that low of 23,331. Then there was this recovery again back towards that 23,500 mark. Again, that recovery could not sustain. And now again, we are back towards the lows of the day at 23,350. Of course, that 23,300 mark, the bulls would at least want to close above that level. That is something that they would want to defend. Even if we end lower, they not want to end below that 23,300 mark on a closing basis. That is something that the bulls would be eyeing. And of course, the fact that the heavyweight banks are still trying to pull their weight in, but all of that is getting offset by other names like Reliance, Tata Steel, Bharti Airtel. Metals is one pack that has been sulking. They were sulking yesterday, they are sulking today as well. But otherwise, the index has gone nowhere. The bulls at least would hope that 23,300 is saved by close.
Absolutely. And, you know, if you take a look at the sectors, right, it was that recovery we saw in the Nifty Bank that helped the markets move higher at one point. And, you know, PSU Bank Index is one of those top gaining indices today, apart from the media pack. So we've got Canara Bank, Indian Bank, PNB, all of them up 2% in trade, now about 1% higher in trade. We've got those realty stocks also doing well, Phoenix, Prestige, Lodha, all of them gaining nearly 2% in trade. Some of the financials that are doing well after the policy announcement, HDFC Life, Shriram Finance and Bajaj Finance, all of them also in the red. But on the downside, as Harmaz pointed out, it is those metal names that's the top losing index. We've got Hindalco, Tata Steel, Vedanta, all of them falling between 2 and 5%. Other names like Nalco also falling in trade today. So that's how the markets are shaping up.
Well, in a move to draw more foreign investor money into government securities, the government and the RBI have taken measures to make returns on government securities tax-free for foreign investors. Now, these measures, announced as part of an Income Tax Act amendment, exempt FIIs from capital gains tax on investments in GSECs. This will be effective retrospectively from the 1st of April. Now, the new norms also exempt FIIs from tax on interest income and capital gains from such securities. Now, the government has also exempted the Bank of International Settlements from taxes on government securities and the capital gains. Now, the 20% withholding tax on Indian securities has also been removed. Now, the government has also allowed individual persons resident outside India to invest in equities via portfolio investment schemes. Now, all of the above measures are, as we mentioned, effective from the 1st of April 2026.
And earlier today, we spoke to Dinesh Kanabar on the measures announced by the RBI. Here's what he had to say.
A number of representations were made to the Finance Ministry. Interest was becoming an irritant. Taxation of the interest was becoming an irritant for a number of reasons. I heard you mention earlier about tax treaties. But under none of the tax treaties does interest get fully exempt. nor is capital gains exempt. And here, of course, we have more concerns about interest and capital gains, because capital gains is on the fluctuation of the value of the security. Interest is something which is an ongoing thing. Now that that has gone, not only do you get your full interest without any withholding, so I think it's a very welcome step. Good irritant being removed. It's not just an irritant, but really a huge cash flow from the investor's perspective.
And moving on from the policy, let's focus now on Tata Motors. Speaking at the company's dealer business planning meet, Chairman N. Chandra said that the automaker has committed a sum of 35,000 crore rupees in capex through 2030. Let's go across to Sudarshan for more on this. Sudarshan?
So Tata Motors PV has been in the focus for the last few months, and it's been the biggest outperformer if you consider 2026 and all the PV names. It's the only amongst few stocks that has been higher YTD. It's up almost 9%, but if you compare with the stocks like Mahindra and Mahindra, Maruti, all those stocks are down YTD in 2026. Yesterday, N. Chandra, that is the chairman of Tata Sons, has addressed the dealers of Tata Motors passenger vehicle, where he has given the ambitious target for 2030, and he believes that there is an up move that we can expect for the passenger vehicle segment going forward too. And what does he say? He said that if PV industry moves towards 6 million vehicles by 2030, our target, that means the target that company has, is of 1.2 million vehicles and the market share of more than 20%. Current market share of Tata Motors passenger vehicle is hovering around 4 to 6%. That he's planning to increase to more than 20%. And the one segment that is going to play a very important role is the electric vehicle segment, and the push that this segment is getting from regulatory bodies as well as the government. We can only expect for it to move further higher, and Tata Motors PV is the market leader with market share of almost 40% as far as EV is concerned. And he says that he has committed significant capital investment of almost 35,000 crore by 2030. And on EV particularly, he has said EV began as a focused bet 7 to 8 years ago, but now it has matured into a significant strategic advantage. So today, because market has been choppy, it has come off highs. That's this stock too has come off highs. But over the last few months, it has been moving just in one direction. That's upward, almost 30 to 40% up from the recent lows.
Very interesting. Tata Motors passenger vehicles doing well, 17% higher over the last 1 month has the stock moved. So a good move for Tata Motors PV. Of course, in line with the choppiness in the market, this too is seeing some bit of choppy moves. But beyond Tata Motors, there are a lot of other stocks that are also buzzing around on the back of news flow. Ananya is joining in with all of those updates. Ananya, over to you.
So while RBI MPC decision is in focus today, let us look at some buzzing stock in trade. Now, first starting with Z Entertainment, they are in focus after securing rights to broadcast and stream 39 FIFA tournaments in India from 2026 to 2034, including the FIFA World Cups in 2026 and 2030. Now, coming to Grow is also buzzing after Franklin Templeton sold 1.13 crore shares through a block deal, while Goldman Sachs picked up a stake worth around 210 crore. Now, Go Digit General Insurance is witnessing interest after Peak XV sold 33.33 lakh shares via a block deal, with AB Sun Life and JP Morgan emerging as key buyers. Now, Ola Electric remains on investors' radar after raising about 780 crore through its qualified institutional placement. Now, BHEL is also in focus after bagging a massive EPC order worth over 21,000 crore for a major stage 2 thermal power project in Uttar Pradesh. Meanwhile, Meesho has unveiled its AI-powered discovery engine Prism, with the company saying that more than 75% of the platform orders now come through AI-driven recommendations. And finally, Nephrocare Health Services is in focus after expanding its international presence through the acquisition of dialysis center assets in the Philippines. So these are the key stocks that are buzzing today.
All right. Thank you so much for taking us through those details. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned.
Welcome back. On to updates from West Asia. Then US-Iran peace talks have stalled after Hezbollah chief rejected a conditional truce announced by Lebanese and Israeli envoys, demanding a comprehensive ceasefire and full Israeli withdrawal instead, as he threatened North Israel with new attacks. CNBC's Dan Murphy is joining in with more details.
What we have seen is this much talked about ceasefire between Israel and Lebanon now looking increasingly like it is on the brink. In the last 24 hours, we've heard from the Hezbollah leader, Naim Qassem, who called the deal illusory and also branded the ceasefire talks shameless. In a statement, he also said that Hezbollah did not make any commitment to any party to stop resisting as long as there is occupation. He's now demanding a full Israeli withdrawal first, saying anything less would be, in his words, surrender and defeat. Of course, Iran's Foreign Minister Abbas Araghchi also weighing in, insisting that Lebanon is an inseparable part of any deal with the United States and that the war there only ends when Israeli forces withdraw as well. It also seems as if the ceasefire only really existed on paper, and that is because we have seen a significant development in the last couple of hours as well. What we have seen is Israel striking at least a dozen villages in southern Lebanon overnight, at least according to reports. And at the same time as well, there's also some disagreement emerging inside Lebanon as well, with Israel's defense minister saying troops will not be leaving yet. Israel's National Security Minister Ben Gvir also calling the ceasefire a serious mistake and saying that Prime Minister Netanyahu should have been willing to say no even to the President of the United States. What's also interesting is that the US President, Donald Trump, is maintaining his optimism here. He has also been speaking overnight saying that these talks with Iran were still going well, and at the same time downplayed the strikes this week that have really raised questions about exactly where the diplomatic track really stands right now too. So lots of questions about what the weekend is ultimately going to look like as we see the kinetic activity not necessarily slowing down, and of course the diplomatic effort continuing, but at a real snail's pace.
So Dan there with the latest on what's happening in West Asia. But on that note, it is time for us to head into another short break. But more news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Blackstone-backed data center specialist AirTrunk plans to invest more than $30 billion to develop over 5 gigawatts of digital infrastructure capacity in India by 2030. CEO Robin Khuda met Prime Minister Narendra Modi earlier today to discuss India's vision to become a global AI powerhouse. The proposed investment program is backed by Blackstone and the Canada Pension Plan Investment Board and is among the largest digital infrastructure initiatives currently under consideration in the country. During his visit, CEO Robin Khuda met with state ministers in Maharashtra and Andhra Pradesh to discuss infrastructure, energy and policy frameworks necessary to sustain AI-driven growth.
And with that, we take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. The markets are at the lows of the day now. Midcap Radar takes the action forward on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Fatakia. Hormuz, good afternoon. Big reforms announced today. The markets reacted positively to that, but then came in for some profit booking. Has been quite volatile. For now, we are below that 23,400 mark by a big margin, actually very close to that 23,300 mark. Mid-caps are in line with benchmark indices, but Bank Nifty is outperforming by a little bit, but continues to be in the red.
It's a nifty bank that's causing the volatility as well, right? At one point, the index was up, 300, 400 points, and now it's come off. It's down almost 80 points in the red, and that's having a bearing on the nifty as well. You get to the markets in just a bit. These are the headlines at 1:30 on the final trading day of the week. Stocks have plunged to the lows of the day in this volatile session. Mid-caps are underperforming their larger peers. The consistent selling in IT and metals, while financials were in the green but are now in the red.
Institutional investors pick up stake in Go Digit via block deal worth 100 crore rupees yesterday. Aditya Birla Sun Life buys 21.66 lakh shares. JP Morgan adds 11.66 lakh shares. On the flip side, Peak Partners Growth Investments erstwhile Sequoia Capital offloads 33 lakh shares.
Nephrocare Health Services expands operations in the Philippines. The company has acquired assets of dialysis center via a subsidiary for a consideration of 4 crore.
Zee Entertainment secures rights to broadcast the FIFA World Cup in India, ending a month-long standoff over the tournament's availability. Zee now has rights to broadcast 39 events starting 2026 till 2034. Stock upbeat in afternoon trade. Okay, those are the top headlines that we are tracking for now. The markets continue to trend lower as we speak, but a lot of movers in the broader markets for now. The Nifty has come off from the highs and is at the day's low for now. And what are the factors which are leading to that? Even the mid-cap index for that matter. We do have some of these energy names, the Bank Nifty yet again, which is causing all this pressure on the markets from the highs of the day. We do have the IT pack as well. That should come up for you on the screen. That has also come off from the highs, is very close to the day's low. The IT pack there is causing some of the pressure that we are seeing on the Nifty as well. The mid-caps, again, as I said, continue to trend lower. So after that volatile phase, we are seeing some trend reversal that's come by. Look at that. A sharp fall on the mid-cap index, which was outperforming most of the time.
The bulls will be disappointed today, at least as of now, considering the fact that they were at one point on the cusp of 23,800, but now they are fighting to defend that 23,300 mark as of now, and that is one level that they would want to hold on to on a closing basis at least. So very, very choppy on the markets currently. Some of the heavyweight banks, ICICI, Axis, trying to lend some support, but getting offset by the underperformance seen in Reliance, Bharti Airtel, and more so in HDFC Bank as well. But there are a lot of movers in the broader markets today. Ria is here to take us through all of those names. Ria, over to you.
Well, yes, a lot of stocks are buzzing around in trade today. Let's look at some of the big gainers first. There's Jyoti CNC, Tata Teleservices, Schneider Electric, as well as Zee Entertainment and Acutaas Chemicals, which continues its strong move in today's trading session. And also looking at some of the stocks that are buzzing on the back of strong volumes compared to their 30-day average traded volumes. Go Digit is trading at 38 times compared to its monthly volumes traded. Tata Teleservices as well as Aditya Birla Lifestyle brands, both trading with volumes at 12 and 10 times the 30-day average, and Zee Entertainment as well as Jyoti CNC, each with 5 times the monthly average traded volumes. And moving on to some of the stocks that have hit their 52-week highs today, this includes Acutaas Chemicals as well as Acme Solar, both of which are also at their all-time highs. And there's HSCL, Adani Ensol as well as AIA Engineering, all of which also hitting their 52-week highs today. Moving on to the losers in today's trading session, there's Wockhardt, HFCL, Netweb, PhysicsWallah as well as Reddington. PhysicsWallah being the standout there after yesterday's 17% move, and today taking a hit of about 3.5%.
Okay, take that point. Thank you so much, Ria, for joining us with that list. Some of those stocks making big moves in a volatile market. Let's welcome Samil Mehta from Mirae Asset Share Khan for a quick technical check on the markets. Samil, good afternoon. Thank you so much for joining in. What do you make of the fall that we've seen from the highs? First, that surge after the policy announcement, and then this day's low number that we're seeing right now. What happens to the Nifty? What's the next level that we are watching out for?
Good afternoon to everyone. See, we already making lower top, lower bottom formations on Nifty and on Bank Nifty. Now, in the very, very short term, we've been taking support around 23,200, 23,100 level, which is a very crucial support, of course. And in the medium term outlook, we are in a very broad range between 23,100, 23,200. And on the upside, 24,100, 24,000. So that's a broad range. Now, I'll be expecting more downside in the very short term towards 23,100. So now 23,100 is a very, very crucial level because that is a 61% retracement of the entire bounce which we saw last month. Now, if we break that, then the next level would be 22,700. So that's where we are heading. My targets would be 22,700 and my bias would be a negative in the very short term, and I'll be expecting more sell-offs. In Bank Nifty has, today it started about 20 day of around 40 daily exponential moving average, but now it has started going down, taking resistance at that average and falling down. ICICI Bank, Axis Bank, Kotak Bank, SBI, all of these stocks are making low top, slow bottom on the hourly chart. So I'll be expecting more sell-offs there. My targets for Bank Nifty for now in the very short term would be 52,700, 52,800 levels. So negative in the very short term.
52,700, 52,800, that's a 1,500 point downside for the Nifty Bank. But Saumil, in light of that, what are the specific stocks that you're recommending?
There are two sectors which are looking a little negative, two stocks which I've chosen. First is HCL Tech. IT is definitely looking negative after the fall which we've seen this start of the week. HCL has started making low top, slow bottom, trading below 2040 daily moving average. Stop loss would be 1190 and target would be 1070. The second stock which I've chosen is Kotak. Kotak Bank was very sideways for a little while now, but however, it has broken an upward sloping trend line on the downside, taking resistance at 20 and 40 daily moving average. Negative on this stock, target would be 350 and stop loss would be 386.
Okay, all right. Thank you so much, Saumil, for joining us with those technical trades. With that, let's move on and get you some updates which are stock specific. Shares of Interglobe Aviation, they are in focus on the back of Centre's new ATF pricing mechanism. The company has also temporarily cancelled flights to 6 international destinations because of cost pressures. Devyani is joining us with the blowdown. Devyani.
Well, amidst the West Asia war, if there's one stock that's been on everyone's radar, that's been Interglobe Aviation. And airlines have now received a certain kind of relief. Now, airlines are likely to pay a fixed ATF price of 86.3 rupees per litre on the domestic front and around 104.5 rupees per litre on the international front, along with applicable taxes and charges. Now, this is under the new government-backed 10,000 crore price stabilization scheme, and as per latest analyst estimates, this takes the effective price to 115 rupees per litre in Delhi, up from the current 105 rupees per litre of fuel costs that the airlines are currently paying. Now, that said, that does bring down the cost of international operations, but does increase the overall cost of domestic operations by roughly around 10 rupees per litre. Now, they have also temporarily suspended operations to 6 international destinations in order to optimize cost as well as looking at the lower demand in Q2. Now, they will resume bookings for all the impacted services starting 1st of October 2026. And that said, it still continues to operate roughly around 1,800 weekly international flights. Now, it is a net negative for the company since fuel prices have gone down on the international front, but also capacity has gone down on the international front. But on the domestic operations front, prices have actually seen an uptake on the fuel cost perspective. So all in all, a mild negative this time around.
Devyani, thank you for that update there. At the lowest point of the day now is Indigo, but still 1.25% lower, still holding on to levels of around 4,400. Now, the one stock that has been under pressure though today has been Wockhardt. It's seeing some profit booking after this breakneck surge that it saw over the last few trading sessions, and that is following an investor conference where the company laid out its strategy with regards to the Zenix antibiotic. Ekta is here to tell us more on that. Ekta.
Thanks for that. Well, yes, a couple of takeaways from the investor conference that was held yesterday with regards to the Xenic antibiotic, which has been approved in the US as well as India. So the expected launch in both the countries are expected to be in 6 to 7 months. Europe should be 3 to 4 months after the US filing. They are targeting 7 to 8 emerging markets in 18 to 24 months, which include the likes of Latin America, Eurasia, etc. India price expected to be 75 to 80% lower than the US, which is estimated at around $10,000 per treatment. Initially, it is 12 to 18 months. You expect a pickup rather in 12 to 18 months, and that will be basically how long the hospital adoption cycle would take. Meaningful traction, probably FY29 onwards, is what the company had indicated. Peak sales potential, $1.5 to $2 billion per year, which would be the life cycle peak for the drug. First 12 to 18 months, near break-even or a small profit. Medium term, top line should eventually possibly become the bottom line for the company with regards to this drug. The management expects around 10% plus improvement in terms of margins over the next 3 to 4 years. And the company is shifting from now being a generics/biosimilars business to a global innovator pharma company. Focus is going to be on novel antibiotics as well as new drug discovery.
All right. Thank you so much, Ekta, for joining us with all those details. Before we slip into a short break, just want to highlight some of the stocks which are at the day's low. BSE, for instance, has slipped from the highs, is currently trading at the day's low. So watch out for that. Stock is down around 5%. Of course, the entire broader market space is not doing so well. We do have, and that's a sharp fall that we got in just in last half an hour. MCX2 is the other exchange which is not doing so well. So 4.5% lower on MCX as well. Some of these capital market stocks not doing so well in trade as we speak. We'll slip into a short break. When we come back, we'll talk more about the stocks and get individual analysis as well. Welcome back. Let's get a corporate conversation going now. DE Development is the management on our radar. The board has approved issue of 59.76 lakh shares worth 300 crore rupees at 502 rupees per share. The promoters will be participating in that as well. KL Bansal, Chairman and MD, DE Development Engineers, is joining us now to understand what is the reason for this particular fundraise that has come by. We'll understand that, the use of funds, if the revenue target of 1,500 crore rupees is realistic, and the order book outlook as well. Mr. Bansal, good afternoon. Thank you so much for joining in. We spoke to you just a few days back on your numbers as well, which were very strong. Let's talk about this fundraise now, because that is something that the street seemed to like. Give us a sense of what is the usage of these proceeds. Will it be for the capex that you have spoken about earlier? Give us more details.
Good afternoon. Thank you so much. Primary purpose for this fundraise will be to repay the debts, and some part of it will go for general corporate purpose. And in that general corporate purpose, we may go in for some sort of a capex, but still it is not finalized. But, basically 225 towards loan repayment and around 75 crores for general corporate purpose.
Okay, so Mr. Bansal, so most of it is for repayment of debt. So once you do that, how much debt would be left with you after this? And since you are not earmarking a significant sum for the capex, would you be looking at further fundraisers to fund the expansion plans that you have in store?
Not really. We are targeting to reduce our limits by around 225 crores, and we are not looking for any further fundraise, at least in coming 3 to 4 years time. That's what the plan is, and we are quite confident that with whatever growth we are anticipating, we shall be able to fulfill all the requirements from our inflows, from our cash accruals, as well as from this fundraise. It should be good enough to take us to the next level of growth.
So you will be repaying debt worth 225 crore rupees is what you're saying?
225
and
is the target.
You'll be net debt free with that? Or you'll be debt free with that?
No, I couldn't get your question.
You'll be paying the entire debt with this 225 crore rupees?
It will not be entire debt. It will just a part payment. It's just a part payment.
So how much of an absolute debt will you be left with?
In our parent company, we shall be left with around 150 crores of debt as far as working capital is concerned. And, there's a term loan of around 140 crores, which will keep on staying. And, we'll keep on paying it from time to time as per the agreed schedule with the banks.
Okay. So what will the impact on earnings be in that case, Mr. Bansal? What is the current rate that you're paying the debt at? What is the current cost of debt? How much interest will reduce because of that? What will the impact on PNL be?
Expecting around 20 to 25 crores of reduction in terms of interest, which will directly add to the PBT.
Per annum?
Per annum, yes.
Okay. And you're still left with around 140 crore of debt is what you're saying?
That's right.
And that's long-term or working capital debt?
The long-term, I'm saying long-term is around 140 and working capital will be around, let us say around 150 odd rupees shall still be left out.
Mr. Bansal, how much of your BPCL order revenue would be recognized in this financial year? It's one of your largest orders, right? Almost 400 crore. So how much do you expect to accrue this year and then going into FY28?
Around 25% this year.
25% this year, and the rest goes into FY28, or it will be staggered over FY29?
Entire FY28, entire.
Okay, so the rest of the 75 comes in FY28.
We have to complete it within that time.
Okay. And sir, since you have mentioned that you're targeting for 2,000 crore worth of order flows this year, and 1,000 crore comes from exports, what geographies are you targeting, especially considering your West Asia exposure is fairly limited?
Our, orders come from our OEMs who are located either in US, Europe or Japan. So, but the supplies can go to anywhere in the world. So we are not concerned on that. Our inflows come from primarily these three territories, that is US, Europe and Japan only.
Mr. Bansal, thank you for sparing time and joining us today with your outlook on the preferential issue and the way you plan on using the proceeds. Take a short break on that note. The stock in a 5% upper circuit. Back with more on the other side.
Welcome back. You're still tuned into Midcap Radar. Well, a lot has happened when it comes to gold flows in mutual funds. And now the latest one has to be HDFC MF, which in an addendum announced that they are suspending direct subscriptions in their gold ETFs. This is largely for large lump sum flows. The first limit is, of course, anything beyond 25 crore rupees. The direct subscription of 25 crore rupees, that is, which is suspended for now. Additionally, this will be done from June 8th for large investors, which basically invest in HDFC Gold ETF. They've capped new investments in Gold ETF fund of fund, which primarily invests in units of the HDFC Gold ETF, which is up to 10 lakh rupees per PAN. This again will be done from June 5th, that is today. So this is largely done because there continues to be a lot of interest in gold, and HDFC MF doesn't want to go ahead and buy gold because that's the underlying for any FOF or an ETF, right? So this is first of a kind where they have stopped inflows in ETF. The limit is at 10 lakh rupees per PAN. This happens from 5th June for smaller amounts and 8th June for bigger amounts. And yeah, so it is important for any investor to keep in mind that if they are invested into this particular ETF, the flows will be stopped, or at least subscriptions will be stopped from this particular date.
Important update there from HDFC Mutual Fund. Sonal, thank you for summarizing that for us. Take a leave on this edition of Midcap Radar from Sonal and me. Thank you for watching. The market still at the lowest point of the day. Your stocks on the other side.
Hello and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan and with me as always Vinny Motiwala. Good afternoon guys, good afternoon Vinny. You know, it's been quite a topsy-turvy day, right? The markets are in the red now, but post the RBI announcement we saw a recovery. The Nifty went near 23,500, but now it's back to the lows of the day, right? It's around 23,324. So the Nifty and Sensex about 0.3% lower. We've got the mid-cap index that's underperforming the blue chips, but the Nifty bank absolutely flat. It was a recovery in the Nifty bank that actually helped the Nifty go higher. So some of those financial names, PSU banks doing well. We've got private banks also, ICICI Bank in the green at this point in time. On the downside, we've got that metal pack that's not doing very well. And we've seen Nalco, Hindalco, all of them are down between 3 and 4% in trade. So that's how the markets are shaping up, Vinny.
Absolutely. That's a good market roundup that you have. But in terms of what's doing well, we have realty that's holding on to some bit of a green. So let's keep an eye out on that, as well as the pharma pack that's holding on to some bit of a green as well, and a lot of individual movers coming in from the broader end of the market. Also, Schneider Electric, Jyoti CNC, Equities Chemicals, all of them are holding on to gains in the trading session. This is from the broader end of the market. But let's get started with the show. This is a show where we solve all your stock-related queries that you'll have sent us. And to do just that, we have our experts joining us. We have Shaina Mukaddam, independent market expert, as well as Ashish Kyal of Wave Strategy Advisors to answer all those queries. Shaina, as well as Ashish, good afternoon. Thank you so much for joining us on the show as always. Let's get started with the first query then for today. We have Bala Subramanian, who's writing to us from Bangalore. He's holding 300 shares of Bharat Electronics, BEL, and that is at a price of 389, making some bit of a profit on this one. Holding it for around a year. They bought it in June 2025. The other one is 175 shares of IRCTC, IPO price around that time 62 rupees. Long-term investor in both BEL as well as IRCTC. Is it the right time to add more stocks is what they want to do, or should they switch to other names? Shaina, your view?
Well, I would suggest that BL is a stock that you could add. IRCTC is something that you could hold. BL, I would believe financial performance is improving in terms of their operational efficiency. If you see for the full year FY26, they reported a decent growth in revenues and profits were up by about 14%. The main thing over here is if they've done a revenue of about 27,000 crores in FY26, their order book is 3 times this. So you have a visibility that is there for a couple of years. Technology is pretty good, which they are, sort of capitalizing on in defense segment. So I would say BL, you could add in any dips. IRCTC also, basically, the opposite is happening. The numbers have been pretty disappointing. And the stock has corrected substantially, I would say, in the last couple of quarters. Now I believe that it is possible that the increase in raw material cost, the impact on their margins could be behind, and hopefully over in FY27 numbers should improve, especially supported by some of their other activities other than their ticketing. So I would say both of these stocks are a hold as of now, in my view, and add at dips.
All right, so both of these stocks are hold in your view and add on dips is what you're saying. Ashish, if I could bring you into the conversation, he's got BEL and IRCTC making a profit on both of these stocks. Should he add at the current price or should he switch to another stock? That's the query he has.
Hi, afternoon to you and all the viewers. If you look at BEL, the stock has corrected from 465 levels and made a low of around 400. Now, 400 seems to be a very important price action support because this is where the low was formed in the month of April. This was the low which was also formed in the month of Feb, and we are seeing some bottoming formation over here. So my suggestion would be to hold on to the stock here, maintain at 399 as a very strict stop loss over short term. But from a medium to long term perspective, continue to hold the stock. We can expect a move towards the level of 435 on the upside. And the next stock, which is IRCTC, we can see that there has been very, very severe correction from the highs of around 780 and the stock has continued to move down. But however, there is a double bottom formation even in this stock at around 500 levels. So hold on over here as long as on the downside we maintain that 480 mark. 480 to 500 zone is important. And on the upside, we can expect the stock to move back towards 580 over the near term. targets.
All right, so both of you saying hold on both of those stocks, but key levels given there by Ashish to watch out for. The next query coming in from Ram Iyer. He writes to us from Mumbai. He holds 10,000 shares of Cupid at 29 rupees. He is making a profit on this. He wants to know whether he should hold or sell and book his profits at this point in time. So Shaina, let me come to you first. What's your view on the stock? Should he book his profits or should he continue to hold?
Well, this stock has actually given a very sharp upside if you see the last couple of months. I think at current levels, it is better to take some profits off the table because in terms of valuation, it is extremely expensive. So I would suggest take some profits off the table.
Take some profits off the table. That's the word coming in on the fundamentals. On the technicals, would you also suggest that given we've seen a run-up of 500% in the last 1 year for the stock? Ashish, what's your suggestion?
Yes, the stock has moved in a spectacular way, trading around 136 as of now. And it is still managing to protect the prior low over the past many days. So the overall undertone and the momentum still remains intact. I think the stock can move towards a level of around 149 or maybe higher. And on the downside, one can maintain a stop loss for the stock at around 128.
Okay, surely point taken there. Let's move on then to the next query for today. We have this is coming from Parag Joshi, who's writing to us from Mumbai, holding 100 shares of Apollo Tyres. Price is 470 rupees per share. So it seems like they're making a bit of a loss on this one right now. Wants to know if you should continue to hold or maybe look to add more shares, average, or just sell out, book your losses right now. Shaina, what's your view coming in for Apollo Tyres?
I would say you hold it as of now. And at dips, you could average. Basically, they are doing pretty well in volumes. If you look at the domestic business, which accounts for more than, I would say, 87-88% of their overall revenues, they are doing very well. The tire, both in OEM as well as replacement market, is doing pretty well. They have been affected to some extent. One is on higher raw material costs for this year. And second is in Netherlands, they are running, Europe, they are running losses. But I would believe by June, that is in this next 1 or 2 quarters, they are planning to shut down their Netherlands plants, and that will result in improvement in EBITDA margins over the coming quarters. Second part why I say that you hold it is because valuations. Valuations, in my view, at current levels are quite attractive. It's just about 10 times EV by EBITDA 1 year forward. So I would say hold and add at dips.
So hold and added dips. Before we go to Ashish, just a quick note. The rupee has seen quite a bit of a gain today, 95.06 against the dollar. It's seen a 70 paise gain today. Even after the policy came out, it actually had recovered from the lows that it saw yesterday at around 95.67 and now at 95.08.
So around 95.
Yeah,
Finally.
so sharp recovery there in the rupee post the policy. But Ashish, coming to you now, back to Apollo Tyres. You know, they did see a strong quarter. He wants to know if he should continue to hold or add more shares. The management had pointed out that it is going to see higher input costs going forward. So what's your view on the stock?
Yes, I think that's the major problem because everywhere we can clearly see there is the pressure of the global political tension that's ongoing. The crude oil prices uncertainty and the rupee depreciation has been the major reason why these companies has not been able to perform well. But Apollo Tyre, I think, has important support at around 370 level. My suggestion would be hold on to the stock here, as in when we start seeing cool off in the oil prices and also we start seeing the demand picking up, the stock can easily move towards the level of 450 or maybe higher.
All right. So the next query coming in from Gopal, who's writing to us from Bangalore. He holds 179 shares of MTAR Tech at 7,295 rupees. He's making a profit on the stock. The stock is currently at 7,524. And he wants to know if he should continue to hold or sell. So, Shaina, what's the fundamental view on the stock? Should he continue to hold? He is making a profit on it.
I would say continue to hold. The results, if you saw FY26 fourth quarter also, was phenomenal. And the management is guided that they will do a similar type of growth in the FY27, FY28. And their order book position is supporting this type of growth. So I would believe that, given the sector that it is in, clean energy, which accounts for a major chunk of their revenues, and they're also moving into defense in a bigger way, I would believe both these, this combination of sector as well as growth, strong growth going forward, makes it a decent hold. See, expensive. It is expensive. If you look at it, even 1 year forward, it is about 25 times EV by EBITDA. In fact, more than that. It's slightly more expensive than that also. So I would say you hold it for now, but add it at dips.
Okay, hold it for now. At least that's the word coming in for the present situation. On the technicals, what's your view, suggestion as well, Ashish? Good run up in the stock that we have already seen in the last 1 year. Do you think there is more room for upside now from the levels that they bought it at 7,295?
Yes, it looks like, because see, the stock found a very decent support at around 20 days moving average, and showed a bounce back sharply from there. The overall broader market has not moved that much, but MTA Tech has continued to outperform. The volumes have been decent enough. So hold on to the stock here. We can expect it to move towards the prior swing, which is 8,500 or possibly higher. On the downside, the support for the stock comes to around 7,050 levels.
Okay, we'll keep an eye out on those levels over there. Thanks for that. But on that note, we're going to slip into a very short break. After the break, we'll come back with more of your stock-related queries. Stay tuned. Welcome back to Your Stocks on CNBC TV 18. We still have with us our expert China Mukaddam as well as Ashish Gal to answer all the stock-related queries. Markets as of now continue to be near the 23,300 levels, near the day's lowest point. But let's keep it going with the next query for today. This is coming from Jigar, who is writing to us from Mumbai. He wants to know at what level can he look to add JSW Steel for a period of 9 to 12 months. So 1 year time period is what they're looking at. Shaina, your view, JSW Steel, the metal side, what's your suggestion?
Well, metals looks good as well as JSW Steel. If you see actual steel prices, and if you see the hot rolled coil prices, which is a major contributor to JSW Steel revenues, the prices have gone up. If you see on point-to-point basis, 1 year about 35%. The stock also has done pretty well. If you see the last 1 year, 6 months. At the same time, I would say even at current levels, you could hold and maybe add at any dips. because even prospects are good going forward. Volumes, they're expecting high lower single-digit volumes. And I think prices will remain stable at current levels. There could be some impact of raw materials, but still I would hold it for the long term because they actually are repaying some of their debt, in fact, quite a bit of debt because of the funds that they're getting in from the sale or from the transfer of the Bhushan power plant, which is almost 17,000 crore plus. So their debt will come down and that will support their growth plans. They can leverage further. They are planning to add capacity by almost about 50% over the next 3 to 4 years. So I would say continue to hold decent management, decent stock. Fundamentals will improve in the medium to longer term.
All right, so hold it for the long term is your view. Ashish, he wants to know at what levels can he add JSW Steel for a period of 9 to 12 months? So any key levels for him to watch out for?
See, if you look at JSW Steel, the entire space actually has done extremely well. JSW Steel is showing some kind of short-term profit booking from the higher levels of 1320. So if there is any kind of a dip around the levels of around 1240 or 1220, use that as an opportunity to add more to the stock over here. And on the downside, the crucial support is going to be around 1140 levels. On the upside, we can expect the target of around 1460 for the stock.
All right. The next query is also an investment one, and it's coming in from Sanjay. He writes to us from Thane and wants to know if this is the right time to invest in Pine Labs. He has an investment horizon of 2 years. So, Shaina, if I could come to you first, Pine Labs currently at 144. Is this a good time for him to, buy this stock?
Any investor who's been there from the IPO time is really regretting it, because the stock has, has corrected quite a bit from that point in time. Even at current levels, I would believe it is better to avoid it for now, because valuation still, in my view, if you look at it over the 1 to 2 year period, remains pretty expensive. It's, almost about 30 times EV by EBITDA, FY28, in my view. So I would avoid buying it at now, wait for better levels or, let it correct and then again rebound, show you some decent strength before you start buying it.
Okay, wait before you start buying it. That's over there on the fundamentals. Technically, any suggestion or view here coming in? It's an investment query. Would you look at these levels to enter Pine Labs, Ashish?
See, Pine Lab earlier low was at 150 and currently it formed a low at 135. So 150 is going to now act as a very important hurdle for the stock. My suggestion would be, as of now, wait. Let it cross above 150, 153. That will generate interest and demand from the lower levels. And then we can expect the stock to move towards the level of around 185 on the upside. On the downside, 135 is going to be a very important support. So suggestion would be do not buy now. Let us see if it can sustain above 153 levels and then possibly buy the stock for the short-term targets.
Okay, that's a view there on Pine Labs. Let's move on to the next query. This is coming in from Mr. Gupta, who's writing to us from Pune. He's holding 1,450 shares of Eicher Motors. This is at a price of 500 rupees per share that they bought it at. Wants to know, should they continue to hold? Should they look to sell? Obviously, they've been holding it for a while. Shaina, your suggestions?
Well, yeah, he's done pretty well holding it for this long term. I would suggest continue to hold. Even if you saw the numbers, auto numbers for May, Eicher did pretty well. So I think in terms of their growth in the overall vehicles, they did both in their VCV as well as their Royal Enfield. So I don't see any issue there. See, it could consolidate for some time at current levels because valuations are not cheap. It's about 20 times EV by EBITDA 1 year forward. But I would suggest hold. There's no point in exiting.
All right, continue to hold is what you're saying. Ashish, what should the viewer do? Should he book some of his profits? He's doing well on the stock. He's made quite a bit of profits. So should he continue to hold or should he book some profits?
No, I would suggest continue to hold because we have started seeing some kind of green shoot across the auto space. We can see that how TMPV has managed to outperform over the past few weeks. And same thing can happen with Eicher Motors also. Yes, some consolidation is possible over the coming weeks, but once that is over, we can see the stock move back towards the level of around 8,000 on the upside. So hold is the recommendation. On the downside, important support is 6,800 levels.
All right, so continue to hold is the word from both of you there. The next query coming in from Malika, and she's writing to us from Mumbai with another investment query. She wants to know if this is the right time to invest in Schneider Electric. The stock currently at 1,170 rupees. Shaina, what's the long-term view on the stock? Is it a good time to enter?
Well, not in my view, though the volumes as well as the price is showing otherwise. But in my view, the stock is, pretty expensive. And if you see the performance that it is showing, a very subdued type of performance in terms of profits, growth, impact on margins, they don't seem to be, doing pretty well, though they are in a very high growth segment where most of their competitors in that whole overall segment are doing very well in terms of growth, order book, etc. In my view, don't buy as of now.
Okay. And on the technicals, good time to look at Schneider Electric, or should we look at the peers then, Ashish?
I would suggest avoid. The reason being, over the past 4 days, you can see bearing yesterday, there was a lower circuit in the stock as far as I can see on the chart for consecutive 4 days. So the problem in this kind of stock is that you will not be able to exit from the stock in case there is a reversal on the downside, and you will not be able to manage your risk. So avoid is and be cautious about such stocks.
All right. Ashish, Shaina, thank you so much for being here with us on Your Stocks and answering all of our viewer queries. And it's time to take stock of how the markets are doing. Vinny, the markets are lower than when we started as well. The Nifty now at 23,309, barely holding above that 23,300 mark, which will be key to watch, right? And it has seen quite a topsy-turvy turn today. The Nifty Bank also seeing further losses, 0.2% lower. And, on the upside, we've still got that realty pack, the healthcare pack. And on the downside, we've got metals, leading those losses.
Absolutely, and IT also again today is not managing to hold on to gains, right? So Nifty IT is also now down 1%. Last week we had seen a different story coming in, but today and this week, some couple of days, we've seen a bit of a red for Nifty IT as well. But day's lowest point is what the Nifty is also trading at. So let's watch out for that. We're seeing a recovery that continues in the rupee. You can see it at the bottom of your screens all as well, just near that 95 mark right now. So that will be interesting to watch out for. This came in post, the RBI policy that we've seen, some announcements that came in from the government side as well for the G-Secs as well. So that is something that, we'll watch out for in terms of the recovery in rupee. Where is that going to be headed? And in terms of the markets, where are we going to be headed in the next 1 hour will be key to watch out for of how we are going to be ending the trading session, right? Because midweek we had seen those recoveries coming in at 12, but yesterday and today that doesn't seem to be the case. And today, actually, we've seen a bit of a decline coming in. Broader end of the market also seeing a bit of an underperformance. But with that, we're absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Remember, you can always email us your queries, WhatsApp us your queries, message your queries as well. So do send us your queries. But last hour of trade is left, and for that, you have Closing Bell up next.
go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Taiwan index is down 1.6%. We have Hang Seng that's down 0.4% in the trade.
All of the respondents to the CNBC TV 18 poll expect the Monetary Policy Committee to leave the repo rate unchanged at 5.25%.
Actually under 96, so prices move around a little bit, so 95, 96 around those levels. I think we're at about 23,500 plus, so this is a 100-point up move on the Nifty.
Nifty has clearly underperformed in absolute and relative terms. Large caps have gone nowhere. Nifty has seen no dollar returns in about 5 years.
The MPC voted unanimously to keep the policy repo rate under the LAF unchanged.
FPI bond investor point of view, the tax is gone and more number of instruments are available to them under the fully accessible route. Are you expecting your investor clientele to be happy?
And the fact of the matter is that there is a huge amount of interest that we have seen of people wanting investment in government securities.
Nifty, a sharp uptick since the time we saw these announcements come by as well. It is up 53 points above the 23,400 mark. Across the board, we are seeing that recovery.
That when the tide will turn, we can have some of these participants put in their dollars into the Indian market.
We are hopeful of reasonable and good. We are not targeting any particular amount, but we do expect healthy flows.
Has been quite volatile. For now, we are below that 23,400 mark by a big margin, actually very close to that 23,300 mark.
Well, this is closing bell. That was a day so far. Last hour coming up, not just for this Friday, but of course for the week as well. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, Nigel. Nigel, hi. Afternoon.
Well, what a volatile trading session, Prashant. You know, the bears would have thought they were in with a chance. You know, just till I think maybe around 20 minutes or so ago when we were down 120 points. And the bulls, well, they have dominated most of the trading session. The good news, I think, today is, irrespective of what the equity markets do, is the rupee has shown some stability. There are measures that have been announced. The rupee is responding to that. And I still think, the last 60 minutes or so, maybe, in fact, there is still some optimism that the bulls have some unfinished business, maybe at around the 23,800 odd mark. So it appears the structure, though it got broken a couple of sessions ago, I think maybe I'll have to lean towards the positive bias from these levels.
Well, 23,350. So we're about 65 odd points lower. And, we'll just have to sort of wait and watch, because the other way to look at this is there was a fair bit of expectation. Was there really a huge amount of pre-positioning going into it, which is getting unwound? Maybe yes, but I think, at the margin, if the market is not able to hold on after what the RBI has done, by the way, RBI has announced a slew of things, right? There's been nothing negative. On the positive side, you can say, well, how much money, how much dollars is this, all these measures going to be able to attract into the country? But if after all of it, markets are not able to hold on, it just kind of sort of, points to the underlying weakness that we have on our hands as well, and a general lack of, at least as far as large caps are concerned, a general level of disdain, and people just shrugging their shoulders off. Mid caps, though, is a completely different story, as we've pointed out for a while now, and that's mostly going to be the focus point over the next 60 minutes or so as well. Well, let's just get trades out of the way. Rahul Mohinder is with us. Rahul, good to be speaking to you. It's been a while, I guess. Good afternoon. How would you see things, and what would you do?
Good afternoon. I think first of all, the market does, as you clearly mentioned, does look a little soft from a Nifty perspective, and I clearly agree with you. It's mid caps where traders are focusing on. That's where the action is, and let's get to some clear stock specifics which we could be looking at. I'd say power finance. That's an interesting one. We're seeing a bit of an intraday move right now, but I think we're good for about a target of 465 to 470. I'd buy it with a stop loss of 416. Another one which comes in my radar, which seems to be outperforming, is Cipla. And this one is not just a short-term call, but you could extend this call out to a medium-term trade as well. I think in the near term, yes, 1460 is a likely target, but long haul, I do expect this to move towards 1540, 1550. I'd keep 1365 as a stop loss for buy trades. And another safe spot, in my opinion, would be LIC Housing Finance. There too, I'm looking at a move to about 585, 590, keeping a stop loss of 530. And again, the view would be that the index may not be singing that song. And just to kind of talk a little bit about the Nifty, I still feel we're probably heading to about 22,850 to 22,900. The only thing that would change my opinion on that is if we suddenly see a move past 23,500. So, in the main, I'm kind of medium to negative, sideways to negative on the Nifty index.
So you'll generate a fresh short, right, at these levels?
Well, even at these levels, I think you're still good for a fresh short, but keep in mind that 23,500 is a block hole. That's a level we've got to keep, a stop loss at when trading.
And the Nifty Bank, that's been a relative outperformer this week. That would be a shorting candidate as well?
I would say yes, but, I would be more tilted towards the Nifty. On the Nifty, if you look at the Bank Nifty, yes, 55,500 approximately is your near-term resistance. But, I don't identify, 2 or 3 top names within the index, which I think would really go down. I think it's going to be more lull in comparison. So I would say within the indices, my pick is go short the Nifty.
Yeah, go short the Nifty. That's the view. And the single stocks, I think we've sort of covered that. We'll get Rahul back in a bit and just run us, get you more. But for now, that's the view. Those are the trades. 60 points lower, 23,360 or so is where we find ourselves at. Gurmeet Chadda is with us, Managing Partner, CIO, Complete Circle. Gurmeet, good to have you with us here. Thanks for joining in. So lots of measures, right? All together in that meeting. And lots of all kind of numbers doing the rounds. How much can this get in? I think Samir Arora of Helios has just posted on Twitter saying, well, $30-40 billion is his estimation, and there are others as well. Just your thoughts, Gurmeet. How significant is this? And I mean, relate this to financing conditions here in India, and of course, yields and banks, etc.
Thanks, Prashant. I think very significant move, Prashant. And debt flows are often underappreciated and a distant cousin of equity flows, if I may say that. Since the time India made those amendments in FAR and got included in the global bond index, one of them, we have got about $19 billion kind of a debt inflow. And I think the outflow from debt has been very minimal in terms of the FX outflow, of which I think the FAR, which is fully accessible limit was almost 11-12, and the general route is about $7-8 billion. So we've just got like 6-7% of the eligible amount we can get. So this is significant there because we don't know. It's right now difficult to pen how much, but it is quite significant. Both for once we have the inclusion in global bond index, maybe 20, 25, $30 billion from there, and FCNR could be another 20, 25 because this time it's a 90-day limit. Secondly, if the RBI hedges it and you get that 3.5%, bank gets more, which can be passed through to the customer. And some, the mix of the lending mix will also change. The banks will also benefit. The entire hedging would not be, passed on. So I think it is pretty significant and less underappreciated. And I think over a period of time, I agree the number could, with the GSEC route and the FCNR route, it could be anywhere between $30, $40, $50 billion. We could see, and much needed considering the outflows we have had. Equity is something which continues to, I think see very good outflows. I just hope that something follows through there as well. Some bit of tweaking in either capital gain, STT, some kind of a relief there, I think would really help the overall sentiment. But I think it's a good start, and I think it's good to see some coordination with RBI and government, both the government coming up with LTCG and withholding tax relief, and RBI allowing, and now they're allowing more GSEC maturities in the FAR route as well. So I think it's a good move. Some of the market doesn't seem to like it too much so far.
Yeah. Gurmeet, a pretty rounded answer and way to think about this, both from a debt flow perspective and what it can mean for equities and financials in particular. But let's just address one more important story. Now, Tata Sons board meeting is scheduled for Monday. This is 8th of June. And ahead of that, we understand a fresh complaint has been lodged with the Mumbai Charity Commissioner. And this is important to take note of. Shireen is getting us the story. Shireen, take it away.
Well, thanks very much. Yes, the trouble at the House of Tatas continues, and what we are giving to understand is that a fresh complaint has been made with the Mumbai Charity Commissioner ahead of the crucial Tata Trust board meeting on the 8th of June. Remember, even in May, this was the case where the Charity Commissioner had then had to call off that Tata Trust board meeting on the back of a complaint that had been sent. Now, this is what the letter says. It seeks the intervention of the Charity Commissioner and it alleges the improper transfer of Tata Sons shares. Now, this is a matter that goes back to 1989. Let me explain this to you. The letter asks the Charity Commissioner to initiate an inquiry into the transfer of 833 equity shares from the Navaj Bhai Ratan Tata Trust. The letter has been written by the same gentleman who complained and had filed a legal notice in the month of May and had sent that legal notice to Tata Trust. It's been filed by Suresh Tulsiram Patil Khede. The legal notice has raised the issue of the transfer, as I was pointing out, of 833 equity shares of Tata Sons to Naval Harmasji Tata in 1989. It claims that the transfer was done to Naval Tata, who was no longer a trustee of the Navaj Ratan Bhai Tata Trust, and hence it was an invalid share transfer. And this is the basis of the complaint that's been made to the Mumbai Charity Commissioner, saying that Noel Tata was the beneficiary of those shares because those shares devolved to him, and hence there will be a conflict of interest for Noel Tata to preside over the Tata Trust board meeting. Now, Tata Trust to CNBC TV 18 hitting out very strongly against those allegations, saying that any suggestion of impropriety on the part of either the Ratan Tata Trust, NRTT, or any of the parties in this transaction is being categorically denied. The Tata Trust says they affirm that the transaction was lawful and was taken with full compliance of all existing rules that were in force at that point in time, going on to say that the proposal was cleared at the appropriate levels, including by the late Nani Pakiwala, one of the country's most distinguished lawyers, approved by the then board of Tata Sons. Transfer of shares was effected on a valid transfer form duly stamped by the Registrar of Companies. Tata Trust also then going on to say that the petitioner in this case, Suresh Tulsiram Patil Khede, is a serial litigator who's been in the past filing several cases against the Tata Trust without any locus standi. They believe that the allegations and these complaints are part of a willful, malicious and orchestrated campaign being undertaken with the sole objective of discrediting the Tata Trust. Now, this has been sent to the Mumbai Charity Commissioner. We will have to wait to see if the Charity Commissioner acts on this complaint and the board meeting scheduled on the 8th of May still stands, or will that also be deferred? Remember, it was deferred by the Charity Commissioner in the month of May. Back to you guys.
Well, thanks very much for that, Shireen. And I think it's an important one. The Trust's meeting coming up on Monday. So that is the Tata story with Shireen there. Well, let's just look at markets and, maybe a little bit more of a downtake, right? From the last time we looked at it, we were down 50 when we started at 230. We're down about 80. And there is, broader markets which have also slipped a little bit going into this Friday, last 40-45 minutes of trade. But, multiple measures and which Gurmeet called pretty consequential and should attract a fair bit of flows, right? Let's just quickly summarize those measures with Ritu. She's, of course, been covering the RBI. She was there at the press conference. Ritu, take it away.
Well, yes, very quickly, Prashant, 50 billion kind of BOP gap is what most economists have been talking about that we could face. Some of these measures, and if you take what Gurmeet was saying, could actually significantly help bridge that. So, yes, it is a bazooka and it's a double whammy coming, not whammy rather, it's a bazooka from both the government and the RBI put together. These are pretty substantial measures that can help attract significant foreign inflows. On the taxation side, you have the government first, of course, saying that any kind of taxation, whether that is withholding tax of 20% or the capital gains tax of 12.5% for FIIs investing into government securities will be completely done away with. This is a huge positive measure coming in from the government. But from the RBI side itself, the universe of government securities under the fully accessible route itself has been expanded, which means, through this route, foreign investors can put money in GSECs without any kind of investment limit. Earlier, it was limited to only the 10-year government security bond. Now, the 15-year, 30-year and the 40-year GSECs will also be eligible. So a wider pool of government securities available for foreign investors to put their money in. Apart from this, the investment limit for NRIs and OCIs to invest in Indian equities without any SEBI registration has been increased. So there is one facilitation that has come in from there. Apart from this, there is a concessional forex swap to incentivize ECB borrowing by public sector enterprises for a limited window until September end 2026. Essentially, think of it this way. An NRI sitting in Dubai, for instance, wants to put money in deposits here. When banks take that deposit, they have to take this, dollar liability. So to some extent, there will be a concession there from the Reserve Bank of India. To what extent that comes in, we'll have to see. And lastly, RBI will also bear the full hedging cost for fresh 3 to 5 year FCNRB deposits raised by banks until the 30th of September. So this is one of the bigger measures that has come in. Last time around, we had this FCNRB window. We were looking at inflows of 28-30 odd billion dollars. So if you're looking at a similar figure, perhaps it could be substantial. Initial estimates by economists say that banks with this helping hand from RBI could offer interest rates as attractive as 5 or 6%, to NRIs looking to invest through FCNRB bonds. So compared to the 4.5% yield you'd get, in US, for instance, that is substantial enough to attract these foreign investors, attract these NRIs to invest into deposits in India. So put together, it is pretty substantial, and all of these, of course, have already come into effect as we speak.
Got it. Okay. All right. Thanks a lot, Ritu, for joining in and filling us in with all of those details. Gurmeet, well, the markets are a little bit wobbly, but I'll tell you what, at the start of the show, I was mentioning that I think still the bulls believe they're in with a bit of a fight. If we look at the index right now, we were down 100 points approximately when we started off the show. I think we're down to 20 now. There has been a bit of a recovery that we have seen. And what's fighting back is actually the Nifty Bank. So from this pocket, BFSI, banking, financial, insurance companies, what are you all tanking upon?
Nigel, I think I had a discussion with few treasury guys of private banks. I think they're pretty excited. So, I think the liability mix will change. Especially banks with a very good NR base, like Federal Bank, which is dominantly more in South and Middle East, gets a lot of remittances. ICICI Bank has a very decent NR book. I think they would see the mix change. Also, some of the PSU lenders can use the ECB route to overall lower the cost of funds. I think that is something we'll see more action coming probably over the next couple of weeks there. So these are some of the preferred pockets. And I think Federal Bank also has seen capital infusion, change of guard with Mr. Manian coming in from Kotak. So I think things are shaping up well. So we've added a little bit more today in BFSI, especially in Federal and ICICI Bank. And we are looking at more PSU lenders in terms of what impact it has on cost of funds. But look, and also the treasury income of the bank. I think that you should keep a close eye there. So there will be some mark-to-market. There has been a MTM impact because of yields hardening. I think the near term you will see yield softening as well, and the amount of money banks will make over the next 90 days in terms of executing this FCNRB. So pretty positive, and I think it's struggling. Entire bank Nifty is 12-13 times earnings, so looks reasonably valued, and maybe a good tactical bounce is up there.
Gurmeet, there is this Tejas Networks, right? Which I was just thinking about it. With Shireen was just talking about, she was talking about the Tata Group dispute, etc. There are 4 businesses which have been highlighted as, the allegation is that, well, they've been underperformers and they've not done well in this, capital allocation. The 3 are unlisted. The only listed entity in that group is Tejas Networks. Highlighting underperformance can result in fixing the underperformance, Gurmeet. I don't know how or what can happen, but that seems to be the direction markets are taking. It's actually bounced a little bit. I think about 25% or so since this entire saga started. The first time it was highlighted, What's your sense? I mean, it's a company with strong IPs. There is no doubt about it. Tata's bought them in 2021 or 22. Very strong player in telecom, but lots of other industries as well, networking for data centers and actually lots of products. Any thoughts here?
There are three issues here. One, the 5G rollout from BSNL got delayed. So they were supposed to do some 5-6 lakh 5G microsite. One site is typically a few crores. So that order book into few lakh sites would have translated into a 3,000-5,000 crore order book that got delayed. And you had accumulated losses, the debt went up. So it was just poor execution after a stellar re-rating of the stock. But and then there's optical fiber network and network equipment, IP-related plays. I think you're better off playing maybe a Bharti Airtel or Indus Income. You want to play that. Bharti also, in my view, not comparable, of course. I think it's just because of largely FI selling. I mean, if you see, remove the capex part and the spectrum dues, etc., I think the free cash flow is upwards of 40,000 crores. And they continuously are adding more subscribers, more than now Jio for second consecutive month. ARPU will improve last quarter because it had lesser number of days. I think it's clearly, plus if whenever the Jio gets listing, Jio valuation is around $130-140 billion. Bharti is currently almost $100 billion valuation, maybe $105 billion valuation. So there are more near-term and long-term triggers there, both in the mobility business, enterprise business, etc., and with the Airtel Africa, IPO as well. And then promoters now talking of getting the stake back to 51%. So I think that, in my view, that's a better secular, less risk-averse way of playing this entire telecom equipment and infrastructure play. And then there is this optic fiber network. Gujarat government yesterday announced 5,000 crores for underground cabling, etc. So a lot of capex happening. So good cable and wire guys, and mainly 5G. I think that's a better way to play it.
Got it. Okay, all right. Let's talk about Wockhardt. By the way, markets almost moved into the green as we speak. So there's a massive recovery that we've seen from the time we started off the show. I think 85-90 point recovery is what we're seeing. The bulls will want to go home in the green. Let's see if that happens. But one stock that's under pressure is Wockhardt. That's down post the investor conference meet. We have Ekta who joins us to detail all of that. Ekta?
Well, yes, the investor conference took place last evening. It was with regards to Zenic, the antibiotic, which has been approved, and it is a novel antibiotic which has been approved by from Wockhardt stable by the US and India. So what they did say is that the expected launch in both US and India is probably in the next 6 to 7 months. Europe would be 3 to 4 months after the US filing. They're targeting 7 to 8 emerging markets as well in the next 18 to 24 months, which would include the likes of Latin America, GCC, Eurasia. India price expected to be 75 to 80% cheaper than the US. US, it could probably go to around $10,000 for a treatment as well. Initially, expect a slower uptake because hospitals will have that adoption cycle. They will be a little hesitant to use it. Eventually, you will start seeing revenues come through or traction come through maybe around FY29. Peak sales potential, $1.5 to $2 billion. And eventually, 12 to 18 months, you could probably see a near break-even or a small profit as well. The management expects around 10% improvement in margins over 3 to 4 years. Company shifting from a generics biosimilars business to being a global innovator pharma company, focuses on novel antibiotics and new drug discovery as well.
Okay, all right, Ekta. Thanks a lot for that. Gurmeet, what do you make of this one? Boki, always a tricky one. The stock, I remember on Monday morning, it started gap up. It was up close to 15%. From there, slam dunk. Big downtick is what we're seeing. Even after this pullback, in the last 1 month, the stock is up 25%. So it appears a bit of sell-on news has played out over here because the stock has corrected 20% from the top, but it's still up 20% in the last 1 month. At around 1,900 rupees, are you interested?
Nigel, maybe better entry points. So other than Zenic, if you see, they have Vicnoff. There's another one which is on bacterial pneumonia. So quite a list of antibiotics they're working on. I think the decision for them is more to build in-house and then other than go for licensing, which means they want to play the longer game. And this could mean maybe short-term bit of, if you may call it return ratio suppression, margin suppression. And that is why I think you're seeing a reaction today that after the commentary yesterday. So it's a question of how they want to scale. And I think the Zenic is after 20-25 years, the antibiotic has come. So maybe at a better entry point considering what Wukat has done in last 2 years, 3 years, but definitely right up there in the radar. I think also a lot of API names, Nigel, because see, yuan has appreciated 22% against the rupee. Moment anybody set up any API fermentation capacity, China used to cut rates. Now with yuan appreciating, China having their own supply pressures, that will play out. That import substitution will start playing out in some of the API names, some of the specialty chemical names. So I think this space is looking now far more interesting after a lot of pricing pressure for almost 2-3 years.
Got it. Okay, all right, Gurmeet, we appreciate you joining in, giving us all of those details. An important point with regard to the currency as well. We keep cribbing that the currency has depreciated, but in the export market, it could be making us more competitive because the Chinese currency actually has appreciated while we have depreciated as well. Better earnings for the domestic names that are exporting. Slip into a short break on the other side. Rupin Rajguru of Julius Baer is waiting for us. He'll give us his take on the markets and stocks and themes that he likes. Welcome back. You're tuned into Closing Bell. You're on CNBC TV 18. Well, it's that part of the show when Hormuz joins us. He puts the spotlight on all the big movers in today's market. Hormuz, take it away.
Today is possibly one of the few days where the index has taken the spotlight over stocks. But of course, there are a lot that are moving in the broader markets. Himadri Specialty Chemicals is one of them. The stock was up around 6.5% yesterday as well. It's extending those gains now, 4.5% higher. So 10% in the last two sessions. Over 2 crore shares have been traded today. The 20-day average is just around about 90 lakh shares. The stock is well above key moving averages. It has remained so over the last 2 months. Almost a quarter of the shares that have been traded so far have been marked for delivery. And in the month of June so far, the stock is up 10%. Yes, the stock was flat in May, but had seen a very sharp recovery after the sell-off in March. It was up around 40% in the month of April. Equities Chemicals is one name that has continued to do well. The fourth straight day of gains for the stock. This gained in 4 out of the last 5 trading sessions. The 9 lakh shares have been traded today. 3x its 20-day average. Close to 40% of those shares have been marked marked for delivery as well. And right from the start of the year, the stock has continued to remain above all of its key moving averages. Of course, as a result of that, the stock is in overbought territory as well. The RSI is at around 74, 75. And the stock made its debut in around September of 2021, issue price of around 610, 620, and the stock is up 5x from those levels. And the last on the downside today, BSE is seeing some profit booking from elevated levels. Capital market stocks continue to remain under pressure today. It declined in 5 out of the last 7 trading sessions, has BSE. Today's session over 55 lakh shares traded. The 20-day averages are under 40 lakh shares. The 50 DMA on the downside, the next level to watch 3605, still some distance away from there. A third of the shares that have been traded so far are marked for delivery, and BSE today is the most traded stock on the Nifty 500.
All right, thank you very much, Hormuz, for that. So those are some movers from what's happening today in the broader markets. Rupen Rajguru is with us. He's head of equity investments and strategy at Julius Baer India. Rupen, good to have you with us here. Thanks for joining in. So let's just start with financials as a space and NBFCs in particular, because you know the swing both ways. They get hurt the most. They benefit the most because they pay more for deposits as compared to banks. What do you own there in that space? What do you like in that space? NBFCs in particular.
Hi, afternoon, Prashant. You very rightly said that NBFCs do tend to get impacted in a big manner, in a changing interest rate environment. So while in today's context, the status quo has been maintained by the RBI, but they have left a room open for a rate hike sometime towards the second half of the year. That's what our sense is. Within NBFCs, typically, we like diversified NBFCs. So NBFCs which are present into various segments, and they have developed their own niche. Some of the large NBFCs, and the cost of funding to them is definitely much better than the smaller NBFCs. So some of the large NBFCs is what typically we like. And apart from that, we also like home financiers, which are again housing finance companies. So those again, it's in an environment in which there is a little bit of uncertainty. I think we prefer secured assets. So HFCs do qualify in that. But to sum up, in the current environment, our preference would be towards large private sector banks vis-a-vis the NBFCs, because those banks which has a strong liability franchise, they tend to benefit in a environment where the interest rates tend to go up. So those would be a big winner according to us.
All right. Hi, Rupen. Good afternoon. Good to see you in. I think we're speaking after a while. It appears that you are factoring in probably that we are towards the end of the cycle, and hopefully of this entire war actually, and hopefully things actually recover from here on, which would mean that crude oil prices slip. In that case, it appears you're quite optimistic on OMCs. It's a good tactical trade.
Yeah, hi, afternoon, Nigel. And yes, let's hope that this war ends sooner. As we speak, we are more than 90 days into the war, and I think nobody initially expected that it will go on for so long. And if we go with the premise that the war is going to be ending pretty soon, which are the obvious tactical play, definitely OMCs come into picture. So OMC as a stocks have been moving down since the war has begun. But over last month or so, we have seen steps taken by the government. Government have hiked the prices, so that should cushion the OMCs. Also, they have set up the ATF stabilization fund, and as well as if the oil prices were to cool off from here, definitely there would be a good leverage play on that. And finally, if I were to look into the valuations of these OMCs, which probably before the war they were at say 1.7, 1.8 times price to book, they have now come down to say 1.1, 1.2 times price to book. And typically, in a normalized environment, that is a good time for anyone to get into those stocks. So yes, if there were to be any news flow around the war, and let us all sincerely hope that there is a final resolution to this, OMCs would be a good leverage play or beta play on that.
Okay, all right. Got that. OMCs. The other space that I believe we're looking at is defense. Now, in the kind of geopolitical scenario that we have been, faced with, both this year, I think the last 3 years as well, I think have been very, very rocky. Defense stocks, they're not cheap right now, but it appears globally there are going to be tailwinds, as well as domestic spend as well is going to go up from our government. Do you believe that this theme is something that you would like to play with a longer term view?
Nigel, 2 or 3 big themes globally which we believe will play out after the uncertainty, geopolitical and post COVID and all other factors. So one, yes, as you rightly said, defense is one theme because after the Ukraine war, clearly all countries which were under the umbrella of US security, they suddenly feel the need that, okay, that security is not going to be there and let us now develop our own capabilities around that. So that's one theme. The other theme, which has more come into picture after the West Asian crisis, is the energy security theme. And finally, food as a theme, because ultimately, if the supply chains are getting disrupted, I think one of the basic requirements of food, fertilizer, those, is another big theme which has come up. So specifically talking about the defense, you're absolutely right. And India has recognized it. And, in last few years, the Indian government has made phenomenal efforts to get into our own manufacturing, and not only manufacturing, but also exporting. And even in this year, almost 5 to 6 lakh crores worth of tendering is expected, which will be not this year, but over next 2 years is expected. So the order books of all the companies related to defense, be it on the manufacturing side, be it on electronic sides and all, are pretty much full. And you might be also getting more order flow. So that's definitely a very strong theme to play for next, probably 5 to 6 years, because this is here to stay.
I got that. This is here to stay. Well, thanks very much, Rupen, for joining us. Good speaking with you. Have a good weekend, restful one, and we'll see you back on Monday. But F&O data and what's moving there, Nigel, take it away.
Looking forward to the restful weekend. Got an eye on that one.
Not an exciting weekend.
Rest is important, I think. But let's talk about the markets then. We're still lower again, 60, 65 points thereabouts. So one factor the bulls will clutch on to is the India VIX is not perking up. Now that's normally a sign that maybe in fact the fear is a little bit cooling off now. Because normally those two have an inverse relation, right? Markets are down, Nifty is down, the VIX should be up. But that's not happened. So that's one encouraging sign. The other encouraging sign is the Nifty Bank, it appears to be putting in a bit of a fight. If the Nifty needs to fight back, the Nifty Bank needs to put its hand up. And today the encouraging part was it went to 54,700. From there, it did see some selling pressure. But it's very close to those technical levels. It needs to get past that. That's what will trigger a bigger short covering bounce. But the options data as well suggests that the bears, they want to defend this 23,600 mark. I say that because the premium on the 23,500 call, it was $150 yesterday. It's come down to around 92 rupees. So there is writing on that particular strike. Even when we were higher by 20, 30 points on, the premium out there was lower, telling you there is writing. Even if you look at the 23,400 call, premium has come down, $200 has become 134 rupees. So writers, they are comfortable. They are eyeing that 23,600 mark that it doesn't get breached on the upside. However, a dip towards that 23,200 is going to invite buying. The reason I say that is because the premium out there is around 130 rupees approximately, and at around 130 rupees, you'll have to say the smarter money actually is writing that particular strike. At the lows of today, it was 50 rupees. So there was some put buying earlier, but now it appears there is some writing on that particular aspect. 50 DMA on the Nifty will be important. That's the first reference point out there, comes in ballpark 23,650. Individual stocks that are in focus, well, you have REC. That's coming for a bit of a short covering bounce. Remember, the stock has corrected a goodish bit from the top, but the shorts seem to be getting squeezed out. And from the banking names, Yes Bank has spent a lot of time in this 20 to 25 odd mark. But that's seeing some fresh addition in today's trades, long build up out there, and some shorts getting built into sale. Now we'll have to see whether or not there is just some routine profit taking that's taking place on sale, or if in fact there is some change in terms of the fundamentals. But there are some shorts in the system on that particular name. Well, time to slip into a short break. Come back. Final 30 minutes of trade. Nimish is waiting by as well. He'll tell us what he's picking up in D-Street Chatter.
Okay, welcome back. Well, Adani Group stocks are back in the spotlight on the back of those block deals that took place last month in May. I mean, they were worth some 15,000 crores, have changed hands. Well, let's just look at who are the buyers and sellers. Sud has put this together. So take it away.
So as you have said, in the last 1 month, Adani Group shares have seen block deals of more than rupees 15,000 crore, or say $1.7 billion. And some of the major buyers included Capital International, SBI Mutual Fund and Birla Mutual Fund. So I'll start with Adani Ports, which had seen block deals of more than rupees 7,400 crore in the month of May. And seller was Worldwide Emerging Market, while buyers, first buyer Capital Group, which had bought shares of more than rupees 4,600 crore. And another buyer was Euro Pacific Growth Fund, which had bought shares of more than rupees 2,800 crore. Adani Enterprises too had seen block deals of more than rupees 1,400 crore in May, and seller here was GQG Partners and buyer was SBI Mutual Fund. Remember, even in September 2025, SBI Mutual Fund had bought shares of more than rupees 2,300 crore in Adani Enterprises via block deals. Another name, Adani Energy, which in the month of May had seen block deals of more than 644 crore. And here the seller was Qatar Holding LLC and buyer was Birla Mutual Fund. Even today, we have seen block deals in two major companies. First, Adani Enterprises, where block deal was worth rupees 4,800 crore, and Adani Energy, where block deals were of rupees 960 crore. Details of today's block deals, basically buyers and sellers' name, will only get to know in the evening when the NSE and BSE data come out.
Okay, got it. All right, Sud, thanks a lot for putting all that data into perspective. Let's hop across to Nimish, who's going to tell us about D-Street Chatter. Nimish, before we get to that, you want to throw some color on what Sud had to say?
Well, Sud already said that you'll get to know the data towards the end of day today in the BSE NSE disclosures. But my sense is there was a single buyer and a single seller. The seller was a large FII, and a buyer was one of the leading domestic mutual funds. So let's see whether it will get disclosed because it happened in the block window. So disclosure should happen. And maybe that's the reason why it will get impacted in the FI data as well, because the seller, to my understanding, was the largest FII, and the buyer was a domestic mutual fund. So it will get reflected on both sides, on the FI side as well on the DI side. So that's basically the feedback as far as the Adani blocks today are concerned. Almost 5,600 crores, so it's a large amount which will get reflected in the institutional data.
Got it. Okay. All right. So that's about that. But run us through the remainder of the chatter then. Flows, how are you seeing things shape up, and then maybe you could fill us in with stocks as well.
Well, Nigel, it's been a volatile day of trade, but at least from a policy point of view and post-policy action point of view, my sense is there is a bit of buying interest back in the financial names. So large PSU banks, private banks are well bid by the large institutions. So maybe it will reflected in the data as well, and that's the reason why while the Nifty Bank is also volatile, it's up almost 0.5% in today's trade. A bit of profit booking, I would say, in the metal names. The index is down nearly 1.5%. No specific reasons to it, but largely it looks like a profit booking after the recent run-up in the metal names in today's market. There is a small MOC sell basket again in today's market, so that will have an impact on some individual names. Largely, it's restricted to the large cap Nifty names as far as the MOC sell is concerned. But broadly, I guess in today's market, apart from the large block deals, if there is a buying interest, that largely seems to be towards the financial names.
All right. What about individual names, Nimish?
The first stock on my list is Kalyan Jewellers. After a long time, some bit of traction seems to be in Kalyan Jewellers. It's up buzzing in trade today, but my sense is at least one of the leading family office has turned buyer in Kalyan Jewellers. Some accumulation is happening at current levels in that particular stock. Second name, as I said, there is a bit of MOC sell. What stands out is Vedanta as well as Ashok Leyland. Both the stocks are going to see selling pressure towards the end from a leading FI. So maybe it will show up in the institutional data and in the delivery data as well. So selling pressure in Vedanta as well as Ashok Leyland. The third name is Schaeffler India. After a long time, some bit of interest is back in that name as well. There are block bids indicated from larger institutions in Schaeffler India. So it looks like there are some buyers at current levels in that name. And the last is Meesho. As I said, every second day you're going to see large block deals. While Meesho has been consolidating of late, expect a very large block in Meesho as well very soon. So that's something to track in Meesho. A potential private equity seller in Meesho, which is likely to come very soon.
Yeah, absolutely. Nimish, so just to link two things completely unrelated, the buyer in Adani stocks and the buyer in Meesho is this. Meesho a few days back is the same.
I'm not sure who's the buyer in Vishwa Prashant. So, anyway, so disclosures will come as far as Adani stocks are concerned. As I said, it happened in the block window, so it'll be an institutional, interest on both sides. So,
and I think with Misho, what you're saying is there's a large block coming, but I think the lock-in is ending, right? Perhaps that's what's happening there. Yeah.
It happened. I think the lock-in is ending early next week. So after that, you'll potentially see a large block coming with.
All right. Let's just do a quick check on Z with Nimesh. Nimesh comes up at 3 and we look at Z.
I have nothing more to add, Prashant. I mean,
oh dear. I was just joking.
We first highlighted.
It's up 8%.
Well.
It basically was part of Nimesh's chatter list a few days back. And there is the FIFA excitement, etc. I mean, there's news there. But it's done quite well, very, very quickly. I think from about 70-ish, it's added about 50 rupees in a short order. Nimesh, thanks very much for that. There's 16 minutes to go for close, but Rahul is back with us as we always get some trading ideas here and now. These are short-term ideas. Rahul, what do you have?
2 or 3 observations. I was seeing, Coal India, that's a stock that's taken a bit of a hit today. We've got a close to about a 2% drop. I'd utilize, drops like this to probably enter the stock. And the reason I say this is we've got some very strong support at around 430, just from a super long-term perspective too. And, when you look at the kind of volumes it did a week ago, it's probably one of the highest volumes we've seen in a decade, probably. Maybe the top, if not the second highest. So I think it all points to the fact that there is something, brewing here, and use, declines to get in, keeping in mind that 430 solid support, which is there on the long run. Amongst the heavyweights, another observation, I think what would pull the Nifty down, since I did talk about the Nifty slipping, I think Reliance could be one of those big boys which pull it down. 1245, 1250, that's a target I'd peg on Reliance. So I think even from here, one could be looking at a bit of a downside. If you're looking at a bit of an aggressive buy, and this could be a little risky, that's why I use the word aggressive, it could be a stock like Tech Mahindra. Tech doesn't look good, but, I'm seeing signs of, some potential pullback move. So if you keep a, clear stop loss at 1460, you could even shoot for 1540. Again, this is an aggressive short-term call here.
Okay, 1460. That's the important mark on the downside. I'm just throwing this at you, Rahul. Prashant and Nimesh were just talking how they just highlighted that stock. One-way move after correcting big time, 70 to 112 rupees. It's got momentum, it seems, but does it have enough to go even higher from here?
I am of the view that Z actually had a very good breakout, not just price-wise. When you start looking at the kind of volumes it did over the last 3 or 4 sessions, I think that's what speaks a lot to me. So where can it head to? About 125 is where I'd peg the target. I mean, is this an entry point? No. I think we're a bit late on it. You have been probably seeing this on the radar for a couple of days now. But, at these levels, I would be a little circumspect to enter. But, if someone's already into the stock, I'd say 103 is a good stop loss to move with if you're a short-term trader.
Yeah, no, absolutely. Good calls there, and a good strong view. We'll, mark the views to market a little later next time you're on, Rahul. But appreciate it, as always. Let's look at the RBI policy from a macro-ish perspective in terms of what the real thrust was. Latha, of course, was the first one to ask the governor about it. Latha, welcome back to the studios. Eventful day and a really buzzing policy.
Yes, we are not talking interest rates, we are not talking inflation, we are all talking rupee. And what a bunch of, announcements. Everything that was being speculated was announced. ECBs, FCNRB, just the whole lot. And, of course, the tax cancellation for FPI debt also came at the same time. And, of course, by design, even the small encumbrances on FPI debt has been removed. They had small short-term bucket, long-term bucket within each bond. All that removed, more bonds available. Just everything has been thrown at them. And that is clearly showing in the currency. Almost a rupee cheaper is what the dollar is. It's about 0.9%. And it's not just that it is 0.9% stronger. It is stronger on a day when all Asian currencies are either weak or at best flat. This kind of an outperformance, I can't remember in a very long time. Now, what can this bring? This FCNRB scheme, that is foreign currency non-resident guys sending money to an Indian bank, that was there, of course, in 2013 as well. At that time, we had got about 25-30 billion. The expectation is the same amount can come in the very least. Of course, now there's competition from, say, a US Muni bonds. They all give even more than the 4.5 that US Treasury gives. But nevertheless, you're going to get, with the hedging cost, over and above what even a AAA mortgage bond in the US will get. So the expectation is at least the same amount will come. Under the ECB route, all PSUs, so, you know, Coal India was rising. For all you know, Coal India could be allowed to raise. Of course, SBI, BOB, PNB would be going out to raise. But you will have PFC, you will have NTPC. The guys who have even otherwise gone to these markets, they get about a concession in their hedging cost. And, you know, the beneficiary of all this is also the corporate bond market. Today, the CD market and the corporate bond market saw yields fall by about a 1/4 percentage point, 25 basis points. Why? Because when this money comes, where will you park it first? You'll park it in corporate bonds, right? And when you are getting money, when banks are getting money, this kind of money, FCNR deposits and ECBs, then why should they pay high on CDs? So CD rates also fell. So there has been a positive impact for the borrowers as well in the market. But the biggest one is exporters. They've been asked to bring their money ahead. Now, if you're an importer, until now you would think like, let me go and hedge, let me go and buy the dollars because tomorrow it will be more expensive. If you're an exporter, you would say, let me not give away my dollars. Tomorrow I may get a better price. Now you're thinking the exact opposite. So that is another, the Reserve Bank intervened to the extent of 150 billion last 1 year, if you look at the data. But actual BOP deficit was only 30 billion. Where did the other 120 billion go? It was this extra hedging by importers. Now that becomes exactly ulta. They stop hedging because they expect it to get cheaper, and exporters will come in and rush forward sales because who knows, today 95, today may be the last day LC 96, today it ends at 95, tomorrow it may go to 94.5. So there is this reversal that is happening in the market, and this was already smelt by the NDF market. Today the NDF 1 month forward rate is lower than it is in the onshore market. To that extent, the mood has changed. And therefore, you can see this rupee rally, and the mood in the market at the moment is 93, 94, don't rule out.
Got it. All right, Lata, thanks a lot for that. Not a bad time to have a relook at the foreign travel. Huh? All right, I'll do that since you gave me permission. End of this month. Let's do it. Okay, let's shift focus then to general insurers and how they are fared in the month of May. ICICI Lombard seems to have outperformed the industry with 11% growth. Yash is the expert out there. He joins us to fill us in with the quick analysis. Yash, take it away.
Well, it's a quite strong outperformance which ICICI Lombard has posted in the month of May. It has become the only listed general insurance companies to show any kind of growth in the month of May. And it's not a very marginal growth that we're talking about. It's a good double of the industry average growth which ICICI Lombard seem to have posted. As far as specific numbers are concerned, the premium for ICICI Lombard in the month of May has grown by about 12%. Industry average growth in the month of May is just about 6%. Let's speak about another listed company, Go Digit General Insurance. It has reported a decline or a drop of 1% when it comes to premium collection on a year-on-year basis. New India Assurance, the premium collection is flat on a year-on-year basis. Now let's speak about standalone health insurance companies. The industry average is about 32% growth in premium in the month of May. Niva Bupa has done 30% growth in its premium collection. Star Health has grown its premium by about 19%. So as far as the industry growth rate is concerned, ICICI Lombard, clear outperformer, and of course, growing ahead of the industry, almost double of the industry average growth.
Well, thanks very much. Life numbers expected when, Yash?
Hopefully, first half of next week.
Okay, all right. Well, thanks very much for that. We'll take a break. We're back. More on the other side.
1, 2, 3, 1, 2, 3. 3 number here. 1, 2, 3, 4, 1, 2.
Welcome back. I think Anand Tandon is with us for a quick chat. There's about 3 minutes to go for close. Anand, sorry about coming to you a little later, but these RBI measures, you think, the thing is equities are down 50-odd points despite everything which has been announced. So typically on good news, bad price action is not a great thing. But you can argue and say all these measures are for the debt side, debt flows, not very much anything on the equity side. But how would you read it?
Well, I won't put too much stress on the flows alone. I mean, clearly, like you said, the measures are for the debt. However, it will ease flows into equities also. But see, the point is that we think of it as in isolation. Just because we have decided that suddenly we like foreign debt doesn't mean foreign debt doesn't have other opportunities. Don't forget that this is a year where the new US Fed chair has indicated that they may want to reduce their balance sheet by a small amount of about $2 trillion. Now, if you're shrinking your balance sheet by about $2 trillion, and even if you do it over the next 2 years, it is quite unknown what the impact of that in the US interest rate is. At best, it will not spike up. At worst, it may actually surprise on the upside. We still have the tightest spread between the Indian interest rate and the US interest rate for a very long time. Why do you think it is suddenly very attractive to be investing in India, given the general outlook?
Yeah, it's a dire prognosis, Anand.
It's not a prognosis. It is what the man has already said. We are going to shrink the balance sheet. It is currently $6 trillion is the US Fed balance sheet. They have put out a paper which says that between $1.6 to $2.1 trillion is possible to be shrunk without creating too much of an issue by reducing their reserve requirements. whether that will impact the market, I don't know. I mean, theoretically, it is supposed to be done without pain, but I have never seen it done without pain. You would therefore assume that they will actually go ahead with it. There will be some ruckus in the US market. We are not going to, just because India has, the bureaucrats here have decided that, oh my God, we shouldn't charge interest, charge income tax, doesn't mean people are rushing in with bagfuls of money.
But if you make it attractive, people will put in money, right?
For sure, provided it's attractive enough. Like I said, what is the
this
spread that we
FCNR,
have
for example,
between the
it
two
can
interest
get in
rates
30,
and
40
the
billion
inflation?
dollars now. Is it enough is another question. Does it solve the problem is another question. But the money will come.
I doubt whether much you'll get anywhere close to that, but then we'll see.
Yeah. But, it's if you offer a high enough rate, right, and you subsidize hedging for banks here on the dollars which come in, we'll see. But there are all kinds of estimates. No way to tell, right? We'll, of course, know in hindsight. But, Anand, the point is broader markets, I think that's the close. Let's just take a couple of more questions with Anand while we show the closing on the side of the window. Anand, taking this broad view, look at what's happening with broader markets, and on the editors roundtable in the next 30 minutes, Nimesh is going to put out a piece just looking at the sheer outperformance just this year in 2026. And this is not focused in just one area. It is the non-FII stocks, if I can put it, where there has been humongous runs.
Yes, there is. And that, to my mind, is a function of liquidity. One thing I learned very early in my investing career is that when you look at the broader market, it behaves like, it has what Mr. Soros used to call reflexivity. That as the market goes up, the performance increases, and the performance increase moves into the market. Now, whether it is because of the fact that capital becomes cheaper and therefore you are able to generate more output out of that capital, or it is because, suddenly the promoters find that it is better that you have more earnings rather than more private earnings, is a matter of discussion and has changed over a period of time. However, by and large, when you are looking at the market, we have to agree on looking at one index. And the reality is that the index one looks at is the main market index. Can you, in 4,000 companies, figure out 2 or 3 companies which will do great? Absolutely. There is never a challenge on that. The question is, can you consistently build a portfolio where you can put a significant portion of your net worth and then go to sleep with that kind of position? That is where you require. A few investors can, most people can't. And that's the reason why you have diversified portfolios and diversified returns. Therefore, to focus, I keep seeing these kind of reports. Oh, if you knock off these 2 sectors, the index has actually done very well. Sure, if you knock off all the underperformers, it will outperform. But, that doesn't tell you anything. The reality is you have a portfolio as an investor which is reasonably diversified, and you are going to get near diversified market returns. And that is what has to be used as a benchmark.
Yeah, but that's the point. And I wish we could speak more, but it's not a narrow set. It's not 3 stocks, 4 stocks, 5 stocks. It is a very large number of stocks which have done very, very well. So, yeah, if you are... but I agree with most. I don't fundamentally disagree with what you're saying, Anand. But I want to push back on a few, but I don't have time to do that. So I'm going to say thank you. Appreciate you joining in, and we'll chat again with more on this. Have a good weekend. It's a wrap of this edition of Closing Bell. Done for the week. Down mostly across the larger indices. Editors Roundtable on the other side.
The Wall Street closed lower for the second consecutive week, with the Sensex and Nifty losing about 0.5%. The mid-cap index underperformed the benchmark, while bank stocks emerged as a pocket of strength and outperformed the broader market. Over the next 30 minutes, we'll decode the week's market action. We'll analyze the RBI's monetary policy decisions, the implications for investors, discuss the continued resilience in the broader market, and take a look at the rally seen in kitchen appliance stocks. Hello and welcome to Editors Roundtable. I am Rima. With me are my editors Prashant, Nimesh and Nigel. And joining us here on the show today is Sandeep Tandon, founder and CIO at Quant Mutual Fund. Hi guys, it's been a very volatile week, but a big week.
Absolutely. I guess all eyes were on RBI policy, and I think it's delivered on what the street expectation was. So maybe a bit of profit booking towards the end because...
But a little disappointing, right? I mean, the RBI did what they could, but yet, you know, the Nifty Bank did okay. But on the whole...
But it rallied before the policy. So there's a bit of an anticipation that what RBI is going to do. And since it got done, I guess there's a bit of sell-on news or a bit of profit booking. So I guess markets will react on Monday because everybody will write over the weekend, right, as to what the real implications are, what it means for banks, for NBFCs, for housing finance companies. So I guess some reaction will come probably next week.
I think RBI is done now to the government what they can do or
support. Yeah.
And that is the big one, right? The equities taxation. I'm not saying something will happen, but you know, till it happens, people will keep talking about, well, what can happen? That's the nature of things. But I was just looking at the changes for the week, right? Nifty is down 3/4, mid-cap index is down about 1.5, small caps are flat. Yeah, so it's not... Lots of action. I think Nimesh is
small cap.
Today.
Yeah, I was about to tell you that small caps are flat, but it's not. It doesn't give the right picture. There is a unprecedented bull run happening in the small and mid cap.
So that is the
that data out later.
You know, Gautam Shah today on from Goldilocks said there is a raging bull market in the small caps and micro caps.
And that'll show up in the data that I'm putting out later.
So when I said small caps are flat, that's what the flat is, because others are down 1.5, 2. When the Nifty is down, Nifty Bank. But small caps, just look at, and this is not an exhaustive list, Z is up 20, just this week, Z is up 21, CP Plus is up 20, Concord Bio is up 16, there's Acme Solar, which is up 15%. So it's a really long list of at least 10% and more kind of gains which have come through. And I think that's the point. So we may sulk about macros, and I mean, generally the sentiment is, I think the sentiment is also not bad, is also a little poor because of the macro stuff, right? Oil is up, and yeah, it's real. It's all real. But you know, the broader markets, there's a wide swath of outperformance which is very much underway. Let's bring in Sandeep Tandon, who's with us, founder and CIO of Quant Mutual Fund. Sandeep, good to have you with us here. Thanks for joining in. So just that point, Sandeep, if you will, and Nimesh will outline the data in just a bit. But how would you read it, the performance? Because index, if you've been invested, the Nifty, yeah, it's flat. But otherwise, you know, there have been doublers, treblers this year. And I'm not talking about one or two names.
Yeah.
So frankly speaking, Prashant, right from 1st April, we have been saying that this is time to capitalize, not capitulate. Okay. And we have talked about that best opportunity is micro cap, followed by small, then mid, and then large. This month's fact sheet, we have talked about ignore the indices movement, you just focus on the stocks. So what is the crux of the matter is, given the geopolitical environment and given the changing perception about India, I think stock-specific opportunity will play. And it's not fair to say that FIIs are net seller. When you look at the gross or net number, it looks, but they have been buyer also in certain sector. So I think the way I look at it is a theme-based opportunity which is there in India and across the globe, and people are participating. So I think that's the way one has to look at your portfolio, rebalance your portfolio, given that opportunity is very limited and everybody wants to participate, and given the high impact cost, you will see a far bigger impact also on the price movement on both the side. And that's the way I'm looking at it. Will be a stock specific opportunity, and we continues to remain more bullish on mid and small caps names as compared to large cap, which is largely distributed over-owned names. Okay, and we have to also look at from FII perspective, it's not about absolute returns, it's also about relative opportunity for them, and that's the way where we have issues with India. The relative opportunity is far more attractive somewhere else, plus rupee movement. With that, obviously create unwarranted pressure on the Indian equities.
Hi Sandeep, you know, you spoke about FIIs not selling across the board. In fact, there have been buyers as well in some of those names. You know, in the last one, we just put out a data in the afternoon show. In the last 1 month itself, in the Adani Group stocks, there has been buying of close to 15,000 crores from the likes of Capital, the likes of SBI Mutual Fund and all. You've been a buyer into Adani names way earlier. What's your view on the group now? The fact that there has been a final settlement with the US. Any view on this group?
I will make a very generic comment rather than stock-specific comment. Okay.
Of course. See, of course. Broadly on the group.
Yeah, this group has a very large presence in the India infrastructure come energy transition game. Okay. And if you really look at what is attracting money from the foreigners' point of view, people are looking at asset-heavy business, okay? So real assets, what they're looking at, because intangible assets or AI opportunities not there in India, and they are the biggest beneficiary. And if you even look at our own portfolio, which is obviously skewed towards power, because we were also playing a very meaningful data center opportunity, and obviously the biggest opportunity data center is power, followed by telecom or cable or maybe unique stocks you can talk about. So obviously this group has its own advantages. And the most important aspect is that under ownership. This was most hated name on the street, grossly under-owned. Okay, and given the weightage it has in their overall portfolio, so it makes sense. And as a reason, you have seen a massive move coming in these names.
Okay, in fact, let's just try and understand and gauge the kind of rally that we've seen in some of the small caps and micro caps. Nimish, you've done the number crunching?
Oh, absolutely. So as I said, forget the geopolitical risk, forget all the oil concerns and macro concerns. The broader markets have seen an unprecedented bull run in the last few months. I'll just put some data out as to how the bull market has been in the broader market names in the last 2 months itself. So just look at the data now. Since April 1st, this is the data from Y2D as well as April 1st. Look at the April 1st data. The mid cap index is up 15%, small cap index is up 19%, micro cap index is up 26%, vis-a-vis Nifty and Bank Nifty up 4 and 8%. So big outperformance in the broader market names, mid cap, small cap, and micro cap since the April 1st. So that's a kind of index return that this indices have seen since April 1st. So that's the first kind of data. Now look at the individual names, the outperformance. This is broadly the stocks which have hit 52-week highs. Within the BSE small cap index, 41 stocks have hit 52-week highs as of today. In the micro cap, 9 stocks are at 52-week highs, and in the mid cap, 3 stocks are at 52-week highs. Compared to Nifty and Bank Nifty, hardly any name which has still hit a 52-week high. So that, in that context, the mid and broad cap have done very well. This is the first set of data, the BSE small cap index. Look at the kind of gainers since April 1st. Sterlite Technologies is up 250%. HFCL is up to 156%. United Foods 160%. Idea Forge has finally now moved up 150%, and so is D Developments. The management spoke to us in the morning. It's up 150%. So that's the small cap index and the big winners there. Now look at the micro cap index and the big winners in that space as well. Black Box is up 142%. APL Apollo Micro is up 130%. MTA Tech is up almost 117%. Balaji Mines, Lloyd Engineering. These are the few names in the micro cap indexes which have rallied pretty hard since April 1st. The next list is the mid cap index and the mid cap stocks as well. And these are some really bigger names in that list. In the Nifty mid cap index, Vodafone Idea is up 75% since April 1st. BHEL is up 58%. Hitachi Energy 52%. Oracle is up 48%, and Tata Communication is up 47%. So, big movers in the broader market names. As I said, while there is so much of talks about geopolitical risk and oil going up and macro challenges, a lot of the broader market names have done really well. I want to ask, if he can talk about it. Sandeep, your call, because I believe you have exposure to some of those cable businesses. Anything that stands out in that list that you've been owner of and has done very well for you all?
So Nimish, what we have to look at, don't look at India in isolation. Look at what happened in China in the cable company. Okay, yeah. Stock has rallied 8 to 10 times out there. So obviously that is the impact you are seeing out there in some of the listed names out here. Though the size is still a big concern as compared to some of the global names when you talk about Chinese name, where our size is still not there. But obviously, as I said in the beginning, every foreign investor is playing a theme on a regional basis. Okay, if some of these stocks are qualifying in the theme, you will see sharp movement in these names, because in fact, some of the companies I have seen that they have not even met the management. The stocks are not under coverage. Still, some of the FIIs have bought. So what is the logic? Logic is simple. They are part of a bigger theme, and they are taking a regional exposure rather than just looking at country-specific opportunity. That's the way I look at it. And I think if you can identify some of these winners, your portfolio will do very well.
So Sandeep, anything that stands out which is doing really well in the global markets, and we should look at from an India perspective as well? You spoke about the cable companies and all. They've done phenomenally well. Any further sector which stands out for you of late that has done very well in global markets?
I think what people have missed out is the telecom companies also. Okay, because when you get into data centers, telecom companies,
okay.
telecommunication
Black box,
companies.
sure.
Okay,
Yeah.
so whether you talk about the large listed names or even the mid and small also, telecom companies should also, they have not benefit up to that extent in the move which we have seen in India. I think that is also a big beneficiary. So that's the one thesis which I can talk about. And second thing, what's very important to understand that the data center is still in the beginning stages only, the very early stages. But the challenge is that stock have rallied a lot, valuations have gone to the roof. So one has to be very stock specific opportunity. So one has to be very clear, these names will be buy on dips rather than sell on rallies, because everybody wants to participate. So in any downfall, like say today talking about Taiwan or Korea, they're becoming buy on dips where India is right, sell on right. That's the way this thesis is playing out. But I just want to highlight one very important point. The way we look at is that US market particularly, and if I have to talk about Korea, Taiwan, I think we are seeing signs of euphoria getting built. Smart money is moving out. Okay, so there could be, I'm not saying very meaningful correction, but I expect even Korea, Taiwan has a potential to correct and consolidate from this level, which could be a great opportunity for India, because money from India has been shifted towards some of these emerging market name and where weightages has moved up. So if this market corrects, then we as a country will be beneficiary. So I think I will look for a buying opportunity in India rather than saying that, India is underperforming. And even in, let's say, last 2 months, you have seen how mid and small has performed, but our own portfolio has outperformed the benchmark decisively. So that gives us confidence that if you are able to identify the right sector and some of the stock-specific opportunity, I think returns could be meaningful.
Yeah.
Guys, I was just, this is a conversation which I guess we need to have more, but data centers, right, as Sandeep also pointed out, all these not hundreds, but tens of billions of dollars of data center investment which is coming into the country, what is the value add here in India? Because land is being provided at a subsidized rate. Yeah. Power perhaps is coming at a subsidized rate. So, but I don't know if there are any, but by the way, the tax holiday, for example, the tax holiday is for data centers out of India for data from overseas. It's not for data here in India. So my only thing is data center is like at the finish line. Yeah. But till the finish line, there are all these things which go into the data center, right? And I mean, yeah, L&T will probably make some concrete structures or whatever, right? But the only question I'm asking is there like a supply chain being built? When we hear $10 billion, what part of that $10 billion is going to go into ordering Indian equipment and all the other things which is required? I don't have the answer, but I've not seen a formal kind of, in defense, for example, there used to be this offset agreement. You order out $10 billion worth of equipment or whatever, and the company will have to do something worth, say, 50% of that value here in India, right? Defense offset. So, but I've not seen anything in a formal structure like that. So yeah, these are very large numbers we're talking about. But is there a big multiplier effect or a value add? And these are not people-intensive businesses. You don't need thousands of people to operate a data center. Sandeep has got investments there. I mean, in black box, as we highlighted earlier. Sandeep, you have an answer to this? Quick one.
Frankly speaking, nobody has any perfect answer because in the very early stages, many companies are trying to position themselves to take advantage of this opportunity, but it's very difficult for us to quantify because, as I said in the beginning, India is not in that league, okay? But there are few opportunities. One of the names which you mentioned, you have to identify these names,
But by the way, Sandeep, a black box story is also in the US, right? I mean, they are building all this in the
Predominantly US, okay?
Predominantly US, yeah.
Yeah, you are absolutely right. But I think the way, if you have US experience, so obviously if you set up opportunity, if you see opportunity in India, you will get the benefit. I think the way team has to played out, people who have exposure, set up the data center globally, and who've been part of this journey for, let's say, last 5-10 years, I think they will be big winner. And apart from that, you also look for some of the opportunity, what happened in the Middle East recently. A lot of data center was affected purely from a security perspective, and they're more vulnerable now. And hence, a lot of new data center will open up in India. I see that is a very big opportunity which will play out. We may not have any real AI play, but data center opportunity will be very meaningful, not only from Indian companies' point of view. We can have potential to become the hub for the global also, given the changes happening, and India is relatively more stable, and we have ability to demonstrate. So more from a energy perspective also, we can do that.
Just one limited point. A company like STL, which you spoke about, right? 250% rally from 1st April. Last year, the EPS was 1.1 rupees, 1 rupee 10 paise. The stock closed at 600 rupees plus, even after the 5% lower circuit on Friday, which means trailing EPS is at 550 times.
Oh, absolutely.
550 times.
Valuation.
Assuming it goes up, the EPS goes up to 10 rupees. We're talking about 8-9x. Even then, it's going to trade at 60 times. FY27 PE, just because there's such few names in this entire data center play.
People are betting on the large order win that they've got, and the assumption is that over the next couple of years...
It's a product award letter. It's not yet an award win, but it's one step before that.
Step forward. And the anticipation is that maybe they'll get some similar large orders. So the TAM could be quite large, and maybe that's why people are betting on it. But yeah, I completely agree to your point. You know, a lot of the stocks...
It has to convert yet, and...
But valuations are crazy in many of these names.
This year. Yeah. I think 100 to 600, right?
500% up, yeah, 6x.
Yeah. All right, we'll take a quick break here. We'll just come back and we'll sort of spotlight the kitchen appliance stocks. There's TTK and there's all of these other names which are doing very well. Another space which continues to fire up. So on the other side, coming up.
Welcome back. You're tuned into Editors Roundtable here on CNBC TV 18. Well, there is a debate whether or not the markets are going to hot up or not. But it definitely appears that the kitchen appliance makers, well, they are heating up. And this is post a very, very sharp correction that we've seen in the recent past. So the question is the kitchen space finally heating up? And I say this because some of these stocks, Prestige is half from the top. You have Stovecraft that's down close to 40% from the top. And you have Hawkins that's down close to 25% from the top. And to be fair, just take a look at the growth in the last few years. On a CAGR basis, revenue growth has been in single digit. And for a couple of them, it's actually been in low single digit. So the question is, are things now coming together for these companies? Let me explain a few factors. Because of late, you've seen some interest in these stocks. Now, these are the broad reasons why, in fact, you are seeing that interest. First up, induction cooktop. Because of the surge you've seen in gas prices, there is a surge in terms of demand out there. As a part of their portfolios, well, for some of them, it's not too large, but there's a lot of focus out there. And remember, induction cooktops actually are margin accretive businesses. Besides that, the government is looking to shift cooking from LPG focus to electric, and that's going to obviously help some of these companies. And remember, in COVID, that's in 2021, these companies had a brilliant year. Now it seems replacement demand is coming back after a period of around 4 to around 5 years. And finally, you'll say, well, input costs have spiked up. But these companies have indicated that their price hikes have been to the tune of close to around 10% or thereabouts, which has offset most of the input cost spikes. So in the near term, margins may not get dented very, very badly. And as we always talk about, discretionary spends could pick up here in India. and that could benefit companies like these as well. A quick check on the valuations on a trailing basis, they're not cheap at all. 30 to around 50 times as we can see, but the street is building in better numbers that are coming in there. And that's why for a couple of names, they're actually in 25 to around 30 times on a forward earnings basis. However, if you look at it on a price to sales basis, well, that is quite interesting because Hawkins trades at around 3 times. Prestige, TTK Prestige trades at around 2.5 times. Remember, they're quite large in comparison to a Stovecraft, but a Stovecraft trades at around 1.5 times. So it'll be interesting to see whether or not these kitchen appliance makers can get their act together and drive home the gains from here on, because for the time being, it appears there are some tailwinds in store. Well, let me ask Sandeep. Sandeep, what do you think about this space? In the past, in 2021, it looked very, very good. And suddenly, things went wrong. We didn't have any big growth for the last few years. Is this a space you all have been looking at?
No, we are not looking. In fact, we are slightly underweight on most of the manufacturing name, and this space doesn't excite us. 2-3 reasons, because if you really look at in last 2 years or 3 years, last 2 years particularly, we have seen some amount of disinterest in some of these names, which is reflected in the revenue number. You've seen the hardly 2 to 8% CAGR growth you're seeing on the revenue, which means somewhere some momentum is getting lost, not from the market perspective, even more from the revenue perspective, and nothing very unique right now. Okay, so what market is looking at some new, like power is the theme which people are playing, or capital goods is the theme which people are playing, and frankly speaking, these valuations are also not that cheap that you can say, yes, we are like to participate. So for us, it's a avoid space. We are not participating into the space at all.
Got it.
Sandeep, this has been a very short conversation. We would love to chat with you more, but that's for another time. Thank you very much for joining in. Well, with that, it's curtains down on this edition of Editors Roundtable from the entire team. Thank you for watching. Have a good weekend. See you Monday morning.
Well, we've been calling it a blockbuster Friday for a reason. We had the RBI deliver its monetary policy in the morning, and this afternoon it's the GDP print. Q4 FY26 GDP coming in at 7.8% versus the CNBC TV 18 poll of 7.3%. FY26 real GDP growth at 7.7% versus the CNBC TV 18 poll of 7.5%. Let's get the first cut in. Latha joins us now. Latha, GDP numbers slightly ahead of estimates.
This is not slight, Shireen. This is quite a bit. 7.3 to 7.8 is big. I'll tell you why it's big. Why people brought it down to 7.3 was because there is one full month of the war. We are having the Jan-Feb March numbers. That's what we are discussing now. And Feb 28 is the first shot fired in Iran. And crude has gone to between 90 and 100 for practically all of March. And we had serious shortages of, packaging material. Anything connected to the petrochemical complex was hard to come by. Now, it's possible that people have used existing inventory and managed through the March month. We had, of course, some early signs that things are not bad because the corporate results actually surprised to the positive. For most brokerages, upgrades were more than downgrades. The PMI numbers, even up until April, was very good. And auto sales were blockbuster, March and April. And therefore, there was a sense that things were not bad, but that it would be so much better. 7.8, it is coming on a strong base of 7.8. Just look at the year-ago base. The quarter ago, 7.8, 7.8. That's an absolute blockbuster number. So, I mean, it is a stunner at this point in time. We have to look at the details. The other advantage advantage that will accrue to the coming year will be that inflation also will be high. Now we have to look at the nominal GDP. My sense is that may not be all that good because those were the months when inflation was low. So we may have a lower nominal GDP number, but I must say that the real GDP number at 7.8 for the fourth quarter and therefore 7.7 for the full year is quite an important number, a catchy number. Let me just see if we can get any more details. At the moment, the market is will be wanting to know which are the details. I'm not able to access the PIB website just yet. Do you have more details?
It's just opened. It's just opened, Lata, and I'm trying to just go over the details as well. Real GDP has been estimated to grow by 7.7%. Nominal GDP has witnessed a growth of 8.9%, Lata. Nominal GDP growth of 8.9%. Real and nominal GVA has been assessed to grow by 7.9% and 9.1% respectively. Secondary and tertiary sector boosted the performance of the economy by registering growths of 8.8 and 9.3%. Manufacturing, trade, repair, hotel, transport, communication, have attained double-digit growth at both the constant and current prices. And on the expenditure side, both the private final consumption expenditure and gross fixed capital formation have exhibited more than 7.5% growth rate in FY 25-26. So real and nominal GVA estimated to grow by 7.9% and 9.9% respectively in Q4 and in FY 26, Lata.
I can tell you some more eye-popping numbers. The gross fixed capital formation has grown at 10.8%, and I'm giving you real numbers adjusted for inflation. That's again a superb number. To be fair, the nominal also will not be very different because there was hardly any WPI inflation in the first quarter. And therefore, maybe even nominal would be 10.8, 11%. But this is a damn good number. And consumption expenditure, private final consumption expenditure, you would think that if there's so much investment, is that bad? No, it's not bad at all, 7.1%. So, we could take it with both hands. The growth of the previous quarters have also been revised, and that revision is even better. The October-December GDP growth has been revised from earlier 7.8, already very good like we were showing you. It has now gone up to 8. So that's even better. The July-September, that is Q2, has been revised to 8.3. It was 8.4 earlier, so marginally lower. And April-June has been revised to 6.8, 6.7. So not much of a difference in the first half, but the second half is an absolute stellar number. It is 8% in the third quarter and 7.8 in the fourth quarter. So you have a near 8% growth in the second half of the year. We must remember that this was the 2 quarters that had the advantage of 2 successive good harvests. Every FMCG company was telling us that rural demand has picked up. They were a bit iffy about urban demand. But, no two ways about CapEx. CapEx at 10.8 and much of it would be government CapEx as well. So I think this is all guns blazing kind of number. I can give you more details. Services has come in at 9.9. My God. Jan-March services sector. Construction at 8.4. Again, that's, usually a labor-intensive sector. So one likes to see it at 8.4, a good number. Manufacturing at 7.3. Other than mining and agriculture, which, even at 3.6 should be considered a good number, all other numbers are, well above the 7% mark. This is a blockbuster Q4. We were not prepared for this level of good news. The war clearly is going to have an impact in the subsequent quarter, that is the current quarter, because in March the petrol prices were not passed on and perhaps people used up inventories and therefore there wasn't a problem of raw material being too expensive. Maybe we will see the ravages in Q1, but so far so good, excellent numbers. I mean, even the Reserve Bank was considered a little optimistic and had given 7.6 for the full year, now finds the actual numbers beating its estimates. It was considered highest on the street, the Reserve Bank at 7.6. And look at the full year number now, 7.7. So, well, I have nothing more to add except to say that this is a superb piece of news. We got a blockbuster monetary policy from the governor, from the RBI, which has made the rupee the best performing currency today by a distance. It's almost 1% higher. And now, after market hours, we are getting the fourth quarter GDP, which puts the economy on indeed a very strong footing.
Yes, we called it a Friday blockbuster with good reason, Lata. As you pointed out, the RBI and the MPC, along with some support, fiscal support from the government, delivering in the morning, doing its part as far as the rupee is concerned and for capital flows, and strong GDP data coming in this afternoon, closing out this weekend and this week on a strong footing. So it bodes well as we go into trade on Monday. But Lata, quick summary now. Of course, the big story from the morning, which was the Reserve Bank, the measures taken by the government as well, in conjunction with the measures announced by the Reserve Bank, and to top it all, the GDP print.
Well, may I say, the rupee market gave a 90 basis point salute to the Reserve Bank. Like I told you, almost 1% higher is where the currency has ended. And that's courtesy, this almost rolling out the red carpet to FX flows. First was, of course, the ECB announcement. I think that will be the one that will deliver a lot because of corporates, PSUs really, NTPC, REC, PFC are now one and the same, SBI, BOB, even Coal India, all these can go and borrow abroad. And they would do it because it would be cheaper if RBI bears the hedging cost. Now, I would expect the banks to go, whole headlong into this, all the PNBs, SBIs, simply because there is a deposit crunch. So you get this money, your deposit crunch becomes that much easier for them. Funding crunch becomes easier. And then there is an FCNRB, foreign currency non-resident deposits are going to be hedged by the Reserve Bank. If the ECBs get partial hedging support, the foreign currency deposits, non-resident deposits get full hedging support. So it would be, very good for everybody, HDFC Bank, ICICI, Axis Bank, Federal Bank, the guys with a lot of non-resident deposits. All these guys are, could take advantage of this and their funding costs go down. That's why I would expect that the bank nifty will see better days because as the cost of funds go down, banks will have an advantage. Actually, you can see the impact today itself. The CD rates, certificates of deposits, which are bonds raised by banks, the CD yields fell by 25 basis points or 20 basis points. Likewise, corporate bond yields have fallen because if you take deposits from non-residents, where will you park it? It's a 3 to 5 year deposit. You're likely to buy corporate bonds. So corporate bond yields also fell today. CDs fell today, which means what? The funding, cost of capital for banks is going down. Therefore, it's an all-round good story. What will it do to the rupee? It is not just this, a likely 25 billion that will come from FCNRB and a likely 25 billion that may come from ECBs. So a 50 billion inflow. It's not just that. The other advantage is what it does to the psyche of the importers and the exporters. Until now, importers, the moment they know that they have to buy a raw material, they would go and buy the dollar forward. Because with each passing day, the dollar is getting expensive. Now, they will wait because it's getting cheaper. So you won't have the pressure of forward dollar buying by importers. And on the contrary, exporters have been asked to bring their dollars back in 9 months. They had 15 months earlier. More importantly, the exporter on his own will bring it back as soon as he can because the more you wait, likely you're going to get less. As it is, they'll be cursing themselves. Why didn't we sell at 96.5 and why didn't we sell at 96 and at $96 or 95.5? Today you're getting 94 and change for $1. So there will be a rush of exporters also selling. The guess in the market now is that the dollar could get as cheap as 93 to 94. So that's a fairly important, very important impact of the RBI policies. This is a seminal policy.
As a result of all these measures, we expect healthy flows, not only in this period of 3 to 4 months that we have given short window for ECBs and FC and RB deposits, but there have been other measures for equity as well as government bonds. So all put together, we are quite confident of very healthy, a much better BOP this year as compared to what it would have been otherwise. I think if I recall correctly, I said something to the effect that it is reasonable to think that it may not be overvalued. And some people, of course, do say that it is, when they look at REIT, etc., then they do say that it is undervalued. So this is what I said. I never said that it is undervalued, but by some accounts, yes, it is undervalued.
Well, that is the RBI Governor Sanjay Malhotra there delivering a booster shot to try and draw in capital flows, prop up the rupee, and certainly has been successful as far as defending the rupee is concerned today, closing below 95. On to the day's market action. Well, the equity markets largely lower today after a volatile session with the Nifty ending below the 23,400 mark. The Nifty Bank outperformed and ended higher for the fourth straight session. Nifty IT and Nifty Metal ending in the red today, so the bank stocks closing up in positive territory. A flat close for the markets, and the Nifty IT index down by about 1%. For the week, the markets have ended low for the second straight week, with the Sensex and the Nifty falling over 0.5%. Each mid-cap index was up by about 0.5%. The Nifty Bank down by about 1.5% this week. Well, the Reserve Bank has expanded access to Indian equities for overseas investors. Hormuz joins us now to tell us how. Hormuz.
This is exactly what has happened here. The RBI has made a very important announcement for the NRIs, the OCIs and the PROIs. What they basically have done is they have expanded the scope of a registration-free route to the PROIs as well. So the change basically is that earlier this registration-free route used to earlier be applied only for the NRIs and for the OCIs. Now, if you are a PROI or a person resident outside India, you had to earlier register as an FPI with the SEBI and then make your investments in the Indian markets, which complicated their investment process. That has been done away with, and now the PROIs will also be given a similar treatment as the NRIs and the OCIs are given. Now, their technical terminologies, of course, the NRI is someone who has lived outside India for 182 days or more in a financial year, and OCI, of course, is someone who has a foreign citizen of Indian origin having the right to live, work or study indefinitely in the country. And lastly, a person resident outside India, the PROI, that's actually a broader technical term which is used under FEMA, and all NRIs are PROIs, but all PROIs are not necessarily NRIs, and that is something that needs to be taken into account. Now, the investment cap that was earlier announced in the budget, the NRI investment cap has earlier been raised from 5% to 10%, and the combined all NRI cap for in companies has been raised from 10% to 24%. That will be put into effect. So a very important change coming in for attracting more dollar deposits into the Indian equities from the hands of the NRIs, the OCIs, and more particularly from the PROIs.
All right, Hormuz, many thanks. This was, of course, a budget proposal that has now been operationalized. On to the highlights of the monetary policy. MPC has kept the benchmark rates unchanged at 5.25% in a unanimous decision. The committee has also retained its neutral stance. However, the central bank struck a slightly cautious tone as far as the economy is concerned. It raised its inflation forecast for FY27 to 5.1% from the earlier 4.6%. The RBI expects supply shocks to wane from the fourth quarter, but added that the outlook remains clouded by weaker monsoon forecasts and El Nino risks. The central bank has also trimmed its growth forecast from 6.9% to 6.6% for the full fiscal year on the back of elevated energy and commodity prices and continued supply chain disruptions. Governor Malhotra said inflation target is sacrosanct and remains at 4%.
It's a target which is sacrosanct for us. It's a target which the government has given to us. It was reviewed It remains 4%, and that is what our endeavor is. But keep in mind that this target, it is to be met, over a period. So our target remains the same. It is 4%. It is to be met over a period of time. And as mentioned, we will be data dependent. We have to watch and see as to whether this shock supply, because it's a supply shock, whether its effect is going to persist or whether it is going to wane away.
So it's wait and watch as far as inflation is concerned. But on to the top global story. Crude oil prices remain unchanged as uncertainty clouds US and Iran talks and Hezbollah reject the Lebanon-Israel ceasefire. Let's break down the latest developments for you. Israel's army has killed at least 4 in a fresh wave of airstrikes in Lebanon. Israeli troops operating in southern Lebanon were also targeted by Hezbollah. The group's leader said negotiations had been futile and humiliating for the country. He also said the deal was rejected categorically by broad segments of the Lebanese people. Health officials say over 3,500 have been killed since the 2nd of March. However, President Trump claims progress has been made in ending the fighting with Hezbollah. Trump insists the militant group directly contacted Washington and asked if Israel's attacks could also stop. He also spoke about the ceasefire with Israel's Prime Minister Netanyahu. The president said he would meet Iran's supreme leader Ayatollah Khamenei if a deal is reached to end the US-Iran war. Meanwhile, Iran insists that there will be no peace until Israel withdraws from Lebanon. Tehran has also said it seeks to impose service fee for ships crossing the Strait of Hormuz in exchange for ensuring the vessel's security. The country's deputy foreign minister claimed Iran is not seeking to collect passage fee and the rules will be in line with international law.
Lebanon's been under attack for so many years and always like an underdog. And it would be really nice if it could end. And I spoke to Bibi Netanyahu about that, and I speak to them about it, and I actually spoke to Hezbollah about it. And I think progress is made. That's been going on for a long time.
Well, that's President Trump. We'll take a break, but up next, uncertainty over Tata Sons listing set to end soon. RBI governor says updated list of upper-level NBFCs will be issued shortly. That and more when we return.